Good morning, everyone. Welcome to all of you watching online and on FiOS 1 News. I'm Alexis Christoforous.
And I'm Brian Sozzi, and this is the first trade for Wednesday, October 30th.
General Electric's latest earnings show the turnaround may be taking hold, but all the special charges are leading to a whole lot of confusion this morning. We're sorting through GE's earnings report to make sense of what you need to know.
All sizzle and no steak. Beyond Meat hopes to rebound after a huge sell-off yesterday. We sit down with the founder and CEO, Ethan Brown, about what's coming next and what they're doing to win over those Wall Street bears.
And taking on Netflix. New details today on the launch of HBO Max, why you'll have to wait until May to stream South Park and so much more, and why AT&T thinks you'll pay more than Apple and Disney Plus combined.
Let's get a quick check of the futures here ahead of the opening bell. A lot of news out this morning. GDP printed under 2%. A lot more earnings, too, especially, as we just mentioned, from GE. Dow futures up 13 points. The S&P 500 and NASDAQ slightly in the green ahead of that big Fed meeting later on today.
We'll get a full check of the markets for you in just a bit, but first, today's big story.
It was another messy quarter over at GE. The company posted a beat on earnings, but revenue came in flat from a year ago. It boosted its free cash flow forecast and reiterated its earnings outlook, but there were a slew of special charges and adjustments, making for a very confusing report. We should say that revenue estimate includes Baker Hughes. GE sold off its stake in that business late last quarter. GE got some $3 billion in cash from that deal, which it used to pay down its enormous debt pile. The stock has been all over the place in the pre-market. Right now, it's now up 8.7% towards the highs of the session. Scott Gamm is here to help us break down the numbers. GE, very, very messy quarter here, Scott.
Yeah, this is not an easy assignment to have to do this this morning.
Well, that's why you're here.
But I want to start with industrial free cash flow guidance. This is the key metric for GE. They're raising that even with the headwinds from the 737 MAX issues, and I'll get to how GE is related to the MAX in a moment. But now GE is guiding for industrial free cash flow for 2019 for a range of flat to $2 billion compared to the prior guidance, which was negative $1 billion to positive $1 billion. For this quarter that we're talking about right now, industrial free cash flow was $650 million. That's a decline of 43% year over year. So that's why we're talking so much about industrial free cash flow. Now, when it comes to the MAX, we know that the engines on the 737 MAX jet are made by CFM, which is a joint venture between Safran and GE. So if you're at GE, this is frustrating because you have all these GE specific issues, and then you have, stuff you can't really control like the MAX. But we should point out that aviation revenue rose 8% year over year. That was one of the bright spots of the quarter. So that suggests that GE has a lot of exposure outside of the 737 MAX engines. And just one quick point, we talk about how there's an airplane duopoly with Boeing and Airbus. Well, you could argue that there's a similar dynamic in the jet engine space, right? You have GE, Pratt & Whitney,
sure,
and Rolls-Royce. So that kind of gives GE a little bit of a moat.
What does this report tell us about what's going right at GE? CEO Larry Culp's turnaround, is it finally, gaining some traction?
Well, aviation revenue was a bright spot. The fact that they raised their industrial free cash flow guidance is a bright spot. And we know that they saw some cash proceeds from the continued sale of their stake in Wabtec, and then part of that stake in Baker Hughes was sold off. So that money was used to help pay down debt.
All right. Thanks for making sense of the GE report this morning, Scott Gamm. All right, time now to head down to the New York Stock Exchange and check in with Yahoo Finance's Inez Ferre, who has a read on economic growth in the third quarter. Also, Inez, the parent company of KFC and Taco Bell, out with earnings today. How do they look?
Yeah, that's right, Alexis. I'll get to Yum Brands in just a second, but first to that GDP number that you were just referencing. GDP increased by 1.9% in the third quarter. This is the first reading, of course, of that number. This is a mild beat because economists had been expecting GDP to slow down to about 1.6% from the 2% reading in the second quarter. The growth was led by consumer spending. I also want to mention ADP private payroll numbers. Those came out this morning, 125,000 employees added in the month of October. This was led by medium-sized companies, followed by large-sized companies. Small-sized companies saw, though, the least expansion, job expansion. I also want to mention that the September ADP numbers were revised downward by 43,000 to 93, 42,000 to 93,000. Yum Brands, as you were just mentioning, Alexis, Yum Brands is under pressure this morning after their quarterly earnings came in below what the street was expecting. Pizza Hut same-store sales for the quarter were flat. The change also, the company says that the change in the fair value of their investment in Grubhub negatively impacted their profits, shaving off 15 cents a share. And then meanwhile, we're watching Mattel seeing a big pop in pre-market, up 21% after a better than expected quarter.
Inez Ferre, thank you.
Thank you.
Chipmaker Advanced Micro Devices just reported its highest quarterly sales in more than a decade, but its fourth quarter sales outlook was a little light, which is weighing on the stock this morning. Daniel Newman of Futurum Research joins us now. Daniel, good to see you again. You know, I was on that earnings call last night, and my initial takeaway here is they are gaining a lot of market share. Who are they gaining that market share from?
Yeah, in the client side, on the PC side, they've taken some share from Intel, who basically has had some issues with production. You've heard about the shortages in chips. That, of course, they've also had the announcements around their 7-nanometer product, which has helped the company gain some momentum. So I believe on the client side, that's definitely where AMD has been able to gain some momentum, specifically in that area of their business. Also,
Daniel, were you happy with their forward-looking guidance for the holidays and into 2020? And also, several times during that earnings call, they talked about record high gross margins. What's your take on that?
Yeah, I thought the numbers were a little light compared to what everybody was anticipating for the holiday season. Of course, I think their guidance was right at the sort of bottom of what the target was at about $2.15 billion. Conservative, but AMD has so much momentum. I think they might be playing it a little bit safe, maybe a little bit conservative. The stock almost 80% growth on the year. It's been a really tremendous run for the company. The margins are an area that everybody has to feel pretty positive about right now. 43% overall, which is a really strong number. But of course, the earnings coming in at about 18 cents compared to their competitors, compared to Intel, compared to NVIDIA. The company's still showing really light earnings, but the street has rewarded the company extremely well because the growth of AMD's value stock this year at almost 80% is significantly higher than, say, Intel, which has only seen about 11%.
Is it fair to say that AMD is shaping up to be one of the biggest winners from the cloud computing boom? They ticked off a lot of contract wins in the most recent quarter. I'm looking Microsoft, Amazon, you name it. They seem to win it.
The EPYC processor, their new server product, has done very well at 50% growth in the last quarter. And it's hard to deny. You mentioned a few of their wins. They had wins with Google. They had a win with Twitter. They had a number of OEM announcements, partners like HPE and Dell and Lenovo, who had included their products. Now, again, it's important to note that some of these wins are not exclusive wins. Intel is still very involved in a lot of these opportunities of working with a lot of these customers, but they're finding their sea legs in some of these areas, which for a long time the company hadn't. And I mean, even if Microsoft just had their new launch of Surface with their new hardware launch, and AMD found its way into one of the new Surface products. So you're starting to see them finding their legs in certain markets, and they're competing better. But you know, I do think, like I said, there's a lot of bullishness around AMD, and the company still has headwinds in front of them. They're still going to have a very formidable pair of competitors in both Intel and NVIDIA, and I expect the competitors to continue to come out with new products to challenge AMD's run. And again, if you look at their price earnings, AMD's been getting the benefit of the doubt, so it's kind of interesting to see how much higher can it go without the company showing some better earnings results in future quarters.
All right, Daniel Newman, thanks for the breakdown on AMD. Appreciate your time.
Thanks for having me.
Beyond Meat is hoping for a better day on Wall Street. The stock sank more than 20% yesterday, and that's despite serving up a beat on both the top and bottom line and raising its guidance for the full year. Let's go inside the C-suite now with Beyond Meat CEO Ethan Brown. Ethan, it's great to have you here. Welcome to Yahoo Finance.
Very much. See you guys.
What does a guy have to do? I mean, you turn your first profit in the company's history. The stock tumbles. We should note the lockup period expired yesterday, so lots of people who got in early had an opportunity to exit. Is Wall Street getting the Beyond Meat story wrong lately?
Well, I think what we're focused on is building this business over a very long period of time to a $40 billion business. We're looking very much at the global meat market, which is about a $1.4 trillion industry, and we feel this quarter we made immense strides in that direction, whether it's the QSR partnerships and tests with McDonald's and Subway and Dunkin', which is a national expansion actually. We feel that by focusing on those longer term relationships, building the value, the market will catch up.
What's your read on that test with McDonald's? I got a Bernstein note in my box overnight saying that demand may not be what they expected in Canada. What do you see from that initial test?
Yeah, so we can't discuss the actual results of a test while they're ongoing, but everything I'm seeing, I feel very optimistic about the long-term relationship with McDonald's.
So it's still looking like there could be a nationwide rollout in the U.S. at some point.
I would say that if we're successful in this test, which everything's pointing that direction, we should see a national expansion, but that's up to them, not me.
Sure.
Speaking of expanding, you want to go overseas in a big way. Currently, I think 18% of sales are coming from abroad.
Correct.
What will that expansion look like, and what about the costs associated with it?
Yeah, so we are very focused on not only the domestic growth here in the U.S., but also in the EU and increasingly in Asia. You'll see us be very aggressive over the next year, putting production in Asia, putting production in the EU, putting production in Asia.
So you'll do this locally in those markets?
Mm-hmm.
Okay. Mm-hmm. What about the swine flu? You bring up Asia. I mean, they're hit now with this swine flu. Do you think that that's an opportunity for your company and actually for protein-based?
I absolutely do.
Protein?
So what we need to do is in these communities that are now developing animal agriculture, we need to try to leapfrog that model and go directly to a model that takes the protein from plants and delivers it to the consumer in the form of plant-based meat. We believe Asia presents a terrific opportunity to do that, particularly with the issues they're having with their supply chain.
Several months ago, we talked about some new products that you are working on. Let me take them off. Bacon, where are you at with that?
We continue to work very hard on it. It's a big initiative within the company, and a lot of people are excited about it.
Why is it so hard just to get the fat right with bacon?
You know, it's interesting, as you get to products that are more transparent on the plate in terms of where the fat is distributed, where the protein is distributed, it gets harder and harder to do that. Something that's ground or has a lot of spice in it gives us room to play and potentially mitigate some of the areas that we're still working on. But as you get to that naked presentation, it gets harder and harder to do.
Is bacon first quarter of 2020?
We can't disclose when it's coming out.
Fair enough. And what about fish?
So we're focused on beef, pork, and poultry. That's the $1.4 trillion industry we're looking at, and so we feel very comfortable we can make a big impact there.
You're asked a lot about the health of imitation meat. A lot of folks point to higher sodium levels, that the caloric intake is actually pretty similar to beef. There's also high fat content. Are you guys working to sort of make things healthier as you go along?
So I think that has been an interesting dialogue in the media, and one that potentially could be better served by facts. If you look at, for example, the Dunkin' breakfast sandwich that we've done, that has 50% less fat, it has 44% less saturated fat, it has 37% less sodium, it has more protein and more iron. In my view, that's very hard to argue with. If you look at our entire product suite, we're about 25 to 38% less saturated fat outside of that breakfast sausage. So everything we're doing is delivering to the consumer all the benefits of meat, but taking out stuff that we think they could do with less.
Ethan, what's your overall message to the stock market here? They're seeing these wild swings from the IPO and right now. What's your message to them that probably see some wild swings going forward too as well?
Yeah, I think to stay very focused on the long-term prospects of the business. That's what we do at Beyond Meat. I mean, we put together a quarter here where I think you put 92 million in revenue, positive EBITDA, net income. All the right metrics are in place to grow this business from where it is today to a large global protein company.
Is your longer-term target still $2 billion in the annual sales?
So we have some pretty robust internal targets that I can't share. But as I said, we are looking at, I look at companies that are in that 40 billion revenue, serving a global protein market, and I think that's where we can be.
How do you remain the leader in this growing industry now, especially when you have traditional established companies that have huge distribution lines and huge supply chains like Nestle and Hormel sort of nipping at your heels? How do you do that and keep costs under control?
Sure. So I really answer that in two ways. The first is, to really win in this market, what we have to do is continue to drive three core pillars, and that's around taste, and making sure that we're delivering to the consumer a satiating taste that they love and are accustomed to in meat. The second is around nutrition. Let's keep delivering nutritional wins. Let's keep making our products healthier and healthier, better and better. And the third is around cost. Let's get the cost out of the system so that we can deliver to the consumer a product at a price that underprices animal protein. If you think about what we're saying, the animal is consuming a lot of vegetation and they're drinking a lot of water. They're using their biology and their skeletal muscular system to produce a muscle, which we then harvest as meat. What we're doing is taking the protein directly from the plants and the fats directly from the plants and skipping the animal entirely. We should be less expensive. We're not, because we're not at the scale. But as we get to scale, you'll see us be able to start dropping pricing and get below that of animal protein. That's a really exciting opportunity. Now, in competition, I got asked that a lot throughout the roadshow. And so competition is nothing new. We've been competing for a very long time with large established players. These QSR relationships we have, they were being pursued by other companies, of course, and we were able to win because we are myopically focused, almost manically focused on this one goal of building meat directly from plants. And we have the ability to move more quickly, take greater risk than any large incumbent player. We have no ties to the traditional supply chain. We have no sunk assets in that supply chain. So our ability to focus and move more quickly than the incumbents, I think, is a big competitive advantage. It's one that you see time and time again. And so one of the ways that I felt was an effective answer to this question on our roadshow was to return with a question, was why was Tesla able to do what Tesla has done to General Motors, to Ford, et cetera? There are examples throughout history where companies have been able to move quickly enough to provide a new product from somebody new to the consumer and upend an industry. And we've looked at those and are studying what's worked and what hasn't.
Well, we'll have to leave it there. Ethan Brown, hit me up with some of that bacon.
Will do.
Have a good
Thank you very much.
Always good to see you. Appreciate it.
Yep, sure. Thank you for having me.
Now let's get a look at European markets right now. European markets seeing some mixed action across the screen. The FTSE 100 in the green, CAC 40 slightly in the green, and the DAX in the red. Yahoo Finance's Oscar Williams-Groot joins us now from London. Oscar, what's the latest on Brexit?
We are having an election, Brian. MPs last night voted to approve a general election on December 12th. Now, Conservatives clearly think they can win a majority here. They've got a lead in the polls, and they're hoping that they can win enough seats to allow them to get Boris Johnson's deal through Parliament. However, it's a risk. In 2017, we had a snap election. Back then, Theresa May went into the election with a lead, but ended up losing her majority. Still, investors see this as at least some progress to breaking the Brexit deadlock. The pound continues to trade around 5-month highs against both the euro and the dollar today.
All right, Oscar, also Deutsche Bank out with results today. We know they've been in some challenging positions. How's their turnaround going?
Well, not very good if you're an investor. The stock is down 6% today. It's one of the worst performers across Europe, which is why we saw the DAX in the red. It booked a 832 million euro loss for the third quarter. Revenue fell 16% year on year, and revenue at its bond trading arm also fell, while all its competitors made gains. Now, CEO Christian Sewing is keen to paint this as just a little pain along the road towards a turnaround, but investors can't see past that revenue slump.
All right, Oscar Williams-Groot for us in London. Thanks as always. Let's take a look now at today's news bites. The top Ukraine expert on President Trump's National Security Council told House investigators that a memo of Trump's call with Ukraine's leader was missing key words and phrases, including references to former Vice President Biden and a Ukrainian energy company that employed Biden's son Hunter. 2 other career diplomats are set to testify today over the Trump administration's policy towards Ukraine. The National Weather Service has issued its first ever extreme red flag warning for Los Angeles. Meteorologists warn that strong Santa Ana winds today could spark extreme fire weather conditions in LA and Ventura counties. That would be, quote, the worst in recent memory. Meantime, fires continue to rage in Northern California's wine country. The NCAA is clearing the way for college athletes to profit from the use of their name, image, and likeness without jeopardizing their eligibility to compete. The move comes 1 month after California signed a law requiring schools to allow players to earn endorsement money. And hundreds of millions of people worldwide are at risk of losing their homes over the next 3 decades. That's as entire cities sink under rising seas. A new study published in the journal Nature Communications finds that nearly triple the number of people are under threat by rising tides. The research finds that by 2050, land that is currently home to about 300 million people could face severe floods at least once a year because of those rising sea levels.
Coming up here on The First Trade, brace for more trade talks. What to expect when the U.S. and China head back to the negotiation table and whether a deal will be reached in time. Also, it's almost showtime. Warner Media unveils details for HBO Max. We'll break down the new service and see what it means for the bottom lines of media giants Netflix and Disney. Taking a quick check of the futures here. Some green in the screen ahead of that big Fed decision later on today. Dow futures up 13 points, the S&P 500 and NASDAQ slightly in the green. We'll be right back. Welcome back to the first trade. Taking another look at the futures here ahead of the opening bell. Some green on the screen, not much, but just enough. Dow futures up 9 points. The S&P 500 and NASDAQ slightly in the green.
All right, investors snagged a China trade update this morning. China's foreign ministry said that China and U.S. trade negotiators are set to speak soon again after a U.S. administration official said that an interim deal might not happen in time for a signing in Chile next month. Joining us now to discuss China trade is Renaissance Macro Research Head of Policy, Stephen Pavlik. Steve, great to have you here.
Thank you for having me.
Just your latest on what you just heard. It seems like there's a lot of flip-flopping and perhaps misinformation that investors are trading on.
I think the Chinese official confirming it is positive because ultimately I think the U.S. has a desire here to pursue phase one, and that China is signaling that they're interested in doing that as well, I think is encouraging. I wouldn't read too much into the administration person's comment that you mentioned regarding not completing it by the APEC summit. I think that's still the goal, but I think what they're signaling is if it's difficult to put this agreement onto paper, and if for some reason that can't happen, then it could happen presumably sooner after the APEC summit. Recall this happened with Japan recently. There was an intent to try to resolve U.S. similar thing, threatening auto tariffs in this instance, with Japan agreeing to buy some additional agriculture products. They were hoping to have Trump announce it when he was at the G8 meeting. They kind of signed something to announce that they would sign something later, which they did. And my hope and my suspicion, that's probably what the administration official was referring to.
Are you surprised to see the markets at a record, given where we are in these trade talks?
No, I think trade has probably been the one thing that's been holding the markets back, candidly, at least the biggest thing in my view. And I think now that you're seeing more signs for optimism, it makes sense that markets would respond favorably to these encouraging reports. I think you got to look at the time horizon, though. I mean, positive news on phase one is encouraging, but is that going to be enough to get business investment off the sidelines?
Is it?
I don't think so. And I think when you talk about what would be in phase two, I think that's the more challenging issues. And you're kind of addressing the low-hanging fruit here in phase one. When you punt all the more difficult topics to phase two, clearly it becomes more challenging to land that plane, so to speak. So my guess is you'll see a positive reaction to phase one, presumably a lot of that's already priced in, but trying to project what this means longer term, I think, when you get to phase 2, those thornier issues, the timeline for that, opportunities for, again, talks to break down, that's something I think markets are going to have to wrestle with for a while.
So phase 2 would include things like intellectual property, opening up markets there in China. Are those the thornier issues that you're talking about?
Correct. The thornier issues, the structural issues, the intellectual property theft, forced technology transfer, subsidization of state-owned enterprises, which is something I think China is very reluctant to give up, market access, although one encouraging part of phase 1 was that they were talking about opening up market access for the U.S. financial services sector, and that is a way you could argue to address some of the intellectual property theft, where if you remove the ownership caps for the Chinese, at that point, U.S. companies would no longer be forced to transfer sensitive technology over to their Chinese owner.
Switching gears real quickly, how worried, you deal with a lot of buy-side institutional clients, how worried are they about Elizabeth Warren winning the presidency?
Very, very worried. And I think with respect to China, something that I think people should keep in mind is, having worked with Elizabeth Warren's office when I was at the Treasury Department, she's very hawkish on China. So I don't think, there's this, I think, sometimes misperception out there that China just wants to wait out Trump in hopes of getting a better deal. And Warren may try to outflank him there and not be as willing to remove tariffs or negotiate on sensitive technology issues like Huawei. So regardless, if Warren were to win, the time for her to get her new administration in place and formulate a response to China, presumably tariffs would be in place during that entire period. So.
All right, Steve Pavlik, thanks for the insights this morning.
Sure, thank you for having me.
All right, is the U.S.-China trade war putting the Trump presidency at risk in the 2020 election? In this week's Ballads and Dollars podcast, we look at the farm and factory vote and whether Trump is losing momentum with his base. You can check it out at Apple Podcasts or wherever you get your podcasts.
The opening bell is coming up here next on the first trade. Taking another look at the futures, some green on the screen ahead of that big Fed decision later on today. Dow futures up a mere 5 points. The S&P 500, NASDAQ slightly in the green. And here's a look overseas before we head to break.
Welcome back to the first trade. We are inside a minute of the opening bell on Wall Street, and stock futures hanging on to some modest gains here. Let's go around the bell with Adam Ozimek, Chief chief economist at Upwork, and Noah Hammond, CEO of Advisor Shares, along with Yahoo Finance's Jared Blickery at the Wi-Fi Interactive Board. Good morning to you all. Adam, I'm going to start with you. We got the GDP number this morning, a slight beat there, up 1.9%. Consumers continuing to spend. Businesses not so much. Business spending down 3%. So are talks of a recession right, or are they overblown?
I think talks of a recession are overblown. It's true that businesses are worried. They're not spending, they're not investing. But if you look at the consumer side of things, consumers continue to be optimistic. They continue to spend, and they're really driving the economy right now.
Noah, what do you make out of the GDP print this morning?
It's a good number, but as you said, companies are spending a little bit less, but consumers are spending more. So it doesn't tell me that the recession is not on the table. It just tells me it can be pushed out further, given Fed action in particular that can push that out for quite a while.
Okay, here we have the opening bell on Wall Street on Halloween Eve, by the way, folks, the Dow Industrials. It's going to start up about 14 points. Noah, I want to bounce off what you said about recession down the road. How down the road might it be?
I don't know. I mean, it depends on how long, we might be in this environment where we have an increasing Fed balance sheet and maybe not just one interest rate cut, but maybe even a few more into next year. So, we were very, bearish, and we were hedging our portfolio until the Fed announcement came out, and we started to get back long U.S. stocks, even long bonds as well, to take advantage of this liquidity in the marketplace.
Noah, what do you make out of Beyond Meat's quarter? We just had Beyond Meat's CEO and founder, Ethan Brown, on. Sounded pretty bullish to me. The stock got absolutely hammered yesterday.
Yeah, I think that's a company a little bit like Tesla, right? Great company doing great things, huge growth ahead of it. It's unclear if the stock price sort of matches the realistic financial expectations, but good numbers and a good company. Hard to tell what will happen with the stock from here, though.
Adam, we've got the Fed decision in just a few hours. Noah seems to think we could have some more cuts later this year, even into next year. What's your feeling on that?
Well, I think we're certainly going to get a cut
today.
Yeah.
Okay.
Because, if the Fed doesn't cut, it's going to be really disappointing to markets. They had plenty of chance to communicate that they weren't going to cut. So, people think it's coming, and it would be bad news if it didn't. It would be disappointing. As for what's coming after that, I think that they're going on a meeting-by-meeting basis, and they're paying attention to the data, and it's too soon to say what's going to happen.
What's the risk that Jerome Powell spooks the market at his press event?
We've certainly seen that several times so far in his leadership. But I think he's learning, and I think also that the risk of spooking the markets is higher when the Fed is on a path to continue hiking than when they're on a path to continue cutting. So, the fact that they're sort of pivoting towards dovishness, I think it does reduce the risk that they're going to spook the market.
Jared, we got a lot of earnings out today. I know Yum Brands taking a big hit. What have you got for us?
Yeah, we're looking at Yum Brands down about 8.5%. We'll go to the 2-day so we can see what's happening here. And actually, let's go to a year-to-date chart so we can see what's happened over the course of the last year. Pop up in a minute, but we do have a lot of earnings today. In the lead over there is Mattel, up 21%, reported after the bell. So this is Yum Brands. We can see it's up 9%, but it has fallen off a lot from its peak here. Some other earnings that we're paying attention to, Crocs is also up over 10%. GE, of course, a big one, up 8.6%. Garmin and Freddie Mac as well. Tupperware is the worst performing. That is down 20%, as well as Hess down 3%, and Molson Coors is down about 4.5%. But all in all, a pretty mixed picture here. We have a lot of earnings out after the bell today as well. Facebook is going to be in the spotlight, as well as Starbucks and Apple as well.
Jared, Pizza Hut, 0% same-store sales increase for Yum Brands. That is just not going to get it done. Noah, let me get back to you. We just had RenMax Steve Pavlik on, and he mentioned that his clients are a little worried about, or increasingly worried about, an Elizabeth Warren presidency. What are your clients telling you?
We're just nervous in general for what this next election, cycle will look like. Whether that's a continuation of our existing politicians in place or a whole new change. So I think regardless, we're going to see a lot of volatility. I don't think people get too worked up on a particular name. I think what you hear people say as they start the campaign trail and what they can actually get done when they get into office are two different things.
Jared just mentioned Facebook after the bell. We had that miss over at Google. Do you think that's a harbinger of things to come for names like Facebook and Amazon and Apple, which are still yet to report? Or was it more a Google-specific issue? Noah?
I think, that's what I'm concerned about in this whole sort of trick-or-treat environment coming into Halloween. I think, the concern is that could be the trick, those FANG stocks, right? You could see a lot more competition coming to that space, a lot more cost coming to that space, and maybe not quite the demand, right, with even the new iPhone sales. So I think all those companies, I put Netflix, Amazon, Apple, Google there as well, Facebook as well, could have some concerns coming into late this year and early next year.
Adam, what's your outlook for the jobs report on Friday?
So I think that we're going to continue to see growth, and we're going to see numbers that suggest that the economy is heading in the right direction, but it's heading there slower than it was. So the most important thing is to look at the sort of longer term fundamentals, the underlying trends, and the fact of the matter is the economy is stronger today than it was 6 months ago, and it's going to be stronger 6 months from now than it is today. And it's important not to get lost too much in the noise of short-term data.
Do you think next year we are printing sub 100,000 jobs reports every month?
No, I don't think so. I think that we are facing two headwinds right now. One is tariffs, and the other is we're still sort of getting out from under the Fed's path of rate hikes that were going too much. And the rate hike headwinds are fading, and I think that I'm optimistic. We still aren't at full employment yet, and the economy still has room to run. And I think over the next year or two, we're actually going to make it full employment, and you're going to see conditions for workers and everyone get a lot better.
What about those FANG stocks, Adam? Do you share Noah's belief that maybe things might get a little challenging for them going forward?
It's hard to say what's going to happen with tech stocks. There's a lot of volatility there. Expectations can change quickly. My focus is more on the core fundamentals of the economy, and they're strong.
What are you seeing in the freelance economy? Upwork does their primarily business model is working with freelancers. A lot of worries and concerns about are they making enough? Look at all the Uber and Lyft headlines.
So it's really unfortunate that when you talk about the freelance economy, there's a lot of focus on a really small corner of the freelance economy that is the gig economy. It's really much broader than that. The biggest category of work that people do in freelance economy is skilled services. So at Upwork, we do a survey called Freelancing in America, where we look at the entire freelancing economy, and we see that it's much more high-paid, high-skilled than the stories that kind of capture the headlines.
All right, you've got a closer look now at the Dow. Jared, over at the Wi-Fi Interactive board.
Yes, we do. Tech is outperforming today. It is in the lead. Apple's up 1/3% along with Microsoft. J&J up over 2% after releasing news that they didn't find asbestos in that contaminated, or what had been thought to be a contaminated sample. Walmart is up 1/4%. Financials are down as a 10-year T-note yield is down. JP Morgan down about 0.4%. Goldman Sachs down 0.75%. But it's almost month end. So let's take a look at month to date. We're going to sort this by the leaders, and we can see United Health, Caterpillar, and Intel are in the lead, 17, 11, and about 9% accordingly. And then Apple also up 9%, and JP Morgan up 7%. If we look at the sectors which are doing the best this month, we see healthcare is in the lead. We haven't seen that since about the fourth quarter of last year. We have tech up about 3%, financials up nearly 3%, and here's the S&P 500. So those three are outperforming. And then underperforming, we have slightly industrials, communication services, and materials. The worst performers this month are the defensive. We have utilities, staples, and real estate all in the red, along slightly with consumer discretionary.
Noah, any interest in getting into GE after that confusing but better than expected quarter?
Not really. I mean, if anything, GE is that great example of why I think, the overall economy, the global economy is still not that great, right? They forecasted horrible numbers and then beat them, and then the stock is up today. So I'm not sure that that's the right message that I want for a company that I'm going to invest in longer term. They've got a lot of changes ahead of them to make, and they can certainly rebound, but it's not a company positioned in the way that we would see a company that would have a much bigger moat, better protection around their pricing and things like that. I think they're going to continue to struggle for a while.
In this environment now of low rates going forward, Noah, where are you finding growth for your clients right now?
It's the companies with the larger moats. It's the ones that can protect their business. We don't like the financials as much, for example, right? All the price competition and transactions moving everywhere. Square's Cash App just announced trading stocks. And so all of that takes from market share from those companies. I think the techs can struggle. The things that we do like, though, are sort of tried and true blue chip in the Halloween spirit. We still like Hershey. We've liked them for a while. We like Sherwin-Williams. We like Raytheon. We like companies that have, strong market share, strong moat. And I think regardless of what's going on globally, will continue to be good companies to invest in. And those are the ones we like domestically.
Noah, interesting call out on Sherwin-Williams. That quarter did look pretty good. What's the play there? Is it a bet on lower interest rates?
I think it's been on lower interest rates, housing, refinancing of housings, building new housings. I think as, interest rates continue to either flatten or go down a little bit more, I think just that space, house improvement, you'll see that maybe even with some of the home builders, even though I know they've had some rough numbers here lately. But I think those core business models, I think, will continue to be successful.
What do you think about housing right now, Adam, the state of housing? We seem to be getting mixed results. Do you think that might actually be, that together with consumer spending, might be the thing that prevents us from slipping into recession?
So I think the housing market has been basically a missing piece of this recovery. And we've had periods of relative strength and weakness, but we really haven't seen the kind of recovery that you would expect following a recession of this size. And I think part of the problem was that rate cuts were getting ahead of where they should have been, or rate hikes were getting ahead of where they should have been. And now that the Fed is adjusting, we're starting to see a little bit of life, especially in new home sales, new home construction.
All right, we'll have to leave it there. Bring on that big Fed meeting later. Noah Hammond, always good to see you. Adam Ozimek, thank you. And
Thanks for having me.
And Jara, I should say, thank you too as well. Let's get back to Inez Ferrer now down at the New York Stock Exchange floor. Inez?
Yeah, Brian, we're looking at the three major indices which are in the red right now. You've got the Dow that's down about 40 points. It's being dragged down a bit by Boeing. It's down about 1.5% right now. Also, we're watching Grubhub today. Grubhub today is actually in the green. Yesterday, it was down about 40%, and Wall Street has started weighing in on Grubhub and its disappointing third quarter, with Goldman Sachs, Wedbush, BTIG analysts slashing their price target on the stock and also lowering their rating to mostly to neutral. Also, the company had said it plans to spend more in the next 12 to 18 months as a strategy to combat competition. We're watching also Molson Coors Brewing Company down this morning, under pressure. This is after an earnings and revenue miss for their latest quarter. Also, the company announced a big revamp plan. This includes changing their name to Molson Coors Beverage Company as they expand beyond beer. Also, they've announced some changes to their senior leadership and cutting jobs, anywhere from 400 to 500 job cuts at the company. And then we're watching Garmin seeing a bit of a pop today. This is after a strong third quarter. Their earnings and revenue beat Wall Street estimates. They saw product sales growth across pretty much all sectors, including aviation, fitness, and outdoor.
Okay, Inez, thanks for the update down from the stock exchange floor. We're keeping an eye on oil. It is falling for a third day in a row on reports of stockpiles rising at America's largest crude storage hub in Oklahoma. Yahoo Finance's Jared Blickery is back over at the Wi-Fi Interactive Board with our commodities report. Give us the latest on oil, Jared.
Yeah, we can see it's down about 1/3%. We did see some volatility, though, around the reports that were released this morning. Here's the overnight price action. We can see we got a spike up here and then a spike down, especially around the GDP report. Net, it's about even where it came from. The API report last night that you were referring to did show a build in the stockpiles at Cushing. We've seen that several weeks in a row. The overall stockpiles for crude did drop a little bit. The big number is going to come out at 10:30 a.m. We've seen some pretty big swings both to the upside and downside over the last 8 weeks, so there's going to be a lot of attention on that number. Going forward, it's all going to be about what are the Saudis and Russia, OPEC Plus, going to do with these production cuts, because we keep hearing rumors that the Saudis want to cut further and the Russians keep walking that back. So that's been contributing to oil price volatility, and we really haven't heard much in the way of geopolitical risk. That's kind of taken a backseat. So if we take a look at our 3-month chart here, we can see that we have been trending up, although we sold off a few days ago from this upper end of the trend line, and we're just coming back down to the lower end. We could hit as low as 53 if the trend continues, but again, 10:30 is going to be the time to watch.
And from oil to soybeans, correct?
Yeah, well, soybeans have been trending up, although they have fallen off a little bit. We can see they broke this uptrend right here. China, for its part, was supposed to buy about $20 billion worth of goods, but reports have been coming in that they haven't really been committing to it as much. And so soybeans and corn have been kind of falling off a little bit lately.
Jared Blickery, thank you. The market's been waiting for this day for weeks. The Fed, in just a few hours, is expected to announce that it's cutting interest rates yet again. And to say Wall Street already thinks it knows where this is going is a complete understatement. Let's get right down to our D.C. bureau, where our Fed correspondent Brian Chung is standing by. Brian, good to see you. So what's the one thing investors really need to lock in on today at this meeting?
Yeah, well, as you say, it's basically an understatement to say that Wall Street is expecting a rate cut. I was just looking at the Fed funds futures markets. Again, these are contracts that price in the odds of what the Fed will do in its meeting today. And it seems like 100% chance of at least 25 basis points of cuts. Actually, since the new GDP numbers came in for the last quarter in the United States, we actually have seen for the first time possible odds of maybe even a 50 basis point cut, although very small. It's 0.5%. Based on the Fed funds futures contracts. But a few things worth noting: what type of language they use in the statement. Keep in mind that there will be no dot plot projections in this particular meeting. So we'll be waiting for Powell's commentary, again, Chairman Powell's commentary about what the next moves on rates might be. We're looking at the third consecutive rate cut in a row if they do follow through in this meeting. That would match the 75 basis points of insurance cuts that we saw in 1995 and 1996, which Fed policymakers have pointed to as a template for trying to avoid a recession. So after this possible rate cut today, though, there are questions about whether or not the Federal Reserve would want to signal the possibility of future rate cuts. It really depends on how you read the GDP report. So on one hand, the headline number was better than expected at 1.9%. But on the other hand, you have some on Wall Street that are saying actually the U.S. consumer, which has been a bright point of the economy so far, has maybe appeared to weaken a little bit. The real consumption slowing to 2.9% from 4.6% in the second quarter. So a lot worth watching in this meeting. Again, the statement comes out at 2, and the press conference with Chairman Powell will be at 2:30.
Talk to me about the language in that statement. What could really spark a rally in the market? What do investors absolutely not want to hear in that statement?
Yeah, well, there was some chatter about whether or not the Federal Reserve would continue with the language "act as appropriate." This is the language that they've used in previous meetings to signal that they could continue to cut rates. Now, if they do tweak that language to what some suggested as what would be, quote, act as needed, that might signal maybe a bias to pausing for the time being. That might get markets in a tizzy. But again, worth watching. That statement will come out at 2 p.m. today.
All right, Brian Chung for us in D.C., thank you. And also, Brian will be in the room when the Fed decision is announced this afternoon. So stay with us right here at Yahoo Finance for complete coverage starting at 2 p.m. Eastern. AT&T's HBO will officially enter the streaming wars in May with the debut of HBO Max. Yahoo Finance's Melody Hom is in our LA bureau with that this morning. And Melody, I'm a little perplexed because at $14.99 a month, HBO Max is going to be the most expensive streaming service out there. Do you think they're putting themselves at a disadvantage right out of the gate on pricing?
Well, you got it, Alexis, but there's a lot of nuance here because keep in mind, $14.99 is the price that folks pay for HBO currently. So, in other words, the biggest winner in this entire picture are existing HBO subscribers. And essentially all the executives who spoke in Burbank yesterday said in so many words that folks would be very unintelligent to not upgrade to this HBO Max feature, which includes, of course, 1,800 movies out the gate, ranging from things like Casablanca to A Star is Born to Joker, which is still in theaters right now. And as we know, the streaming service will launch in May 2020. I think overall, your perplexed nature and all the questions you're raising are correct, but I think the existing 34 million subscribers who are part of HBO's ecosystem, both through the over-the-top streaming service currently, HBO Go, and coupling that with the cable linear subscribers, I think they have a pretty solid bet here, although initially that sticker shock was pretty high.
Melody, I'm also perplexed. I will echo Alexis' thoughts there. Despite the high price, no profits from this business expected anytime soon.
Yeah, no profits expected anytime soon. 2025 is when they're expecting some profitability. As we know, this is a very cash-intensive business. They announced a $250 million exclusive deal with J.J. Abrams' Bad Robot Productions. As we know, Ellen DeGeneres is part of the Warner ecosystem, so Ellen is working on a bunch of shows, including some kids programming. I do want to note, though, CEO Randall Stevenson ended the event with a really interesting quote. He essentially said that he plans to be profitable and show that on revenue as well as EPS, unlike some of the other competitors really trying to carve out this unique space for himself. I do want to note that at the Vanity Fair Summit last week, Netflix CEO Ted Sarandos said he was utterly shocked that it took this long for other players to enter this space, given the fact that they had such amazing content to begin with. And he was like, okay, they're definitely going to regret licensing this content to us, and we see that happening right now.
I'm just not signing up to this yet. Just full and fair disclosure there. Melody Hom, always good to see you.
That's
Thank
fair.
You. Coming up here on The First Trade, 'tis the season for ghouls and dollars, the big opportunity Halloween provides for investors.
And here's another look at those markets, and right now not looking too great. The Dow now off about 15 points after starting the day higher. In the broader market, things are lower as well. Got the NASDAQ Composite off by 9 and the S&P 500 down just 2 points. We'll be back with companies and stocks to watch right after this.
Welcome back to The First Trade. Happy Fed rate decision day. You return to some red on the screen ahead of that big decision. Dow is down about 11 points. The S&P 500 and NASDAQ also in the red.
Now for a look at some of the companies and stocks the Yahoo Finance team is watching for you today. Fiat Chrysler is in talks with the parent company of Peugeot about a possible merger. The move could help both companies cut costs and open up new markets. Fiat Chrysler's talks with French automaker Renault fell apart earlier this year when the French government objected. Boeing's CEO Dennis Muilenburg is heading into day 2 of questioning before lawmakers. He'll go before a House committee one day after being grilled by the Senate over those grounded 737 MAX planes. The head of the House panel says they have serious questions about how Boeing handled the rollout of those jets and the MCAS system. And WhatsApp, the Facebook-owned messaging service, is claiming in a federal lawsuit that Israeli surveillance company NGO used the app to help government agencies hack into the mobile devices of more than 100 people, including journalists and human rights activists. The suit alleges that NGO delivered malware to the mobile devices of targeted users through WhatsApp video calls. Uber, Lyft, and other apps are taking on a California law making gig workers employees. They've submitted a ballot measure that would exempt them from the law and are aiming to have the measure on the statewide ballot in November of 2020. And Lyft, by the way, set to report after the bell today. Airbus is slashing its delivery target for the year. Airbus originally forecast to deliver about 885 jets for the year. It now sits at 860. Delays at its new German manufacturing plant are the cause for the lowered production. The company reported $1.78 billion in adjusted operating income for the third quarter. In order to reach 2019 goals, Airbus must deliver 289 planes this quarter. And those are your companies to watch for this Wednesday, October 30th. Get a load of Mattel, up 17% on that better than expected profit report.
Halloween is almost upon us.
The first time we saw that, it was really cute.
Halloween is almost upon us, and things that go bump in the night could be extremely profitable in today's low unemployment rate economy. People will spend roughly $8.8 billion on Halloween this year. That's according to an annual survey by the National Retail Federation. When you break that down, the report even more, that means shoppers will spend $86.27 on average. That's a lot of change.
I'd have to say, here's a small snapshot of what people are actually buying. So $3.2 billion going to go towards the costumes. You got to have a costume. $2.6 billion on candy. I would have actually thought they'd spend more on candy than costumes. But the costumes probably cost more, right, out of the gate.
I'm giving out Beyond Meat burgers.
2.7. You're going to give out Beyond Meat burgers?
Maybe.
I love it. You're going to also see $2.7 billion on decorations. And that leaves a lot of opportunity for major retailers across the country. And that's well before the holiday shopping season. Remember, that has not yet officially kicked off. Oh, and a fun side note, 29 million people are going to dress up their pets as well.
Because why not? While it's adorable seeing our four-legged friends dressed up like Puppy Shark, it's not all good news. Expect to see a slight dip this year in Halloween spending. The NRF expects to see almost $500 million less being spent this year compared to last season. That is a lot of money. Despite the downturn, streaming stocks are in the spooky holiday spirit. From Netflix to Prime Video, as well as YouTube, there's a wide variety of horror content for you to indulge in.
Yeah, but there is one streaming service that's somewhat new to the block. It is hoping to cause plenty of nightmares on Elm Street. It's called AMC Networks, the people behind The Walking Dead. They're looking to reach a new audience with their streaming service, Shudder.
Service is for fans of horror, thrillers, or the supernatural. Fans can catch classics like John Carpenter's Halloween, love that, or a new and exclusive series of Stephen King's anthology project, Creepshow. It's planning on expanding into Australia, but it's currently in Canada, the UK, Germany, and of course, here in the US.
And if you're interested, the service is offering a pretty big discount for new subscribers until the end of Halloween, which is only until midnight tomorrow. So go over there and eat up all your horror films if you need to.
Is that what we've become, to dress up our pets? Is that what we're all about now?
Oh, absolutely.
Really?
Got to do it.
All right.
That's it for the first trade for this morning. I'm Alexis Christoforous.
And I'm Brian Sozzi. Enjoy that Fed press event later on today. Now let's get one more check in the markets with Inez Ferre down at the New York Stock Exchange. Inez?
Yeah, Brian, we're looking right now at some material stocks, which are a little bit under pressure, some energy stocks as well. But check out Mattel right now. It is surging. This is after a better than expected quarter with their revenue that was up 3.1%. That topped Wall Street estimates. And a big driver for them, of course, was Barbie and Hot Wheels. The company also said that they resolved an accounting issue that was brought up by a whistleblower. They're also looking for a new CFO. Their current CFO, which has been with the company for about 2 years, will be leaving after a transition period. We're also watching Molson Coors Brewing Company a little bit under pressure. This is after an earnings and revenue miss for their latest quarter. The company also announced a big restructuring plan. They're changing their name to Molson Coors Beverage Company as they're expanding into other beverages, and also announced some changes with senior leadership, and some changes also include some job cuts, anywhere from 400 to 500 job cuts. Make sure to stay with us because Wi-Fi AM starts right after the break. We're looking at the Dow that's down 13 points, the S&P and NASDAQ slightly lower.
Good morning and welcome to Wi-Fi AM here at Yahoo Finance. I'm Dan Roberts. We've got Heidi Chung and Kristen Myers here on the couches to go over all the business news of the day. So much to discuss. Let's start with the markets. On your screen right now, we are seeing red. All three major averages in the red, just by a little. The Dow right now down 10 points, and NASDAQ down about the same. And of course, earnings season is rolling on. This morning we had Yum Brands, parent company of many chains you know. Now Yum Brand shares are tumbling. We also had the big chip maker AMD, which reported earnings after the bell yesterday. So let's dive in. Let's talk about Yum Brands. Heidi, that's your beat.
Yes, the stock is down 10% in early trade today, and that is because a couple of things. So same-store sales growth, which is that key metric that we always pay attention to when we're talking about restaurants, missed worldwide same-store sales growth estimates, missed Pizza Hut estimates, missed KFC estimates. Taco Bell is the only one essentially carrying the weight for this company right now.
Is anything okay? Taco Bell. All right.
Not really. That being said, we also know that Yum Brands is invested in Grubhub, which is a company that not doing so well given the delivery wars that are going on. And they actually said that they took about a 15-cent hit when it comes to EPS because of that investment that they have in the company. The outlook, what do we think about the future of Yum Brands at this point? Because as we saw with Burger King, they had to do a lot of things when it comes to menu innovation, right? They had Exactly. So they had the Impossible Whopper at Burger King, they had the Popeyes Chicken Sandwich Wars, and that's why we saw that big boost in same-store sales growth. But Yum Brands, on the other hand, Pizza Hut has just been kind of stinking for a really long time. KFC does pretty well internationally, but here in the U.S., it's not doing so well. It's getting pushed out by Popeyes.
Well, I was going to ask you how much that competition from Popeyes with that new chicken sandwich, which obviously has been wildly successful for them, but also even for Pizza Hut, Domino's, really hitting it hard with innovation and with using a lot of tech, how much that's going to impact Pizza Hut. Because, I mean, does anyone really care about Papa John's?
Well, I will say it's not just Pizza Hut that's struggling in the pizza space. Domino's and Papa John's also not doing so hot, and a lot of that is because of the third-party aggregators, the Grubhubs, the DoorDashes, and Uber Eats. But then on the other hand, we're hearing bad news from companies like Grubhub saying that, you know, the space is not necessarily doing as well as a lot of people had anticipated. And just this morning, Goldman Sachs analysts saying that they were wrong about adding Grubhub to its conviction buy list, saying that this company is just not looking so good right now.
Now, which of these companies have gotten in on the fake meat train? I know you covered, one of them did a plant-based sausage.
Right, so the Pizza Hut collab between Kellogg's and Cognito, they tested it out for one day in one store. They did an Italian sausage replica that's not really made with meat. It was actually quite good. You've tried it as well last week. And yeah, that's what they've been doing. KFC did that one-time test outside of Atlanta with Beyond Meat. So they are looking into potentially expanding into that, but they've just been doing tests up until now.
Something feels to me especially wrong about a KFC doing this. I mean, I know every chain feels like they better have some kind of plant-based meat option because that's the thing right now. But for KFC, where the whole thing is like, it's chicken and it's our recipe and it's all about, you know, it's not like a general chain. A general chain like a McDonald's, Burger King, they do everything. So I sort of understand, like, we're also going to start doing this other thing over here, plant-based. But for KFC, where so much of the brand identity is the Colonel's recipe and the chicken, to also get into fake
Dan, think about it. When
the recipe isn't about the chicken in and of
what they
itself,
do to
it's
it.
what they do to the chicken. So, I mean, you could technically
But also,
apply that.
sorry guys, briefly, we have to talk about AMD because it was an okay quarter, but the forecast was really quite good. And one thing that we have to note is that Intel has been the dominant name when it comes to PC chips, but AMD is slowly coming in with their Ryzen chip, looking to take away market share. Looking to take away market share from them. So that's something that a lot of folks should be keeping an eye on.
All right, yeah, and AMD I know had its highest revenue in a decade.
Right,
Lisa a little light on outlook.
At the head.
All right, this morning we got the latest GDP number. It was 1.9% growth for the third quarter, and that was slower than the quarter before. Now, the number was not quite as bad as some economists had expected. Yahoo Finance's Emily McCormick here on the couches to talk more. Hi, Emily.
Hi, guys.
So 1.9%.
That's right. So the expansion continues. So this was better than consensus expectations. That was for just 1.6% growth, which would have been pretty anemic. But we're still seeing the slowest quarterly growth since the fourth quarter of 2018 and moderating from the second quarter's 2% 1% pace. This was mostly driven again by strength in personal consumption. So the consumer activity comprises about 70% of domestic economic activity. That was up 2.9% versus 2.6% expected, but still a moderation from that 4.6% we saw in the second quarter. That had been the strongest pace of growth in more than 4 years.
And CapEx spending.
Right, businesses aren't investing as much anymore.
Yeah, a
Right.
very dark cloud.
Right. So again, we're seeing that bifurcation in the economy where we have these trade manufacturing sectors that are really seeing a lot of weakness. And we're seeing now that businesses are being a lot more trepidatious in making some of these investments. This was the second consecutive quarter that we saw these non-residential fixed investments actually decline. That's really showing that they aren't really making these spending plans, that they are kind of pulling back and they are being a little bit more concerned. And that is a really negative sign for the economy. So even though we did get that better than expected headline, it could leave room for a potential rate cut when the Fed actually announces its decision again today.
How much concern is there going to be over the next couple of months, given that consumer spending, obviously such a huge part of the health of our economy, but now we have tariffs set to be applied in December, a lot of holiday spending. There's a little bit of wariness about how much consumers are actually going to be shelling out money in the next couple of months.
Well, the fact that this personal consumption figure actually came in ahead of expectations was taken as a good sign, because this did capture that period in August when we got that escalation of tariffs. So the fact that that didn't necessarily impact personal consumption spending plans for retail consumers in this quarter was seen as a good sign, showing that, you know, we could get some payback maybe in the fourth quarter that could moderate further. But still, again, really no signs that the consumer is really pulling back here.
I'm waiting for the President Trump tweet on the GDP situation because he had talked about the target, which is the 2%. I mean, he's had sort of made a promise at a certain level.
Right. Well, but this is, you know, far below his expectations, and again, slowest since the fourth quarter. One thing that I do definitely want to point out, though, is that core personal consumption expenditures. So that's core PCE. That's the Fed's preferred inflation gauge. That actually hit expectations. First time that it came in above 2% since mid 2018. So finally hitting that inflation target. That's another reason for the Fed to really improve its outlook on the economy, since that target had been something that had been so elusive for them for so long.
And Trump has actually already cheered the numbers already.
Today's?
Yes, on Twitter. Yeah, I saw it actually right.
You know, he's like ready to go.
But you have to understand that any news about the economy that has some good headline, he is going to latch onto. As we know, he uses the economy as almost a referendum of his presidency, and he's going to be ramping up that rhetoric more and more as we head towards the 2020 election.
I look forward to his tweets about the Fed later today. Emily, thanks so much.
Thank you, guys.
Well, the Fed will, at its annual meeting today, make a decision on a rate cut, and that will certainly have a big impact on markets. Joining us on the couch to discuss, Nick Maroutsos, friend of the program, co-head of global bonds at Janus Henderson. Nick, thanks for coming back on.
Thanks for having me.
What do you expect today? I know that you think there will be a cut and then maybe even another cut in December, but certain numbers have been pretty good, and so now you hear some people saying maybe there won't be a cut.
I'd be very surprised if they didn't cut interest rates today. There's something about an 85 to 90% chance that they will cut. Historically, what we've seen is that Fed officials typically bless what the market gives them. So in this case, I think it's too late for them to pull back off a cut, but I think you can make the case that you probably don't need to cut in this environment. You have stocks at all-time highs. You have interest rates that have sort of reverse course and are at more reasonable levels. So we're not at sort of the doomsday negative interest rates or zero interest rates that we were facing, 3 to 6 months ago. The dollar's eased off. The GDP numbers, while not fantastic, they weren't too bad. But you also have, less pressure on the economy. So ultimately, I think that they bless the market today. You're going to see Powell try to exercise as much patience as possible. The communication from him is critical. We understand that's not his strong point.
Yeah, markets usually react quite negatively if history is any indication to what Powell says.
Yeah, I think it'd be much easier if they just cut interest rates, issued a statement, and left it at that. Unfortunately, we have the communication or the Q&A, so that'll ultimately lead to some potential misrepresentations in messaging, but I do think that the Fed doesn't want to have to cut in December. It will largely depend on financial conditions in Q4, as well as any sort of money market disruptions or trade issues that are going on.
So, Nick, I want to talk to you about something that you had actually written in your note to us a little bit earlier about negative yields. Obviously, we're seeing this abroad. I'm wondering if you are at all concerned right now about a bond bubble.
I don't think so. And the reason why we don't see a bond bubble is because, yes, there's a demand for it. There's a reason why these bonds are trading at negative interest rates or such low interest rates. The value proposition isn't necessarily there, but people are buying bonds because they're worried about the fragility of the global economy, whether it's in the US or Europe. I think Europe is probably the biggest example of this because they've had negative interest rates for quite some time. You can also throw Japan in the mix, but their economies are in a recession. There's going to be very, very tough. It's going to be very, very tough for them to get out of this situation. Whereas I think in the U.S., at least we have positive interest rates. They have the ability to use the monetary policy to cut interest rates, but also engage in unconventional monetary policy should they need to. So ultimately, I think that that bonds are trading at a level that is really commensurate with what the level of demand is.
Nick, to that point then, as an investor, how should we sort of be positioning ourselves, right? When we take a look at our portfolio, how much should we be allocating to equities versus bonds?
That's a tough question. I mean, look, there's not a lot of things that scream value out there, right? You have bonds at very low interest rates. There's not a ton of value there unless you really think that the world is going to end up pretty poorly and rates are going to go to 1% or even lower. Equities are trading at all-time highs. So from our perspective, what we're doing is we are trying to be defensive. We're trying to create a portfolio that can withstand a recession if needed, but also look to generate some level of income and stability for the end investors. So you're not going to get double-digit returns in this market, but I will say that it's in the Fed's best interest to elevate stock market and keep risk assets propped up to avoid a recession. And I think that's one thing that both Trump and Powell agree on is that they want to avoid a recession.
In its best interest, but not overtly its job,
Correct.
As stated. I want to mention some breaking news. Bloomberg right now reporting that Chile, the country, has canceled its APEC summit amid those protests, and that is sending some stocks off their highs. Now, Nick, let's stick with what we're talking about the global slowdown, because the story has kind of remained the same over the last year, which Powell has said, which is U.S. doing pretty well. Yes, a number of global economies are going to slow down, but we can kind of keep chugging along. Do you see that as kind of the same right now? And in the next 6 months, what's the outlook there? Because I guess I'm asking also how concerned we should be about what's happening outside the U.S.
Sure. And I think for the first time in a long time, the Fed has recognized that the global picture is actually dragging down the U.S. And I think that's very important because the U.S. can be the outlier for a period of time. It can't be the outlier forever. So naturally, as China slows, Europe slows, the rest of the world slows, that's going to have knock-on effects to the U.S. because we engage in trade and all sorts of activities with global partners. So that's obviously going to have an effect on the U.S. economy. The U.S. economy has been relatively insulated, but it's largely to do with the consumer. The consumer has been the backbone of this U.S. economy for now, and I think that's really been what has been the driving force as to why the economy is doing relatively okay. So again, keep an eye on the data. On Friday, we have the jobs number, which again, I guess one thing I will take a step back. The GDP number is backward looking, so I think it's important to look at the jobs number this week, as well as ISM, to get a really indication of what the market's going to do. And again, that messaging from the Fed is going to be critical.
All right, we'll have to check back in with you in a few hours.
Great.
Get you back on. Thanks, Nick.
Thank you for having us.
All right, coming up here on Wi-Fi AM, it's day 2 of the Boeing hearings in D.C. We will have the latest. Stay with us. Welcome back to Wi-Fi AM at Yahoo Finance. Let's see what markets are doing on your screen right now. Of course, we had news that just came out minutes ago about Chile canceling its APEC summit. Right now, the Dow is still up just barely, but the NASDAQ and S&P in the red. Let's go to our friend Inez Ferre, live on the floor of the New York Stock Exchange for some more insights. Hi, Inez.
Hi, Dan. Yeah, you're looking at the broader markets, which are a little bit in the red right now. You've got the S&P and the NASDAQ, which are in the red, and this is because some material stocks, energy stocks are a bit under pressure. The Dow is relatively flat right now. It's up just 10 points. We're watching Mattel today just surging. This is after a better than expected quarter with their revenue increasing by 3.1%. That topped what Wall Street was expecting. A big driver for them was their Barbie brand with the new models of their Barbie dolls. Also Hot Wheels, that brand did very well for the company as well. And Mattel also announced that they have resolved an accounting issue which had been brought forth by an anonymous whistleblower over the summer back in August. They also said that they're looking for a new CFO. Their current CFO, which has been with the company for about 2 years, will be leaving after a transition period of up to 6 months. But really the story with Mattel here is that it's so different from Hasbro, because Hasbro had recently announced their quarterly earnings and it was a bad quarter for them. They said that they had been impacted by tariffs, by cancellation of orders. And in this case, Mattel is saying that tariffs did not impact their quarter.
All right, interesting to hear. You love to hear CEOs on earnings call at least acknowledge the tariffs and say one way or the other whether it's affecting their business. So interesting from Mattel. Thanks, Inez.
Thank you.
Well, Boeing CEO Dennis Muilenburg is back on Capitol Hill for day 2 of questions from lawmakers about the 737 MAX jets involved in those 2 deadly crashes. Now, senators grilled Muilenburg yesterday in a contentious hearing, and this morning he will face a House committee. Our friend Jess Smith is live in D.C. with the highlights from the hearing and can tell us what to expect today. Hi, Jess.
Hey there, we just started opening statements a few minutes ago on this hearing on the House side, and we do expect it to be fiery like it was yesterday. This hearing might even be a little tougher, and it is going to be even longer as there are more members on this committee. Chairman Peter DeFazio is the leader of this committee, and he has been extremely critical of the FAA and of Boeing throughout this whole investigation. He said that he can't remember an investigation of this magnitude on his committee before. So he said it's very robust and they're going through lots of documents, but they still have lots of questions for the CEO today. We do expect a lot of the same themes that we heard about yesterday. It's just how this happened, who at Boeing knew what, and when did they know it, and then how Boeing is working to make sure this does not happen again. Some senators had some really harsh words for the Boeing CEO yesterday. Here's Senator Jon Tester of Montana, who shows that Boeing still has some credibility to win back.
Before I was to get on a 737 MAX, I would walk. There's no way. And the question becomes, when issues like this happen, it costs your company huge. And so you shouldn't be cutting corners, and I see corners being cut.
Lawmakers accused Boeing of just rushing through the process of certifying this airplane, of trying to get it in the air. Some of them said that Boeing set pilots up to fail. One called these jets flying coffins. And we expect another portion of this hearing to really focus on the FAA certification process. That has been a big question throughout this, whether the FAA is giving too much authority to the industry itself. Dan?
Jess, yesterday, one of the questioners who I think scored obvious points, and you wondered if it was a little bit of campaigning, was Amy Klobuchar. I'm curious what you made of that and whether you think any of the other people, either in yesterday's hearing or today, are going to or did yesterday stand out as being among the tougher questioners.
Yeah, I'd say some of the tougher questions were from Senator Blumenthal yesterday, who he actually asked the family members to stand up and hold pictures of the loved ones that they lost. So that was a really, I think, key moment that everybody's going to remember from the hearing yesterday. We also heard from Senator Duckworth, who really just laid into Muilenburg, saying that he let the pilots down, speaking from her own experience as a helicopter pilot. So she really just laid into him and blasted him for his handling of this. So I think those are 2 moments that were really memorable in the hearing yesterday, and there's sure to be much more today.
All right, Jess Smith in D.C., thanks so much.
Of course.
We'll be right back here at Wi-Fi AM after a quick break.
It is time for today's trending tickers. First up, we have General Electric. Shares of the industrial giant soaring almost 13% in early trade today after the company beat earnings expectations and boosted its full-year adjusted free cash flow outlook. Now, one very important thing we need to note is that some estimates, including Bloomberg's estimates for GE's Q3 revenue, include General Electric's divestment in Baker Hughes. Now, however, GE noting in the earnings release, quote, as previously disclosed since 2018, upon ceding majority ownership of Baker Hughes, GE expected to record a significant loss upon deconsolidating the segment, and segment results were reclassified to discontinued operations. This amounted to $8.7 billion pre-tax, which was recorded in discontinued operations. Still expects to be free cash flow positive in 2020. Its power business is continuing to lag the other segments of its business, but
some accounting jujitsu.
Right. And so
very often in
we had a very varied number between Bloomberg and Refinitiv and all these different estimates for the revenue. So I just wanted to make sure that that was very, very clear.
Well, no, it's important to mention, especially because I feel like the last few GE earnings reports, there's been a little bit of wrinkle every time in terms of, well, there's this asterisk, or, well, you need to understand this thing they're doing because they're not including this division.
Right. Didn't they say when they included all one-time purchases, it was actually, they lost 15 cents?
Wait. No. That's speaking about Grubhub. That's the wrong company. But
next.
Just really quickly on GE, I want to make this point because Brian Sozzi, who very astutely pointed out also in a piece that he wrote up this morning, is that the way that the shares are reacting today is just really overblown. If you think about how incremental this beat was and this raise to his free cash flow outlook, because this company has been completely battered over.
And I also think it's when you fall so low, you see that excitement can,
the
littlest bit of excitement can stoke the shares like crazy. So it's also not totally shocking.
Yeah, and I mean, the company still expects that 2020 is going to be a really good year for them, that they're going to be free cash flow positive for the first time in a really long time. Now, whether or not this new or this current CEO is going to be able to pull that off, I think that is what investors are looking towards, is that free cash flow.
I mean, I think it just shows how difficult it is to turn GE around. I mean, it is an icon. We continue to talk about GE, and yet can't get it together. Moving on, though.
But yeah, also moving on. We are also watching shares of Grubhub. The company is actually higher today and rebounding after the stock shed some 43% yesterday for its worst day ever. Now, all of this comes as the delivery company gave weaker than expected fourth quarter guidance as competition runs hot in the delivery space. CEO Matt Maloney saying that the new competition from DoorDash and Uber Eats had a 300 plus basis point impact on Grubhub's growth rate for the third quarter. Now, management also calling customers promiscuous.
How dare
for no loyalty.
All these different delivery apps.
Trying to get the best price
possible. How dare you? Why can't you pick one and only ever use that one? Where's the loyalty?
There is no brand loyalty when it comes to your food delivery service, especially
also ride sharing.
Yep.
Well, so whatever's cheaper.
Right. Exactly. No, of course. Everyone switches between Uber and Lyft and Juno and Via. Like, I'm going to do the same. If I'm going to be getting the same meal and I can get it for $3 cheaper if I use Postmates or Uber Eats or Caviar, I'm going to do that.
That's interesting. I agree with that for the most part. However, I also think there's some people who you have the one on your phone that you often use, and hearing that there's a deal from another one isn't enough to use that other one when you're used to the first one. Unless you can only get from a certain restaurant using the other app. So what I mean is, when I lived in New York, I only ever used Seamless. I never once used Uber Eats in New York City, except the day I moved out, I was ready to try and get McDonald's breakfast, and you had to, at that time, use Uber Eats to get McDonald's delivery. So I downloaded Uber Eats just to get McDonald's. Otherwise, though, I never used a single app in New York City for food delivery other than Seamless, because Seamless was what I knew.
Okay, so I think that has mostly been true, at least for New York City. However, I'm starting to see a lot more of these food delivery apps gaining a lot more of these restaurants that you used to only be able to see on Seamless, right? So Grubhub. And now you actually have the option to jump between apps and see which one is going to be cheaper. Now, it used to be that Seamless never gave you a discount unless you were like a first-time user. Now I feel like every other day, I'm getting an email with some sort of promotion, which they have to do because they're trying to compete with Uber Eats, with Postmates, DoorDash, and the others.
I had the same exact experience as you. I only used Postmates because I wanted McDonald's before they were available on Seamless and Grubhub. But that being said, if we look at the whole entire nation as a whole, DoorDash is the most dominant name. It's here in New York that Grubhub actually even has a big presence. But if we look at the the entire country, it's actually DoorDash.
Really?
Which is the most
Number
market
one
share.
by market share?
By market share.
I think DoorDash entered the New York City market after
Yeah.
Seamless did. And so I think that a lot of the restaurants were already on Seamless. People became very used to using Seamless, at least here in New York City. And I don't know a lot of people that actually use DoorDash here. They
I've
might
never
go to
used it.
Postmates, they might go to Uber Eats, but
I've never used DoorDash.
It is a very regional business, just like peer-to-peer payment apps. In New York, you might think Venmo is all there is, but in other markets, there's Cash App. And then don't forget there's Zelle from the big banks. So it really depends on where you live. Yesterday, bad day for that
Really
stuff.
bad day. Worst day ever.
All right, coming up here on Wi-Fi AM next, we will sit down with the CEO behind the company that makes the helmet that the NFL says is safest. Stay with us. Welcome back to Wi-Fi AM at Yahoo Finance. Let's see what markets are doing on your screen right now. Right now, the Dow up just a little bit. It's up 10 points, hanging on to gains. Of course, we had some a little bit disappointing numbers today, GDP numbers, and that might impact the markets moving forward. NASDAQ and S&P in the red just barely right now. But let's talk about the NFL. The NFL currently has 34 approved helmets that players can choose from. And in lab testing, the league says that the number one safest option is a model from Visus. Of course, head injuries are such a big topic of discussion over the last few years, and not just at the pro football level. And Visus only just became an NFL helmet provider in 2017. CEO Dave Marver is joining us to discuss. Dave, thanks for coming on.
My pleasure, Dan.
So we have the numbers from the NFL and NFLPA. We'll show those on what they believe are the safest helmets. Number one, your model right here. Let's zoom out a little bit before we talk about this specific helmet. I want to make sure our viewers understand. NFL players, I think the average person doesn't realize this. They might think there's one helmet everyone wears. They have an option with helmets. They can wear one that they choose. And the NFL and NFLPA have 34 different models they approve of. So how does that work in terms of, do you guys market directly to the players? And I know you have a number of top players that choose to wear the Visus helmet.
So we have a direct sales organization that calls on the NFL clubs, and we meet with the equipment staff, the athletic training staff, and we educate them so that they can then, in turn, educate the players so that they can make well-informed decisions.
And you guys are competing with a number of other brands. Rydell is in there. How do you sort of say, look, I mean, we have the safest one. That's pretty good marketing. But I know that also for players, believe it or not, everyone, there are things that are important besides just safety. There's sort of, is it lightweight? Is it going to weigh me down? Does it feel good? So how do you sort of balance those things?
Well, safety and protection is number one. So we point to third-party independent data like NFL testing first and foremost. Then we need to develop a helmet that players want to wear. And so we try to implement performance-enhancing features. One of them is field of view. So this helmet has the widest field of peripheral view of any helmet on the market. That's why you see leading quarterbacks like Patrick Mahomes and Russell Wilson and Alex Smith choosing to wear this helmet.
And, I'm curious because when we talk about the NFL, I mean, we had you in here 2 years ago, 2017, and I think you had just become an NFL helmet provider at that time. So only 2 years, and now you've got, this is the newest model. How often are you changing, upgrading the model, and how fast can that happen? Because I imagine innovation with a helmet, I mean, it's so important. These things take time.
Well, as an emerging growth company, velocity is really important. So we want to continue to make this helmet better, and then we intend to introduce our next generation helmet next year. and take the technology even further. But yeah, I think I was here in 2016. We'd never even had our helmet used on field. And now the helmet's being worn by players on 28 NFL teams, 200 universities, including Columbia, one of your alma mater, and 2,200 high schools. So we've really had broad penetration.
Well, I'm glad you mentioned college and high school because we started off talking about the NFL, but the head injury discussion, of course, is not just at the pro level. And there are troubling numbers out there about youth participation. And we wonder, are parents moving forward, millennial parents in my generation, are they going to want their kids to play football in middle school and high school? And obviously that affects the talent pipeline for the NFL. You guys are also providing helmets to even at the youth level. So tell me about that and how's that different from working with the NFL?
Well, we are. In fact, one of my co-founders is a pediatric neurosurgeon. So from a mission perspective, we got into this to help the kids. And so this past year, we launched the 01 Youth, which is a derivation of this leading technology for kids. And we also launched this, which is called the Ultim Cap. I don't know if you can see this on camera.
Yeah.
But this is soft headgear, which is used for non-tackle football. There are now 6 million kids playing some form of non-tackle football. It's growing 10% per year. And they also suffer head injuries because of incidental contact. So we wanted them to also have access to VICE's technology.
Since we are talking about the collegiate level and we have you here, I'm just curious what you make of the NCAA news. That was major news coming out yesterday afternoon, the idea that the NCAA might be about to let college athletes get paid endorsement deals, which will just change the landscape economically so deeply. And since you guys provide helmets to schools like Notre Dame, what do you make of that change?
Well, we're player advocates, athlete advocates, so if it's good for players, we're supportive. I don't really get involved in those business things. We're 100% focused on trying to develop better protective technologies, frankly.
Does VICES do individual player endorsement deals? You have a number of players wearing your helmet. Have you yet used specific athlete ambassadors in advertising?
Well, that's what's interesting. Normally, you would expect a startup like ours to have to pay players to wear the helmet. In fact, we've never paid a player to wear our helmet. And quite the opposite, many of the players who wear our helmet have actually invested in the company. So it really is a strong statement of their belief in our technology and where we're going.
Let's end on this. We're talking about safety. This is, again, the helmet that the NFL and NFLPA say performed the best in safety tests. It's interesting and I think fun for people to hear a little bit about what happens in those safety tests. What kind of testing does the helmet go through? What's thrown at it?
Well, so the helmet is placed on an instrumented crash test dummy head, and then it's impacted in 8 different locations and 3 different velocities. And so each helmet's exposed to the same, very consistent test protocol. And from there, the results are averaged, and the score comes out, and we rank number 1, as you suggested.
All right, really interesting. We'll have to keep monitoring, see how the helmet landscape changes over the next few years. Dave Marver, thanks so much.
Thanks, Dan.
Dave is CEO of VICES, the NFL helmet company. And coming up on Wi-Fi AM, a major economic change for college athletes we will discuss. Plus, sticking with sports, Yahoo Finance talks to Mets legend Mike Piazza.
Welcome back. I'm Ines Ferre here on the floor of the stock exchange with John Corpina talking about today's market action. Not too much happening ahead of the Fed decision. What are you expecting today?
Yeah, that's as expected. Light volume, not a lot of volatility that we're going to see in our markets today. Everyone's in this wait and see mode as to what's going to come out of the Fed. And I think what we're seeing already is that the market is pricing in a 25 basis point rate cut, but that's not really what we're looking for. It's really going to be information, transparency, what the blueprint is going to look like for the next meeting and what their outlook is. We can discuss, the reasons why they've continued to cut rates, but I think we can also look at the fact that the situation in China has slightly gotten better with tariffs. The conversation about our economy has slightly gotten better. Brexit, the outcome of that is better than what we've expected to be at this point. So the Fed does have some ammunition to hold on to cutting rates, but if they deviate away from what they've already kind of said they were going to do, I think that would cause much more of a spark in the market. I think from this point now, they have to stay the course that we've been seeing before and really put it down, punt the can down the road to the next meeting.
What did you think of the GDP growth number coming in at 1.9% for the latest quarter? That was it was better than what some economists had expected, but still slowed down from the second quarter.
Yeah, I mean, clearly there are signs there that that GDP number has trickled down a little bit, getting below that 2% number. Like you said, better than some estimates, but not really where we want it to be. Look, our economy has grown very fast over a longer period of time, and sometimes we are going to see these slow down periods. I think there's going to be ways to trade around that, but at this point, if you take a larger look at the markets in our economy, things have gotten stronger and better.
And lastly, what do you think of the earnings that have come out so far?
So far, so good, right? The expectation, the bar wasn't set too high, so we're coming in kind of where the analysts were. I think everyone's kind of treading very lightly as far as what the outlook is going to look moving forward with tariffs and trade fluctuations.
John Corpina, thank you so much for joining us, and make sure to stay with us. Wi-Fi AM continues after the break.
Welcome back to Wi-Fi AM at Yahoo Finance. The Dow has flipped into the negative territory just a touch. Right now, as you can see on your screen, all three major indices, the Dow, NASDAQ, S&P, each one in the red, but pretty close to flat. We will keep monitoring. But time now to talk about major news that came out yesterday afternoon. The NCAA is directing its three divisions to consider changing the rules that prohibit college athletes from taking endorsement money. The changes are a direct response to California passing a bill doing the same last month. And at the NCAA level, these changes, if they take effect, would have to be put into place no later than January 2021. Yahoo Sports reporter Pete Thamel is joining us now from Boston. Pete, thanks for coming back on the show.
Hey, Dan, it's great to be here. Thanks for having me.
So what was your immediate reaction to this news? Of course, not official yet, but it sure looks likely to happen, and all kinds of ripple effects and complications that will result if this takes effect nationwide.
Like anything with the NCAA, it's complicated, right, Dan?
Oh, yeah.
In one sense, you look at this decision and it's historic. It's breaking away from some of the fundamental tenets of amateurism on which the NCAA was founded and then clung to for far too long as the revenues got into the billion. So there's that side. But really, when I started making calls yesterday and talking to officials around college athletics, the devil is in the details was the phrase that came up 3 different times. This was sort of a self-congratulatory, we're going to do something announcement. But until people find out what the NCAA is actually going to do, it's hard to throw a parade for them. I really think, Dan, that a lot of this is going to come down to recruiting. That's going to be the line of demarcation. Can you offer recruits in potential student athletes in that landscape different inducements? Because that would radically change everything, as opposed to some of the notion of this was that a star athlete like Chase Young should be able to benefit off the sale of his jersey. So there's a lot to sort out here, and it will be complicated and it will be messy.
Pete, Kristen here. So obviously a lot of people were cheering this decision. However, it doesn't come without criticism. I'm wondering if you could talk a little bit about how some people fear this is actually going to increase the inequity in college sports and even among different athletes at different universities.
Sure, Kristen, that's a really good question. I feel like one of the knee-jerk reactions to this from people in college athletics was the rich are going to get richer. If you are Ohio State, Texas, or USC, you are going to have the alumni base and resources in order to secure or keep or lure better roster. And again, this all comes down to recruiting, right? You need great players to have great teams. And so there is a sense that this is only going to further fortify those with more.
Hey, Pete, we're talking about how this will affect sort of demarcating the line between what is an endorsement that will be okay under these new rules and what is recruiting. And I've heard a lot of people make that point. Let's say you're a big booster of a program and you own a local car dealership. Could you do an advertisement and pay a player? But what if it's a big recruit? Are you now getting involved in the recruitment process? Another example of a potential problem here is I'm sure the NCAA will still be very closely involved in approving and regulating the deals that athletes do. And our editor-in-chief, Andy Serwer, pointed out right away, with all the changes to sports betting right now, well, would they allow a player to be in an advertisement for a gambling site? Would they allow a player to be in an advertisement for an adult content site? That's another sort of area that's going to get very tricky.
Oh, I mean, we could talk for hours about the potential complications, Dan, and those are certainly a few that are complicated, gambling and the other thing you mentioned. It is just, bringing amateurism into the wide world of commerce is just going to inherently be complicated. I don't think the NCAA can actually legislate what deals kids do, because you're talking about 1,000 schools and hundreds of thousands of kids. So, if the cross-country team at Shippensburg runs a camp in central Pennsylvania, it's going to be hard for the NCAA. Literally wouldn't have the manpower to be able to approve all of those things. I do think that, the $100,000 in-stadium sponsorship from the local car dealership may turn into actual cars for players. Like, it's going to, how people contribute to and support different athletic programs is going to be changed significantly. Generally, I think that's for the better, because it's just, instead of coaches making $9 million a year, it's going to slice the pie a little bit differently. But again, how the pie is sliced is really where we are, and it's hard to forecast all the complications that come with it.
Pete, just really quickly to Kristen's earlier point, NCAA getting a lot of credit for this, but help me understand, is this just because of outside pressure, or was this a national or a natural progression for the NCAA?
So it's a good question. My column on Yahoo Sports today essentially said that the NCAA has never been a proactive organization. They only act when a gun is pointed to their head. And they've had a few guns pointed at their head, which got them to this historic point. The first gun was really the federal basketball trials, which unfolded down the street from you guys the last couple of years. More than 2 years ago, there were 10 men arrested around basketball, 3 ensuing federal cases coming from that. And that essentially brought the black market to light. And because of that, and the California law and the 12 subsequent states that picked up the law, that's what happened.
All right, Pete Thamel, always good to have you on, our friend, the college sports reporter expert. Really appreciate it.
Thanks, guys.
Now, our editor-in-chief here at Yahoo Finance, Andy Serwer, had a chance to sit down with retired Baseball Hall of Famer Mike Piazza just yesterday at the Future of Search conference in New York City. And Mike Piazza, it turns out, is a big fan of Berkshire Hathaway CEO Warren Buffett.
So you're a fan of Warren Buffett. Yeah. What do you like about Warren Buffett?
Well, I mean, obviously, aside from as a brilliant investor, all these qualities that we talked about, merging with the ability to see markets and see the need and see talent, see companies that are up and coming, see companies that have good teams and that are efficient, that are achieving things, that are proactive, not reactive, and then having the capital to sort of make these strategic bets. And the reason why he's so successful, he would be, if you translate it, he would be a great baseball scout or a great baseball manager, going back to baseball and how it relates. And, again, we've talked before. I'm sure he's had a few tough things that didn't work out, as all investors do. And what do? You lick your wounds and you identify the next target. And so I think it seems like the thing about him that he's always been able to sort of learn from the mistakes and get better and not make them again. I mean, there's nothing wrong with the mistakes, but you have to learn from them, and that knowledge that you acquire becomes wisdom. You know, there's a difference between knowledge and wisdom. I mean, book smarts, and then wisdom is putting it in practice in the real world. So just have a tremendous amount of respect for him. And obviously, being unbelievably rich doesn't hurt as well.
Do you own any Berkshire Hathaway shares?
I wish I had more. I mean, I've been blessed to have good money managers. And I always say that's what it's always fun for me. I think as an investor, you have to have your safe space. So, pardon the pun, but you have to have your solids that are giving you a good residual return. But then you can have a little bit where you're making some strategic bets where you can, maybe play with the ponies a little bit.
Right.
And that's what I kind of do. And that's sort of been my philosophy. I've had some failures, but I've also had some successes as well.
Yep, pro athletes love Warren Buffett, and just about 2 years ago, I interviewed David Ortiz, who said the same thing, that he has taken investing advice from Buffett. You can watch Andy Serwer's full interview with Mike Piazza on the website, yahoofinance.com. And coming up here on Wi-Fi AM, AT&T going in on South Park. We will explain why and how much money is being spent after the break. Welcome back to Wi-Fi AM at Yahoo Finance. Let's talk about the streaming wars. The already very crowded streaming app space is only going to get more crowded. In May, Warner Media has announced that is when it will launch HBO Max. Of course, Disney Plus and Apple TV Plus launch in November. Then HBO Max will launch in May. HBO Max will launch with about 10,000 hours of content from Warner Brothers, HBO, Cartoon Network, Turner Classic Movies or TCM, and more. And HBO Max will be the most expensive of those three options I just named, at $14.99 a month. And by the way, HBO Max and its parent company paying, reportedly, $500 million to be the exclusive home of South Park. Mm-hmm. So respect my authority.
Honestly, I'm more interested in HBO Max than I am in Disney Plus.
Wow.
I know.
Well, HBO has a ton of movies.
Right, and I just like that content more. I just think that it's more up my alley. While I love Disney, obviously, all of the old school, the movies and all of the Marvel content, lovely. But at the same time, I can only watch so much Marvel. And I can only rewatch so much Disney, you know what I mean? So to me, I want this kind of content. $14.99.
But for $14, but do you want it for $14.99?
Well, how much is Hulu?
$5.99.
Well, yes, but if you get the ad-free one, isn't it more like
it's
$10.99, $12.99?
It's $12.
Right. So
$11.99.
exactly. At that point, I don't have Hulu, and I don't anticipate getting Hulu, but I will add HBO Max most likely.
Now, if we keep this graphic up, I want to ask you guys something, Heidi and Kristen.
Yes.
How many OTT video services do you currently pay for? And let's add in any that are about to launch that you already have decided for sure you will pay for. So for me, that's Disney Plus. Maybe for you, it's Apple TV Plus. How many? Let's count them.
I have 2 already. I have Hulu and I have Netflix.
What about Amazon Prime?
I also have Amazon Prime.
3.
That's 3. Sorry, I forgot about that one. I'm definitely going to be adding Disney Plus. For me, it's either Disney Plus or Apple TV Plus. I will not get them both.
4.
5 shows.
4.
Okay.
Heidi?
This is a really embarrassing admission, and I don't know how people will feel about this, but I currently only pay for Netflix. I use my friend's HBO account.
A cord cheater. That's
yes,
called cord cheating.
I am one of those that uses a login for my own benefit and not pay the fee. But that being said, I think I will pay for HBO when it comes out.
Yep.
I mean, I pay for HBO now, obviously, as like an add-on. But
HBO currently.
HBO
yeah, exactly.
currently.
Well,
will I get Max? That remains to be seen.
1 and 4. I think that I am the more common person. I think my number is a lot higher. Netflix, Hulu, Amazon, pay for them all. I'll do Disney Plus. I'll do HBO. I already currently pay for the HBO Go, I believe it's called, but that will become Max. So that's 5. I have Amazon Prime, which I didn't name. Now, of course, Amazon Prime, a little bit of an exception because you're likely paying for it to get Amazon
Right,
Prime.
I have it too,
It's
I
not a
forget.
standalone video. So I'm at 6. I also pay for YouTube TV, which is more of a general. Well, that's to have live TV. So that's 7. I also pay for ESPN Plus. That's 8. And according to certain studies I've seen, I'm not so crazy. The average person right now is closing in on close to 10.
How much is that in total for you? Like a month?
Roughly.
Well, we split, but it's only about $60 since we split everything.
A person?
So that
So
being
$120
said,
a month.
$60 a month.
Might as well just get a cable.
Yeah, but I wouldn't be doing it all if it were just me alone. We're a couple, so.
Okay.
And also, Apple TV Plus is launching Friday. So let's see how many people actually.
They're practically giving that one away.
I mean, yeah,
Well, yeah, it's free,
$4.99. It's the cheapest
essentially.
one. All right, well, let's continue the conversation on streaming wars because Sony announced it will shut down its live TV streaming platform, that's the PlayStation Vue, on January 30th, 2020. Since it launched more than 4 years ago, the service consistently lost Sony money, especially as competitors like Sling and YouTube TV, as Dan was just saying, became increasingly popular. Now, in a blog post, the media giant said, quote, PlayStation fans can continue to access movie and TV content through the PlayStation Store on PS4 and via our partnerships with top entertainment apps.
This is a shock to me, I have to say, especially because PlayStation Vue also had original shows. I mean,
Yeah,
this
they
is
didn't
a
do
major
well,
white
but
flag.
They did not do well. In fact, they famously had to cancel a lot of their shows after one season. PlayStation Vue is not, and they only had about 500,000 subscribers in total, which is
One of them was our
far
executive
less.
producer.
I was just going to say, in our entire morning meeting, only one person was
Only
actually
one person had
upset
it.
to hear this.
More than 0, but.
Right, but if you consider how many subscribers they had in comparison to YouTube TV, which I'm actually surprised that I'm also surprised that people have that. But in comparison, particularly to Sling, which a lot of people.
We also do have to note, though, that they just inked a deal with Disney to stream their stuff, and it just seems as if the insiders knew that this was potentially going to hit the chopping block soon, why would you make a deal like that?
Maybe the optics of, see, we're trying something.
Yeah.
What do you mean it's weird to you that people have YouTube TV? It's doing extremely well.
I don't know. It's just
wasn't that YouTube Red at one point?
That may be something else, like movies. But just to be clear, I also think when we talk about the streaming apps, you have to differentiate between premium TV ones that are just one thing, like HBO, Disney, and then YouTube TV versus like what Vue was versus DirecTV Now versus Sling. Those are stand-ins for cable.
Right.
So instead of having cable, you have YouTube TV. Yeah, that gets us all live TV.
Right.
It's great. All right. We're going to go to a short break. We'll be right back here at Wi-Fi AM. Welcome back to Wi-Fi AM at Yahoo Finance, where markets are a mixed picture right now, but not too scary. All three major indices close to the flat line. And speaking of scares, Halloween is tomorrow. And to get in the Halloween spirit, we were wondering about some of the creepiest jobs. That is according to PayScale, in PayScale's words. And what do those jobs pay? Yahoo Finance's Reggie Wade is in the newsroom with all the spooky jobs. Reg?
Yes, the unemployment numbers might not be scary, but some of the jobs on this list are. We see that a nocturnist earns the most on PayScale's creepiest jobs in 2019 list. That is a doctor who works the night shift. Then we have coming up, blood bank manager serves a very vital role. Entomologists who study insects and all kinds of creepy crawlies, so very in line with Halloween. Followed by mortician, crime scene cleaner, butcher, and gravedigger. So the most morbid jobs are pretty much on the bottom of the list. And some people may be surprised to see butchers on the list, but if Impossible Foods and Beyond Meat really get going, I think that could be the scariest of the jobs on the list.
Reggie, just really quickly, I'm not sure if you know what was on the list in 2018, but was a nocturnist on that list last year? Do you know?
Nocturnist, I believe Nocturnist was on that list. You know, since they are physicians, they usually command the higher salaries on a lot of these lists. Jobs in the medical field and the tech space often do. But it was interesting to see blood bank managers on there myself. We always know the good work that they do, but you don't realize that, yeah, actual people working these things, and you have to, like any business, you have to have a manager. So blood bank managers actually commanding a pretty good salary. So that was one thing that was surprising to me on the list.
Yeah, and these jobs are important. I mean, I wonder if the people who do these jobs would say that they're spooky. Looks like it's pretty good to be a nocturnist.
Yeah, it is. It is. And the director of PayScale said, you know, a lot of these jobs, they're hard, but someone has to do it. And the people who are doing these are getting paid quite well.
I was going to ask, Reggie, if the salary has actually increased over time, because some of these jobs are actually recession-proof. You always are going to need a mortician.
Yes, always going to need morticians, always going to need grave diggers. And PayScale even says, even in the darkest jobs, there are silver linings. If you're a grave digger, you get to work outside, get lots of exercise, fresh air.
True.
So
that's true. Good point. All right, Reggie Wade, thanks so much. Bye. And we're wishing everyone a good Halloween tomorrow. That is Wi-Fi AM for today. Thanks for watching. Stay right here for On the Move. That show starts next in just 2 minutes.
Happy Hump Day, 11 a.m. here in New York City as we dive into the stream 90 minutes into the trading day with stocks a little bit mixed. Dow is down, S&P 500 down as well, flat maybe. NASDAQ is trading barely higher. We're going to hit all of that following the better than expected GDP growth in the third quarter. Find another time to sign. President Trump and Xi Jinping get thrown a curveball on trade. Chile cancels the APEC summit. Here comes the Fed. What you need to know as the central bank gets set to possibly cut rates for a third time this year. And General Electric on the rise. The American staple topped expectations in the third quarter, with the company raising its cash flow forecast for the year. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for joining us. Let's take a look at what's going on in the markets today. Inez Ferray's on the floor of the New York Stock Exchange with some details for us. Inez.
Yeah, Julie, Adam, we're looking at a flat picture right now for the Dow, for the S&P, and traders here just noting that you don't have that much volume, and also we've been in this tight trading range all day as investors await the Fed decision later today. But I will show you some tickers which are moving today, including Yum Brands. Yum Brands is under pressure. This is after their quarterly earnings came in below estimates. Pizza Hut same-store sales for the quarter were flat. Also, the company said that the change in the fair value of their investment in Grubhub had negatively impacted their profit by 15 cents a share. We're also watching Molson Coors Brewing Company, a little bit under pressure. It had been down more than 4% in early trading today. Now it's down just slightly. This is after their earnings and revenue came in as a miss for their latest quarter. But the big news is that the company has announced a big revamp plan, including changing the name of the company to Molson Coors Beverage Company as they expand beyond beers. And also we're watching Mattel today just surging after a better than expected quarter, driven in part by their Barbie brand, also their Hot Wheels brand. Also, the company says that they are looking for a new CFO. The current CFO has been there for about 2 years, and they will be going through a transition period after he steps down later on. And also, the company said that they have resolved an accounting issue which was brought forth by an anonymous whistleblower back in August.
Inez, thank you. Our top story, of course, Chile cancels the APEC summit, which was scheduled for November 17th. President Trump and China's President Xi Jinping were expected to meet at the summit to discuss a possible phase one deal, maybe even sign it. Join us now to discuss all of this in the hour's panel, Heritage Capital President Paul Schatz and Yahoo Finance's Scott Gamm. Also joining us, well, let's talk with Paul first about this. Before we get into a larger discussion about the other headline today, the Fed. They canceled APEC, but it doesn't mean they can't still sign something, does it?
No, clearly, if and when they sign something, given President Trump's unique personality, I think we know that they want the whole world watching. They want lights, cameras, spotlights, and everything. So that was the perfect stage. I can't imagine it will be just some kind of routine signing. I think they really want to make this into the kind of grand event of the year, and that can also give his election campaign a little kick in the rear end.
Well, and I also think, look, the protests in Chile are probably the reason why this thing got canceled, and there's a lot of income inequality issues there, so it wasn't canceled because of a trade issue necessarily. The other thing is I'm pleased to see the markets holding up rather nicely from all this, because you see a headline like that, you immediately think, okay, the algos needs to start selling because maybe there won't be a trade deal as soon as we thought. But no, the market is taking this with a grain of salt.
Okay, something else the market's going to have to take with a grain of salt or is already priced in, the Fed decision. Joining us from Boston, Mellon Chief Economist Vincent Reinhart. Vincent, it's good to see you. Look, we all expect the quarter point rate cut, but I want to read something. Eric Rosengren, voting member, who at the last speech he gave in October 11th said, the stance of monetary policy already accommodative. My view is that policymakers can be patient. Is anyone listening to him? Is he gaining any strength?
Well, I think his colleague Esther George across the table will also dissent as they ease policy this afternoon. I think President Rosengren looks out the window of his Boston Fed office and sees a lot of cranes. Real estate is overheated, commercial real estate's overheated in his district, and that has to influence his view of the economy. I agree that 1/4 point easing today is 1/4 too much, provided my assumption about the political economy is right, that a trade deal gets signed.
Although, as we were just talking about, there's at least a logistical bump in the road to a first phase of that trade deal getting signed. And so how is...
Julie, but I would...
Please.
So, Julie, I would say if the leaders of 40% of the world's GDP want to meet somewhere, and one of them has a lot of properties around the world, they can sign a deal when they want to sign a deal.
Well, and Macau is one of the properties that, on the other side of the table, has been suggested as a potential solution to that. I do want to ask you about trade a little bit more, though, and how it has informed the economic growth, because there has been a little bit of a growing narrative that perhaps trade has not been the economic growth killer that many had predicted. We have heard certainly specific companies talk about it, Caterpillar, Hasbro, just to name two notable examples. But do you think that the effects were overblown?
I think the key issue, and you're right, is that trade matters more for our trading partners than the U.S. We are a big service-related economy. Only about 8% of the workforce is in manufacturing. Only 12.5% of our value added comes from manufacturing. And a big consequence of having a large trade deficit is that more goods and services come into the U.S. than leave the U.S. And so if there's an equal compression on global trade, it matters less for the U.S. It is a problem in Europe. We haven't been getting good data. Germany is probably in recession. Guess what? That's at least twice as trade-centric an economy as we are.
This is the longest economic expansion on record. Given where we are, given how GDP certainly has come down to more modest levels, what's it going to take to kickstart the economy to get GDP back towards 3%?
So I think that modest is good right now because we have slow population growth, slow productivity growth, and so at best our potential output is 2%. So if you want to sustain the economic expansion, delivering growth at 1.9% in a quarter, like we learned this morning, is actually something that will stretch out the economic expansion. The way we kickstart growth is figure out ways to increase productivity. If we're not, population isn't going to grow any faster because neither parties are going to be particularly positive toward increasing immigration for any time soon. But we can do things to increase productivity. We do that, then we can grow faster. But until then, I'd take 2% any quarter.
Hey, Vincent, you know, when the stock market was last at record highs in early May and then in late July, and then, of course, now, all those three times were followed by Fed announcements, or at least a Fed meeting. And, of course, we know that the market didn't hold those record levels. Is there anything to read into with that trend?
So Jay Powell's got a tricky job this afternoon. He's got to convey they had reasons to ease one more time, 3 insurance cuts. But he also has to put a speed bump down so that market participants don't extrapolate more. And he's got to do it in a way that doesn't snuff out the hopes in equity markets. So you're going to hear him talk a lot about the economy being in a good place, but all decisions are data dependent and made meeting by meeting. Tricky balance, and so we'll see what happens.
Vincent Reinhart is the Mellon chief economist and used to be on the inside at the Fed writing some of those statements. It's good to see you. Vincent, thank you.
Thank you, Adam. Thank you, Julie.
Well, General Electric's losses shrank last quarter and its revenue was little changed. On a relative basis, it was a strong performance for GE. It also raised its forecast for cash flow from industrial operations to $2 billion for the full year. Those shares are surging by 11%. Joining us now, Jim Corridor, Director of Industrials Equity Research at CFRA. It would be difficult, I think, for expectations to get any worse surrounding General Electric. That said, when you look at this cash flow situation now, it does seem, not even on a relative basis, but maybe even on an absolute basis, that things are improving.
Yeah, when you look at one of the main criticisms of GE, it was that their cash flow was declining and was going to get much worse, and there was no hope for it to get better anytime soon. Here we are in Q3 of 2019, and the cash flow numbers were better for this quarter. The guidance was better, and things seem to be slowly moving forward for the company, and it was good news today.
Okay, good news is something we welcome, but help us understand. We always talk in adjusted metrics, but the losses, at least when you talk about revenue, unadjusted, it was $9 billion, better than it had been in the last quarter. But how much longer can they sustain that?
Yeah, well, obviously there's some problems at GE. The power division continues to see orders down, but there's a lot of great assets at GE. The aviation business is seeing strong growth. Healthcare is doing fine. The renewables business is seeing surging growth, though at low margins. So there's a lot of positives to look forward to. Power is slowly coming under control. The order flow is decelerating. So we're seeing it bottoming out, and hopefully we'll see improvement next year. But there's a lot of moving pieces there, and some of them are moving in the right direction. And there's some signs of hope. The stock is priced for failure almost, and we're seeing that GE is making progress.
I also wanted to ask you, Jim, about the long-term care liabilities. That's an issue that Harry Markopolos had flagged at the company to much fanfare. And it looks like that the amount that they are setting aside to, the reserves they're setting aside for that are smaller than some analysts had estimated. But what about going forward?
Yeah, that was another positive for Q3 because it was an important test this quarter where GE was going to look at their liabilities and retest them. And they took a $1 billion charge this quarter for that, mainly due to lower interest rate environment, which changes the discount rate assumptions. There is some hope because they are getting higher rates than they expected on those assets as well. They are going to have to continually retest it, and there may be more charges coming in future years. But these are very long-lived assets, and it does seem that things are a little bit better than the worst fears on that asset.
We want to switch to something else that's going on. Boeing CEO Dennis Muilenburg is facing his second day of being grilled about the 737 MAX. You're looking at a live video feed from Capitol Hill. It's the House attorneys before the Senate yesterday. Jim, what do you think is the key message that an investor should take away about when that plane gets back in the air and what happens with Boeing going forward?
Well, I think when you look at the hearings, it's more about looking backwards as to what happened, what went wrong, who is there to blame. And that's certainly valid and important. But we're looking forward. It's important to note that the plane is going to come back into service. Boeing is a very important company for this country, and they are making progress on the software update. I expect the plane to come back into service late this year, early next year. And once that happens, we can start to look at the company on a normalized basis and look at the industry. There's strong growth in commercial aviation. Boeing is the largest commercial aviation company in the world with a huge backlog, and they should eventually be fine.
And we know, though, that GE plays a role in making the engines for the grounded 737 MAX jet. And my understanding is that the issue with the MAX was because the engines were too big for that plane size. So do you see any type of significant downside for GE in a possible scenario where they can't use those engines anymore on the MAX?
No, it's absolutely out of the question that the engine design will be changed. That's the number one benefit of the MAX is the more fuel-efficient engines. Yes, the engine is bigger, and now what's really driving the change in the software is that the engine bumps up above the wing, which changes the aerodynamics of the plane. But that's something that they are fixing in this new software update. So I expect that GE will eventually be fine. They did see a hit in this quarter on cash because of less deliveries of the larger engines, of course, but that should start moving again in 2020. I don't see any scenario in which GE has to make a different engine for this plane.
Jim Corridor of CFRA, thank you for your perspective. Appreciate it.
Thank you.
Racing to a merger, Fiat Chrysler and Peugeot, maker PSA Group of France, say they are in merger talks that could lead to the creation of a roughly $46 billion transatlantic auto giant that would rank as number fourth largest by volume. Want to go to the panel. Does this make sense?
So I always worry when you have multicultures involved in any kind of merger, it's hard enough when both are in one country. So now you're talking about not only cultures across a country, which are different, but cultures across borders and nations. I think long-term, fiscally, it may make sense, but I think if it happens, there's going to be all kinds of internal stumbling blocks for at least a foreseeable future.
Well, but they need that. They need the size. We've already heard. Marchionni, before he died, pointed out that Fiat Chrysler can't go it alone. That they have
size is everything.
Well, and Fiat Chrysler is already across border. It's already mashed up. Why not throw another culture in there?
Think about how difficult some of these mergers were in the past. Again, long term makes perfect sense. It'll be fine. But once for the next, let's call it 2, 3, 4 years. merging those cultures and the protocols, I mean, it sounds great on paper, but in practice, there'll be significant potholes.
Well, and you have to wonder, I mean, maybe this is more of a short-term issue, but if the U.S. were to slap tariffs on European auto imports, perhaps you could fight that if you had a more scalable auto sector in Europe. So maybe this deal makes sense from that perspective.
I'm still trying to figure out, when you talk about the cultures, there are examples of where it has worked. I mean, the Japanese and GM had the project out in California for 20 years. It ran well. Yes, Chrysler Daimler was a disaster, but that was more, Chrysler was a disaster to begin with. This actually might make a lot of sense, this deal, because you also get the platforms that Peugeot has that Chrysler Fiat may not have.
Right, and then you're separating out the long-term, I guess, of the result, the long-term return, the long-term analysis over what happens early on. I can't think of any kind of multinational industrial companies that have done big deals where things have worked out so well right out of the gate. I think there are challenges.
Well, we don't know yet if it's going to get done.
Yeah.
We're just in talks at this point.
And the
so.
French government squashed the last one.
Right.
That was the Nissan-Renault deal. But, you know, the French government's going to have a big say.
But with so many of these industrial companies, you really do. It's go big or go home. You're not going to survive in the global economy none of these companies are small, but a smaller player than competing against the big dogs.
Yeah, the amount you have to invest in new technologies alone is requires a big pocketbook. Yeah. All right, coming up, the U.S. economy keeps chugging right along, although it is slowing. Why some economists are seeing signs of a slowdown, more of a slowdown, despite better than expected third quarter growth. Plus, before we go to break, take a look at some of the top trending tickers on Yahoo Finance today. We were just talking about GE. It is trading higher, as is J&J, after it conducted new tests on its baby powder.
So GDP data out today, better than expected, but still indicating slowing growth. Third quarter GDP coming in at 1.9% versus 1.6%, which had been expected. Joining us with more is Emily McCormick. And Emily, so GDP down over the last quarter, but still beating estimates. How do we interpret this?
Well, Adam, the expansion is still continuing, just with a little bit less gusto than before. So we did get estimates topping headline GDP, that coming in at 1.9% versus the 1.6% consensus expectation, still down marginally from that second quarter's 2.0% growth rate. This was largely driven by still strong personal consumption. So that grew 2.9%, topping expectations for 2.6% growth, but slowing from that surging 4.6% pace we saw in the second quarter. That had been the fastest pace of growth in more than 4 years. We also saw a boost from government spending that helped buoy third quarter GDP by 0.35 percentage points. And then residential real estate actually grew 5.1%. That reversed a decline from the second quarter and was the first time that we saw a positive contribution from this metric in 2 years. That's because we have seen this broad rebound essentially in the housing market. Now, on the flip side, there were some negatives under that headline. So non-residential private investment turned negative for the first time since 2016 in the second quarter. We saw those declines continue, this time by 3%. That was the most since the fourth quarter of 2015. Within this, structures investment was the steepest decline. That was down 15.3%. This had largely been expected, though, because of some weakness in oil patch investment and other factory spending. So looking on that CapEx side, that was definitely the negative here, offset by strength in the consumer. This is a theme we've seen continue for the bulk of 2019 and something that economists look to continue. Back to you.
Thank you, Emily. Appreciate it. Well, as Emily was just talking about, third quarter GDP beat expectations. That it happens to be what our next guest expected. Joining us from Atlanta is Sam Dunlop, Senior Portfolio Manager at Angel Oak Capital Advisors. Sam, you thought it would come in at 2%, came in at 1.9%, but still, you, like many people we've been talking to, like Emily was just talking about, said it has to do with consumer spending and growth here in the U.S. And the question I'll ask you is what we've been asking ourselves and a lot of other people is, how long can that sustain itself?
Excellent question. We think it can sustain itself for quite some time. I think Emily just laid it out best that, the growth has slowed a bit and there were a lot of recession worries, especially leading up to the end of this year. But I think the growth data will continue to surprise to the upside, really led by the strength of that U.S. consumer. And really from a credit perspective and where we focus, the credit of U.S. consumers has really improved quite a bit in the post-crisis period. So they're just not as levered as they were really going into the last downturn that we saw, particularly heading into the last credit crisis. And we think that's notable as we look forward.
So there's the potential that a lot of people are misreading what's happening in the markets and in the world. I mean, GDP in the country could end the year at roughly 2.3%. That's what we're averaging right now. So if that's the actual case, where would you have me focus my investment attention? Should I be looking real estate? Should I be looking at equity? Should I be looking at bonds? What would you advise?
Yeah, so we still have a high degree of conviction really towards U.S. mortgage credit, really buoyed by the strength of that U.S. consumer. Again, it's been the big story for this year, and we think that that'll continue, really, garnered by the strength of the labor market and the improving wage picture for U.S. consumers. They've really been using that to de-lever their balance sheet, as I mentioned. I mean, household debt to GDP has come down from approximately 100% pre-crisis to now 75% today. Mortgage debt to GDP has come down from approximately 75% pre-crisis to 50% today. So that's an excellent credit fundamental, particularly for mortgage credit investors like ourselves. And we think it's an area of credit health despite, the fears of late cycle. So it's an area of attractive current income with an improving credit fundamental.
Sam, do you have any concerns, given how reliant we are on the consumer right now? Do you have any concerns with some recent retail sales data that all is not hunky-dory on the consumer side?
Well, I think, it's obvious we can't rely on the consumer forever in the U.S. economy. And over the medium term, I think that clearly the trade policy uncertainty needs to be resolved and restore some confidence from a business perspective as we look ahead. As Emily noted earlier, breaking down the GDP component, that's really been a laggard from a growth picture. So, if we had some trade policy clarity as we look into 2020, I think that would bode well for the growth picture and relieve some of the pressure from the consumer really driving that GDP number.
And Sam, the third quarter includes the month of August, which was when the yield curve inverted, and it was this daily narrative that a recession is here, hide under your desk. I mean, doesn't that whole narrative look foolish now when we see a print like this?
I wouldn't say foolish. I mean, there was some concern, particularly from looking ahead. I mean, the ISM manufacturing data, as we all know, and ISM non-manufacturing data certainly took a turn. And to your point, the curve shape, which everyone was focused on, certainly took a turn. We think this mid-cycle easing campaign from the Fed is certainly notable, and we'll clearly hear from them this afternoon. I think that will be something clearly to watch, particularly as they signal as what that looks like ahead. But one thing that is worth noting is the curve shape is re-steepened in light of this mid-cycle easing campaign. We'll see how aggressive they get, but we thought that mid-cycle easing campaign was warranted and will extend this recovery, really, frankly, far beyond market participants' expectations.
Sam, so historically, the issue with the yield curve is not as and when it inverts, but it's typically there's a lag period, and you're worried anywhere from 3 to 18 months later. Given that the yield curve has now steepened, are you concerned at all that the clock is now ticking on some recession, maybe in the Q4 of 2020 or perhaps even into 2021, or is the yield curve inversion a false warning?
I would never call them a false warning. It's something to take note of. But again, I think it's worth pointing out that the Fed clearly pivoted quickly. We think that December hike of late in 2018 was clearly a big mistake, and they took note of that. And the Powell pivot has been meaningful from a growth perspective, as we just highlighted. The growth, just overall, I would argue, is a surprise to the upside, especially as we head into the year. So, I think this Powell pivot is significant, and re-steepening of the curve will extend that recovery far beyond, again, expectations. It's very difficult to predict the end of these major cycles, but it is worth noting that the Fed's done a good job reacting fairly quickly to the warning signs that we saw, particularly related to the curve shape as well as some of the weakening manufacturing data and the trade policy uncertainty.
Well, as you say, we'll hear what Jay Powell continues to say on that front today. Sam Dunlop joining us from Atlanta. Thank you.
Thank you.
Coming up, voting on Brexit, why the UK will get another general election before Christmas. Plus, we are awaiting the Federal Reserve's decision on interest rates, how today's move could affect the U.S. housing market. More on that.
It is 11:30 here in New York City. We're 2 hours into the trading day. Stocks are trading lower modestly on this Fed day. And oil trading, let's take a look there as well. It is also trading lower by about 1%, 54.88 the barrel. Britain heads back to the polls. Lawmakers agree to Boris Johnson's request for another general election amid the ongoing Brexit chaos. Johnson & Johnson claims a number of new tests shows its baby powder is safe, but the FDA is not backing down. And the Fed hits home what the central bank's decision this afternoon means for the housing market. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Good to have you here. We're going to head across the Atlantic. British voters are going to decide the fate of Brexit after Parliament backed a general election December 12th. Yahoo Finance's Oscar Williams-Groot joins us from London. And break this down for us. What is at stake?
Well, Adam, both parties think that this could be the crucial key to unlocking Brexit. I don't need to remind you that we have been in a deadlock in Parliament for years now, with no Prime Minister able to get through a deal. However, now Boris Johnson has a lead in the polls and has managed to get Labour to agree to go and have a general election on December 12th. He is hoping that this will allow him to win a majority in the House of Commons and pass his newly negotiated deal. However, there is, of course, a risk here. Cast your mind back to 2017 when Theresa May found herself riding high in the public opinion polls and called a snap election. She ended up losing her majority of the House and Commons, and that was arguably ultimately what led to her downfall. Now, commentators over here are saying that Boris Johnson could risk a similar folly here. They say a week is a long time in politics, and by the time we get to December 12th, who knows what could have happened by then. Boris Johnson could have lost his lead. Corbyn could have really caught up to him. So the outcome is uncertain at best. However, investors are seeing this as good news either way for Brexit negotiations. Whatever happens in terms of the parliamentary arithmetic, hopefully it will allow for some sort of deal to get through if we can rewrite the numbers in the House of Commons. As a result, we've seen the pound trading near 5-month highs against both the euro and the dollar since the election was confirmed last night.
All right, and we also have to talk earnings there. Deutsche Bank is out with its third quarter results. How is that turnaround effort going?
Well, as ever with Deutsche Bank, the turnaround is not going as well as hoped for. They booked a 823 million euro loss in the third quarter, and revenue shrunk by 16% compared to last year. Now, CEO Christian Sewing was keen to paint this as simply bumps along the road to a bright future. The loss is largely driven by restructuring costs, he says, and he pointed to the fact that 4 of the core underlying businesses did make a profit when all these costs are stripped out. However, investors can't look past that big revenue drop that we saw in the third quarter. That's because there are ongoing doubts about this turnaround plan, particularly given the slowing global growth outlook and low interest rates. Shares plummeted 8% in Germany today.
All right, thank you so much, Oscar. Well, if the Fed does cut rates today, as largely expected, it could have a negative impact on the housing market. Low rates make home ownership affordable for many, but at the same time, squeezes supply could lead to a housing shortage. So not an out-and-out negative effect, a little bit of a balancing act. Joining us to discuss this was Mark Fleming, chief economist at First American. So which sort of that balancing act comes out on top? Will it be on balance negative or positive?
Well, I think this year we've seen from the Fed rate cuts over the past 18 or 6 months or so that there's clearly been a benefit to the housing market. The demand side in particular, house buying power has been increased dramatically. And so all those millennials who we thought were never going to buy homes are now demanding homes. And actually the home ownership rate that came out just the other day showed that one of the largest growth groups was that millennial group. The problem is that as time goes on and as rates stay this low, that more and more home owners lock in the 3.5% to 4% mortgage rate. And so there's less incentive to move in the future. So I look at the supply issue as something that might be further down the road than necessarily today.
Well, let's talk about the supply issue because there's still a severe inventory shortage for entry level and too much of a good thing. These low rates might make it more affordable for people, but at the same time, it can have the negative consequence of inflating the price, the actual value of these homes. So which is it?
Price is the result of the dynamic imbalance between supply and demand, right? The price goes up because we make it less expensive for that first-time home buyer to buy the home. All else equal, if rates go down, I can afford to buy more, so I go and I bid against all my fellow first-time home buyers, and the price gets escalated, and so the result is higher prices. And we've seen the Case-Shiller numbers yesterday. Our own indices since April have shown a reacceleration of house price appreciation, and that's because that making buying cheap relative to whatever the supply is, in this case restricted supply, just accelerates house price appreciation. And that actually is the moderator or the governor that then forces things to slow down. In a way, you can think about it, we price in that buying power and it goes away again until maybe we cut rates a little bit more.
So on that, rates have been historically low for now, well, let's round and call it a decade.
Right.
Who's really left at the end of this? You mentioned the millennials. I get that. There's a population, but the longer rates stay historically low and mortgage rates are insanely low, who's really left to give housing a kick in the rear end?
Right, so this is where, as an economist, I'm supposed to say what keeps me up at night, right? This is what keeps me up at night in the long run. Roughly 2/3 of all American households today are already homeowners. We know that there's this big millennial cohort that would like to buy, but that 2/3 of existing homeowners today have the 3.5% to 4% mortgage. When or if rates go up again, that lock-in effect means they'll want to stay put, they won't want to move, and it really sort of, leaves the proverbial next generation out in the cold.
Go ahead.
Well, you have the homeowners, right, and then you have renters, and I'm wondering if there's going to be some sort of transition between the two. In other words, do the renters eventually become homeowners, or do they just stay renters?
Well, we look at the renter population, the other third of American households, roughly. That's where your potential housing market demand comes from, right? Because if you're not a homeowner already, a first-time home buyer by definition is likely a renter right now. The question then is, as rates go up, then that affordability really begins to bind against a supply that's unwilling to come to market. If you look back historically over the last 40 years, rates have always been migrating downward in the long run, and that creates that move-up process, right? So that first-time home buyer then gets enough money or income growth and lower rates, and so he moves up into the next biggest house, which basically makes that available for that next first-time home buyer. That escalation engine risks really being broken as rates rise this time around.
All right. Thanks so much, Mark. Appreciate it. Mark Fleming of First American. Good to see you.
Coming up, Johnson & Johnson says its baby powder is perfectly safe and has 15 independent lab tests to prove it. But the FDA stands by just one test. That raises some serious questions. Plus, the World Series heads to Game 7 tonight in Houston. Facebook dropped its appeal and agreed to pay, are you ready for it? Just $640,000. It's a fine to the UK for selling user data to Cambridge Analytica. Remember them? It used personal data from 1 million UK citizens for political purposes. Facebook says it was pleased to have reached a settlement, and the company wished it had done more to protect user data. FDA officials stand by a lab test they say found trace amounts of asbestos in Johnson & Johnson baby powder. J&J hired 15 other labs which found no traces of asbestos in the baby powder. They tested samples, by the way, from the same batch the FDA used. House Democrats released the outline for public hearings to push the Trump impeachment inquiry forward. The House votes tomorrow. The White House says it's a sham. But a decorated Iraq war veteran and national security officer who happened to be on that phone call listening to President Trump's call with the president of Ukraine testified yesterday that important parts of the conversation were omitted from the transcript. The World Series heads to a winner-take-all game, 7 tonight in Houston. The Washington Nationals won Game 6 in Houston, tying the series 3 games each. The Nationals rallied and won, beating the Astros 7-2. First pitch shortly after 8 o'clock tonight. The game is on Fox.
All right, let's get to markets now. Stocks are choppy as bond yields sink the most in 4 weeks, coming up to the Fed decision. Yahoo Finance's Jared Blickey at the Wi-Fi interactive touchscreen. What is the latest, Jared?
Not a lot of movement in stocks today. The Dow is down 23 points, S&P 500 down 11 basis points, NASDAQ down just a little bit more. Russell 2000 is down about 0.8%. That is a significant move. We can see here's what happened today. This little spike down, this was on the news that APEC was not going to occur in Chile, and the market recovered right afterwards. I guess the thinking is that it will happen somewhere. That is the U.S. and China signing that agreement. Anyway, the markets are down just a little bit. 10-year T-note yield, the action is in bonds today. That is down about 4 basis points. As you pointed out, Julie, the biggest movement to the downside in about 4 weeks. As such, we have financials underperforming and we have the defensives outperforming. We'll take a look at some of those in a minute. Also looking at WTI crude futures. They are kind of volatile after the latest inventory report out of the Department of Energy. We can see they are down about 1% today. Here is the NASDAQ 100 heat map, and we can see the FANG stocks are kind of mixed today. Some are up, some are down. Microsoft up about 0.5%. Apple releasing its earnings after the bell, down about 0.75%. Facebook also releasing after the bell, down about 1%. But I want to take a look at the sectors, and we're going to take a look. This is today's performance. We're going to go month to date. Been an interesting month, and we can see in the lead there is healthcare. That is up nearly 5% for the month. Tech is up about 3%. Financials just up 2.5%. This is the S&P 500, so all of those are outperforming. Underperforming just slightly, industrial, communication services, materials. So basically we have the cyclicals leading this month along with healthcare, which hasn't led in some time, maybe to going back to the fourth quarter of last year. To the downside, we have utilities, energy, and staples. Bond yields for the most part have been climbing during the month, and that explains a lot of the movement here. Guys?
Jared, thank you. When people hear the name Koch Industries, startup investing doesn't typically come to mind. But the multi-billion-dollar corporation is deepening its ties to the world of tech with its VC arm, Koch Disruptive Technologies. Joining us now to discuss all of this, Jason Illian, Koch Disruptive Technologies Managing Director. It's good to have you here.
Thanks for having me.
One of the very cool things you're involved in has to do with 3D desktop metal production. But I got to ask you, what is frontier computational technologies, and how does an investor, what does this mean? Help us understand.
Well, it depends on how much time we have, right? Yeah. So, I mean, when we talk about disruptive technologies, really Koch's vision for this is how do we invest in the next generation of companies? Koch was always built on entrepreneurship. So Chase Koch, who's our president, had the vision of saying, how do we continue to invest with next generation entrepreneurs, which talk about things like desktop metal, 3D metal printing, as well as you just saw on the board of healthcare, and one of our companies is Inside Tech, which is a non-invasive focus ultrasound. So dealing with brain issues like Parkinson's and essential tremors, non-invasively. So looking at technologies that can truly make people's lives better.
Now, you're based in Wichita, Kansas.
That's correct.
Which is not a a name I associate with Silicon Valley
Right.
usually, right? Do you also look for investments that are outside of the sort of traditional geographic areas where you see these disruptive technologies come from? There are some other VCs that do that. Steve Case, for example, has a fund that specifically looks for that. Is that part of your mandate?
Yeah, so Steve's a perfect example. He's a good partner of ours. And so we're looking at technologies all over the country as well as all over the world. So we have an office in Israel as well that we've opened up. But we think there's good entrepreneurs in Boulder, in Denver, in Miami, Indianapolis, places that you haven't typically seen in the past. But you're seeing great entrepreneurial ecosystems grow up, and from there, really amazing technologies. And so Silicon Valley is still going to be a great hub. So don't get me wrong, there's great entrepreneurs there and lots of capital to invest. But we should be looking all over the country. And as those grow up, imagine what those can do, not only just for tech, but for our economy in general.
Do you think Silicon Valley has lost some of its luster just given all of the lackluster IPOs we've seen this year with, I mean, WeWork obviously didn't have their IPO,
Sure.
but there were other bad ones too, or are those one-off items?
You know, I don't think they're going to lose their shine. I still think Silicon Valley is going to be a centerpiece in tech going forward. But I think what you're starting to see, and Steve Case is doing part of this as well as a number of other funds that are popping up, is they're saying if there are great entrepreneurs in the Midwest or in the East Coast or in the South, we should be funding them as well. And what you've seen as part of these IPOs, like 10 or 11,000 new millionaires have been created in San Francisco. So what does that do to prices? It's hard to live there now. So what happens? They start to spread out. And it's good for everybody.
You know, I think that you can go online and see this. When you talk Koch Industries, everything. I mean, each of us in this room, something, we have an interaction with a Koch Industries kind of product. So when you look at this, and I want to talk about Desktop Metal, what are you hearing from companies when you invest in something like this? At what point do we come into contact with this product, and what's your time horizon for when maybe a Koch Industries is using it?
Yeah, so you're right. If you're talking about Koch Industries, you're talking about being in 60 countries, fabric that you're wearing, flooring that you're standing on.
Mattresses you sleep on, everything.
A little bit of everything, right? And so Desktop Metal is another interesting example, right? We're shipping machines to places like Ford and BMW and Tiffany's. So what if the next jewelry you bought for your wife was 3D metal printed, right? Or for your car that you're not holding inventory, you can print the parts you need. Or think about printing an entirely new type of part designed specifically with software that you couldn't build otherwise, but you can do with that. So you're starting to run into that today. You may not even know it, but in the future, all sorts of companies are going to be using these types of technologies.
Koch Industries has also, in recent years, become associated with politics because of the donations and politics of its founders. We saw the Stephen Ross situation with SoulCycle when there was a lot of consternation among SoulCycle customers. Is that an obstacle for you when you are dealing with some of these startup companies? Do any of them say, I don't want to deal with something with the name Koch on it?
Yeah, it's a good question. You know, at first I thought it could be, but as we've got there and started to sit down with entrepreneurs and say, what do you really need? Well, what entrepreneurs really need is that they don't need capital, but they need a partner that can help them think strategically. And because Koch is in so many different areas, we can help them think through those strategic ways of growing their company. And so great companies aren't built just because you throw a lot of money at them. WeWork, right? You've seen this. So what could you do to help that company think strategically? And so Desktop Metal, we try to help them think about how do you ship your machines? How do you do Q&A on your machines? How do you help your customers? And so what we found is actually just the opposite. Entrepreneurs have said, we would love to work with a partner that thinks beyond just the capital infusion.
I needed you about 10 years ago. I was rebuilding a Stromberg carburetor for a 64 Studebaker. It was terrible. Awful. I'm keeping my day job. But
we can hook you up. We can hook you up.
That 3D metal printer would have been great if it could do a carburetor. Thank you very much.
Thanks
Jason Ilian, Koch Disruptive Technologies Managing Director. It's good to see you.
Coming up, industrials are back in focus, how Boeing's 737 MAX scandal is affecting GE's bottom line. Plus, where's the optimism? Why Paul says there is excessive negativity on Wall Street. Let's take a look at trending tickers from YahooFinance.com. You guys are watching Netflix today, apparently. Yahoo Finance users, that is. The shares are up 3.6%. Couldn't find any specific news on Netflix, but this may be tied to the announcement yesterday of the new HBO Max service, which will roll out in spring of next year at $15 per month. And that has led to some questions about whether how many people are going to be buying that service. So maybe we're seeing a bump for Netflix on the basis of that today. Not so, though, for Tupperware. Tupperware shares are plunging 31%. The company's sales fell by 14% last quarter. Listen to this miss, 43 cents a share versus the 62 cents that was estimated by analysts. And for the full year, Tupperware says at most it's going to make $2.83, $3.47 was the average coming from analysts. The shares are already down 66% this year, including the declines that we are seeing today. And then C.H. Robinson, that's the other one I'm looking at here. C.H. Robinson shares have been all over the place this year. Today, however, they are down by 15%. That company saying revenue fell by 10%. It's a logistics company, and it says there is an aggressive industry pricing environment that'll persist here in the second half of the year. Earnings there also missing estimates. If you look at stocks overall today, we're not seeing much change. That's not unusual for Fed Day, not unusual for a day during earnings season either.
Time for Word on the Street. We are going to check in with the panelists. We're going to find out what they're watching. Scott, how does the Boeing scandal, do you think, really affect GE? You were asking about the engines earlier.
Yeah, well, people may not realize that the 737 MAX engines are made by CFM, which is a company that's a joint venture between Safran and GE. So GE has exposure to this space, and GE said itself that the 737 MAX issue could cost more than $1 billion this year, although aviation revenue for GE in this quarter rose 8% year over year. So clearly GE has exposure to jet engines beyond just the 737 MAX. The other point I wanted to make is that, we talk a lot about the airplane duopoly, right, Boeing and Airbus, but you could argue there's a similar dynamic in the jet engine space, right? You have GE, Rolls-Royce, and Pratt & Whitney. So that's another benefit for GE. It kind of gives them a moat. But it's got to be frustrating for GE to have all these GE-specific issues, and then your kind of one bright spot, aviation, is now depressed by this uncontrollable 737 MAX issue.
Although it was interesting how unequivocal Jim Corridor of CFRA was when you asked him, will there be any change to the engine? And he said, absolutely not. The engine design is going to remain intact.
I don't know how you could know that, but you never know.
I guess the problem with the plane is not regarding the engine. Let's talk about a problem that Paul is seeing perhaps in the broader market. Too much negativity, although a lot of people would say that's actually a positive.
Well, it is a positive to a point, right? We come into the year on the heels of a 20% decline. The world is as negative as they've ever been on Earth. Now, fast forward, we're roughly all-time highs again. You've got option traders who are buying protection, meaning playing for lower prices. You've got, in the sentiment surveys, you got levels of bearishness we normally see at market bottoms. The Barron's latest big money poll, you've got big money who's as bearish as they've ever been, yet price still chugs along. It's insane that you'd be hard pressed to find someone who's been more bullish on this market than I have been for the last 10 years. And after every single-digit decline, the world jumps in, the doomsdayers and the naysayers that this is the end, the bear market's coming. People are missing out on what has been a phenomenal bull market. It's not over yet because every little item, especially when it comes to politics, is impacting their views of investing.
If you had gotten out, because of what happened in the last quarter of last year, you would have missed roughly a 52-week, 10% gain on the S&P 500. But I got to ask you, despite all of that, the outflows, we talked about this yesterday, outflows are ginormous out of equities, into cash and into bonds.
So the outflows people are trying to assign rationale behind them. It's a secular move out of equities. Now, a lot of it's baby boomers, 401ks rolling into IRAs, retired don't want that kind of risk anymore. But frankly, they've been rewarded because bonds have done fine. I would argue in the 2020s, at some point in the next couple of years, that bond investor is in for a world of hurt because when rates start to go up the next time, it's for good. But it's crazy that at every little juncture, we see a trade tweet, people sell. I rarely hear anybody at parties, any kind of events, clients who have this kind of internal power that market's going higher. Yet That's why they keep going higher.
Yeah.
Markets are not going to end until the dumb money comes in.
Right. All right, Paul Schatz. Thanks for being here. Good to see you. Scott Gam, thank you as always. Also, coming up, chaos in Chile, forcing the Chilean president to cancel that highly anticipated APEC summit. What it means for the prospects of a U.S.-China trade deal. Where could that summit happen? That's coming up. Plus, before we go to break, take a look at some of the biggest winners in the Dow today. We've got J&J on the rise after doing some new testing on its baby powder. On noon here in New York City, 2.5 hours into the trading day, stocks are trading a bit lower. That follows better than expected GDP growth in the third quarter and ahead of a Fed decision. Taking a look at the 10-year Treasury yield, we've got a 4 basis point decline there in anticipation perhaps of that Fed rate cut. 1.8% is where we stand. Find another time to sign. President Trump and Xi Jinping get thrown a curveball on trade as Chile cancels the APEC summit. Here comes the Fed. What you need to know is the central bank gets set to possibly cut rates for a third time this year. And driving towards a merger after failing to join with Renault, Fiat Chrysler reportedly sets its sights on teaming up with Peugeot. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. We got an eye on markets for you today, of course, but the top story, the Fed decision. The Federal Reserve is expected to give its third rate cut of the year this afternoon to the rest of us. But the key question is, will Fed Chair Jerome Powell signal more rate cuts in the near future, or actually what's next? Joining us from Washington is Yahoo Finance's Brian Chung, and that's the key question, right? In the press conference, we'll get what's next after all this.
That's right. A lot of questions, but not as far as Wall Street's concerned. Get this. The federal funds futures contracts are currently pricing in a 100% chance of at least 25 basis points of cuts in this meeting. There was actually a small chance as of last night that they might hold rates steady. But since the GDP print came out this morning, actually the odds of no change at all went to zero, and the slight odds of maybe a 50 basis point cut increased. And that's only about 0.5%. So markets pretty much expecting only 25 basis points in this meeting here. Why is that significant? Well, it would be the third consecutive rate cut by the Federal Reserve, and it actually gets us to a total of 75 basis points of accommodation. That's the magic number that the Federal Reserve eased rates by in 1995 and 1996, when they similarly were trying to steer clear of a recession. So a lot of things to watch for in this particular meeting. Keep in mind there will be no dot plot projections because this is an off quarter meeting, but we will be paying attention to Chairman Powell's press conference regarding what his outlook is, as you mentioned, Adam, in the future. Will he signal the possibility of maybe another cut in December? Some might say that because the GDP print was actually a little surprising on the upside, that might take that off the table. How will Chairman Powell describe that? Another thing worth watching is how does he describe the mid-October decision from the Federal Reserve to continue organic balance sheet growth? Again, not quantitative easing, but a $60 billion a month pace of buying short-term securities. And the third thing worth watching, as is always the case, is whether or not there are any sort of dissents. If they do decide to cut rates again, it's entirely possible we see 2 more dissents, again from Boston Fed President Eric Rosengren and also Kansas City Fed President Esther George. So all those things worth watching in that meeting today. Again, at 2 p.m., we'll have the full live coverage for you here on Yahoo Finance.
Looking forward to it, Brian. Thank you. We also got some trade news this morning. Chile canceling the APEC summit, which was scheduled for November 17th. President Trump and China President Xi Jinping were expected to meet at that summit to discuss a possible phase 1 trade deal. Joining us now for this hour's panel to discuss, Yusuf Abbasi, International FC Stone Director of U.S. Institutional Equities and Global Market Strategist, and Yahoo Finance's Emily McCormick. I never know if I say that right, Yusuf.
Oh, it is INTL, but
INTL.
I get
Thank
it.
you.
The syllables, the time, I totally get it.
Thank you. All right. Now, also joining us, Orion Advisor Solutions CIO, Rusty Vanneman. Orion, I think I can say without any trouble. Rusty, it's good to see you. It looks like, in terms of the APEC meeting, that they'll just figure out somewhere else to have it. When you look at trade at this point and as to how it relates to the Fed's decision making, this has really been a big factor that they've pointed to in terms of continuing to ease. How do you think the two continue to play into each other?
I think those storylines are probably going to stay in place for a while. I mean, the trade news has been sort of impacting short-term market movement for a while, but it's really been a roller coaster ride, and I think it's really kind of pushed around a lot of the volatility as well. I think that when the Fed is using global growth as a reason, I mean, I think it's valid, but I really think, as been mentioned earlier, the Fed's just going to look at a lot of different things and take a much more balanced approach moving forward.
Okay, if they're not balanced, though, what are you looking for in the statement? Are you looking for language that could be more hawkish, or is there going to be a key phrase that signals to you where they may go in December and even next year?
Well, that's a good question. We are tending to be looking for some more hawkish language, as you said. In terms of a good phrase, you've got me on that one. I mean, we are looking for some more hawkish language coming out of the statement later on today.
It's so tough to think about all of these hawkish rate cuts, right? A hawkish cut, a hawkish cut. The question for me is, how many hawkish cuts does it take to get a dovish Fed? And even beyond that, I think that the situation in the repo market handed Powell carte blanche. He pivoted so quickly from mid-cycle adjustment to $60 billion in, I don't know what you want to call it, but it is QE. It's helping steepen the yield curve. That's helping investors think about risk differently. So I'm not sure if the Fed even really has to say that much, right? A 25 basis point cut and this commitment to buying $60 billion in assets monthly, that's dovish enough for me, and I think for a lot of Wall Street.
Rusty, you want to weigh in?
For them to get incredibly hawkish, I think it's going to take some really good numbers. I think we're seeing numbers that are better than expectations, and so I think that's going to create that more balanced approach. But I mean, until inflation and economic growth can really get a good hold, I can't imagine it's going to be that hawkish.
Rusty, when you just look at the changes that we've seen and the data coming out between the September and October meetings, what do you think has been the biggest change or trend that we're seeing that's going to continue into the December meeting that could tilt the scales one way or another for a potential fourth rate cut, or maybe a third, depending on how today goes?
I don't know if it's so much the data itself as it is the data is relative to expectations. I think that, several months ago, expectations were really negative. Just across the board, not only on Wall Street, but with individual investors. And I think the data has been good enough that those expectations are starting to thaw a little bit. I actually think, and just in terms of just market expectations going into the fourth quarter, I think because investor expectations were so negative and Wall Street expectations were so cautious as well, that we are really set up for a pretty strong fourth quarter and could end up having one of the strongest years for the S&P in over 20 years.
Rusty, good to see you. Rusty Vanneman is Orion Advisor
Thank you.
Solutions CIO. Thank you.
All right, racing to a merger. Fiat Chrysler and Peugeot maker PSA Group of France say they're in merger talks that could lead to the creation of a roughly $46 billion transatlantic auto giant that would rank as the world's fourth largest by volume. Joining us now to talk about this, Yahoo Finance's car enthusiast Pras Subramanian. And as I'm talking about this, I'm hearing the old Billy Ocean song, "Get Out of My Dreams and Into My Car." Is this a dream deal, though, or should investors be scared, very scared?
I think, this was something that, former CEO Sergio Marchionne wanted for a long time. First it was GM. He made that case, didn't happen. Then 5 months ago it was Renault. That failed too. So this is really about scale and investing in EV because, look, VW Group today warned about slowing demand, but they're going to invest $50 billion in the next 5 years in EV, and FCA needs that, and so does Peugeot.
I mean, but is this a better deal than what we saw with Renault? I mean, that of course fell through especially because of the French government and some of the conflict of interest there. But if we think about it, Renault really had that exposure through Nissan to the Asian market. They had that green technology. So is this a better deal than that one was?
There still is a French ownership component for Peugeot too, but I've been reading about how the overlap is better with Peugeot. They have operations in places like Argentina, FCA's in Brazil, more exposure to Europe. I think it might be a better fit actually with Peugeot. But apparently Johan Elkman, the scion of the Angeli family that owns Fiat, was really one of that Renault deal too, because it was such a big name in France and sort of like a big name in the auto industry.
You brought up, though, the French government, which could throw a wrench into this whole deal. They own 12% of the, I'm going to say just Peugeot.
Yeah.
Why the French government was upset because of the Nissan problems with Ghosn. That doesn't exist this time. Is there any argument that we could try to be on the outlook as to why they would stop this one?
I don't think so, not yet. The French government said that they're watching and also cautiously optimistic. If we start seeing job cuts start sort of trickling out, then you have the issue. So I think it's still kind of, all systems go. And in Europe, you have to sort of confirm when a merger, like a talk comes out, you got to confirm whether it's actually happening or not, and they did that. So it sounds like we could hear an actual official deal in the next couple of days.
And if it doesn't work out this time, I mean, who's left for Fiat Chrysler then? If they've already tried GM, they've already tried...
You go.
Yeah, I know, right? I mean, you know what I mean? Are there any other options left available to them? And if they don't do a deal, then what kind of competitive position does that put them in?
I frankly don't see who another partner could be for them because look at the brand. I mean, Dodge hasn't had a new car in years. Chrysler is dead. They have 2 cars. That's it, 2 different types of cars. Same with Fiat in the U.S. It's not a good business other than the fact they have Jeep and Ram trucks. That's all the profits come from those 2 units. So those 2 units are profitable. You could spin those off maybe. Maybe the whole organization sort of just kind of breaks off in pieces. But I don't see anyone besides Peugeot at this point. Renault maybe comes back. I'm not sure about Japanese manufacturers at this point because it just look at Renault and Nissan. So I think this has to happen.
So 2 marginalized car companies, I think we've all kind of agreed to that, are going to merge, and all of a sudden there's going to be some revolution that's going to happen. I mean, I think you asked the perfect question. It's going to be tough sledding whether they remain apart or come together. I mean,
this storyline played out in the 1950s. This is how American Motors was created. It was Hudson Nash when they came together, and we know how that ended.
All right, Ross, thank you. Appreciate it. On that historical note, we'll leave it there. Let's take a look at what's going on in the markets here. Inez Ferrer on the floor of the New York Stock Exchange. Inez.
Yeah, Julia, it's a wait and see for that Fed decision. Traders here are expecting a rate cut of 25 basis points, but it's really the commentary that they will be looking at, the outlook. So right now we're looking at the NASDAQ that's down about 0.1%. The S&P is down slightly. The Dow is relatively flat right now. And just taking a look at one of the Dow components, the best Dow component today being Johnson & Johnson, up more than 2% after the company said that it conducted some 15 tests on that same bottle of baby powder, which the FDA had tested, and found no trace of asbestos. Now, you'll recall that Johnson & Johnson earlier this month pulled a single lot of baby powder from the market after the FDA had tested a single bottle. Also, they said that they conducted some 48 tests on that lot and that they found no asbestos in it. Also, we're watching AT&T. This is after the company unveiled the price for HBO Max, which will be launching next year, pricing it at $14.99 a month. That is the current price for HBO subscribers. Some analysts had speculated that they would need to charge more. Nevertheless, $14.99 a month being the price that they came out with. And AT&T stock not moving too much right now, but take a look at what's moving. Netflix. Netflix is the best NASDAQ component right now. Netflix up more than 3%. Julie, Adam.
All right, Inez, thank you very much. Before we start talking about Apple, I just want to let you know that we're getting out of the White House headlines that the China deal timeframe is unchanged despite the cancellation of APEC in Chile. And again, this is from the White House, quote, "We look forward to finalizing phase one of the historic trade deal with China within the same time frame. And when we have an announcement, we'll let you know." All right. All eyes on Apple as the company reports fiscal fourth quarter earnings after the bell today. Investors are eager to see how the iPhone 11 sales have performed so far. Shares are down slightly right now. Joining us from Sunnyvale, California is Bob O'Donnell, Technology Research President and Chief Technalysis Research President. I'm having a tough time with this today. Welcome to On the Move. Let me just jump to the chase. There's a lot to look at Apple. It's not just the iPhone. It's going to be the services. It's going to be all kinds of things. What are you paying attention to?
Well, obviously, you still do have to start with the iPhone. It's still more than half of their business. And, early signs are that the iPhone 11 has done reasonably well. They do have a few days of iPhone 11 sales in this last quarter. The bigger question is, how much did the previous year's sales decline before the iPhone 11 kicked in? So that'll be the big question mark, of course. And as we know, Apple gave up giving out unit shipment numbers, so we have to do revenue numbers, and there has been some pricing adjustments. So it's always a lot harder to figure all of it out. But you got to start there, because from there, then you can look at the other things, the wearable side of things, which I think is also going to be strong, actually. I think we'll see good Apple Watch and AirPod numbers. Obviously, the new AirPods are coming out. There's a lot of excitement around that. And then the services business, it's still, frankly, early days. The TV stuff doesn't launch until the end of the week, and we're going to see. And the gaming services are just getting started. So that stuff is going to kick in. It's going to be very dependent upon how well those device sales continue to be.
So the company has said over the past couple of years, look at services, look at services, look at services. Even without that streaming service having kicked in, is this the quarter that finally services is really going to be what the street is paying attention to and is going to be significant enough?
Well, look, it's been significant enough, I would argue, in the last several quarters. And I think it'll incrementally grow. And obviously, they do have existing services. To be clear, it's just a lot of the attention these days, of course, is on the video stuff, which is not going to kick in for a while. And, the other big thing is it's not just going to be the numbers. Really, the bigger question is, what's the forecast going to be? Particularly around services, because that's going to give us a hint as to what they think the adoption of these new services is going to be in the current calendar quarter. So I think a lot of the focus around Apple is in fact going to be around that forecast and what they have to say, and what that says as well, perhaps about iPhone 11 adoption and some of the other new devices.
Isn't the plan to get all of us, though, to spend $20 a month to sign up for Apple News, Apple Music, Apple TV? That's the ultimate goal. How long does it take them to get there? And do you think that's realistic in a world of over-the-top streaming with so much competition?
Well, so it's a great question. Of course, that is ideally the goal. I think it's going to take a long time. And look, there are some very important things that you got to remember. Apple TV is not even going to be available on either Android devices or Windows. Well, guess what? Most people who have an Apple device have another device. And the idea that I'm going to be limited to watching a particular set of content on one device and not the other is a big problem that we haven't really discussed a lot. That's going to hit. So I think that's going to be a factor. You've seen them move Apple Music from iOS and macOS onto Android. Eventually, of course, I'm sure they're going to do that with the TV service as well. But those things are going to be a challenge, and I think it's going to delay them for a while. And the other thing is, look, yes, $4.99 a month is cheap for the TV service, but let's not forget it's 9 shows, right? So if I do the math of the number of shows per dollar, it actually looks expensive compared to some of the other solutions, the other offerings. And the Disney one in particular, I think, is going to be a challenge. And then we just heard about the HBO Max service. So it's going to be a very competitive environment. So to your point, I think it's going to take a while for this to all kick in. But obviously, initially, they're going to give it away for free and let people try it, and we'll see what
Right.
happens.
All right, let's turn to Facebook, not a content company, as it has said repeatedly. I don't know if we believe him, but in any case, what should we expect from that company? I mean, obviously, there's been a lot of noise around Facebook. We have yet to see it hit the company's traffic or bottom line.
Well, exactly. And I'll be honest with you, I'm not convinced that it's going to happen this quarter. I mean, you look at it and rationally you say, of course it's going to impact this, and yet they continue to outperform. You know, to me, the bigger question, honestly, with Facebook and the way I think ultimately the market's going to react is frankly not about the numbers. The bigger question is going to be psychologically, how do they feel about all the potential concerns around regulation and breakup and the challenges they're facing with things like Libra and everything else. All of those factors, I think, ultimately become way more important, frankly, than another set of numbers for them, because those are the longer term issues that I think have much more impact on the overall perceived value and pricing of the company.
Bob O'Donnell, Technalysis Research President and Chief Analyst, and I said it correctly this time. Thank you very much for being
yes,
here on
you
The
did.
Move.
Thank you.
Coming up, hailing earnings. Our next guest expects another strong quarter for Lyft, but warns riders should buckle up for price hikes. Let's take a look at some of today's trending tickers on Yahoo Finance as well. General Electric, that company coming out with a positive cash flow from industrial operations forecast that's setting the shares up. And before we go to break, take a look at this video from just moments ago. Firefighters attempting to rescue a group of horses in Simi Valley, California, as wildfires surround the area. A mandatory evacuation has been ordered for the region, which is also home to the Reagan Library.
Lyft is going to report third quarter earnings after the bell today. Our next guest is bullish on the stock, predicting that the ride-sharing giant will outperform Wall Street expectations. D.A. Davidson senior research analyst Tom White joins us now. He has a buy rating on Lyft with a price target of $74. Very simply, why are you so bullish?
Well, Lyft, look, it's a solid second place player in U.S. ride sharing, and importantly, it's the share gainer in the space. And so when we look at Lyft relative to Uber, we look at Lyft's higher growth rate, We look at a business model that, on its face, should be very profitable, we think, ultimately, and one that's pulled back quite a bit. Also, we think visibility in terms of financial expectations, the management team's ability to forecast the business out with some relative sense of accuracy is better as well, because Lyft is fighting fewer battles and fewer products across fewer geographies, and all of that translates into us preferring Lyft over Uber at the moment.
That's right. Lyft said it would be EBITDA positive by the end of 2021, I believe. You talk about price increases as a part of this thesis. What is the pricing sensitivity of your average rideshare rider, right? I mean, what's the ceiling for this? Because you would think at some point people will throw their hands up and say, I'm just going to take the subway, or in other areas, in many cases, maybe a cab is going to start to look like a more attractive option, right?
Yeah, look, I think we're going to find out soon, and I think what's happening with Lyft and Uber is that they are constantly testing and iterating exactly what that sensitivity is to price, not just on a per market basis, but really on a per route basis, and in some cases on a per user basis. So, somebody where the pickup is, say, a midtown office building in Manhattan that's known to have a lot of, private equity firms, and the destination is the airport, that route and that user might be less sensitive to a significant price hike than.
So wait, are you saying prices are different for different people?
Well, I think those are the types of things that they're testing. We know that they're different for different routes and different times of day. There's an algorithm that's constantly optimizing this sort of and solving for either market share or
they break down the kind of ride you are. You can be a business user or a
right. I just didn't realize they charge you different prices based on that.
Right, and it's always more expensive too. If you change your card from the business account to the personal account, it actually goes down. I've found when you hail a ride from personal account. But how essential is taking market share from Uber to the long-term strategy for Lyft? I mean, is this really a winner-take-all kind of situation, or how much market share do they actually have to capture?
Yeah, so look, we don't think it's going to be a winner-take-all type market. It will probably be a winner-take-most. But if ride sharing expands broadly, and price is going to be a big factor in whether this really kind of starts to disrupt things like personal car ownership. But even if prices increase a little bit, there's probably a significant opportunity, we think, for just usage of ride sharing to expand generally, and that'll probably be a big enough market for both companies.
Let me raise a red flag here with you, though. Can we pull up? I think we have the full screen from SimilarWeb. They have data analytics. They sell this to investors. Lyft driver daily active users. Since fourth quarter 2018, the driver population in the United States downloaded on Android devices has declined quite strongly for Lyft, which means when you speak to the folks at SimilarWeb, I have to wait longer to get a car. And if I have to wait longer to get a Lyft car, I cancel. What threat is that to their revenue?
Yeah, well, I think it would be interesting to see what the Uber line looks like as well. We know that in big municipalities like New York, legislators are putting caps on the number of drivers that can service a particular area or how long they can drive around. And those sorts of things are constraining supply. That's probably going to be one of the things that contributes to price increases over time as well. But certainly an area to watch, but we think that the sort of secular trend of people using these services, the disruption of the taxi limousine service, the expansion into new demographics, different age groups, all, provide a lot of tailwinds to these two businesses.
Should there be any concern on the promotional aspects that have come out over the past year?
So all signs seem to suggest that promotional activity is on the decline. Now, every time I say that, investors or media people or whomever, can point to anecdotally a lot of emails that they've gotten in their inbox about promotions and couponing. But I think overall, both companies are signaling that sort of intensity of promotional activity is declining. I think that's one of the big reasons why Lyft was able to basically put this stake in the ground and say, look, we're confident enough to say that by the fourth quarter of 2020, we're going to be EBITDA positive. So, it's sort of a very tenuous détente in a way, right? Like Lyft is, at any one point, if Uber decides that they want to lean back into gaining market share in the U.S., you could see this cycle kind of tick up again.
Right now, a little quieter promoting. All right, Tom White of D.A. Davidson. Good to see you. Thanks for coming in. Now to a question facing most Americans. It's how to save enough to get through your golden years. Funding Our Future is a group we feature each week only on Yahoo Finance that advocates for a secure retirement for all Americans. BlackRock is a partner with that organization. And here with us now is Ann Ackerley. She's the head of BlackRock's U.S. and Canada Defined Contribution Group. Actually, I think you're the head of the retirement business overall, right?
Yes, I am.
Yes, that's your new title. Ann, it's good to see you. Thanks for coming in.
Thanks for having me.
So when you are looking at this challenge, right, for people to fund their future, to prepare for retirement, what do you think is the biggest challenge for individuals when they're facing this huge cliff? I guess is too scary a word to use, when they're facing retirement.
I mean, that's, part of it, right? It's so far out there. And yet what you really need to be doing, particularly right as you come into the workforce, is save. And the sooner you can start save, the sooner you can take advantage of compounding. In the United States, one of the things that's happened over the last, 20, 30 years is we used to give people pension plans. And now we've moved to defined contribution. And we've said, here, you're kind of in charge of your own retirement. Go figure it out. And so that's what we need to be helping people with.
And we've talked about this before. And I think right before 2000, there was still about 58% of the population had a traditional pension. Today, it's like 9%.
Yeah.
So going forward, we've got a 401k. We're fortunate here. But we could lose all of that. I mean, it's risk. We have to figure out the investment strategy. But one of the things you're talking about is doing things cheaper, simpler, and guaranteed. Almost like creating your own pension. And the word that scares everybody is annuities. But
Yes.
that's what's coming down the pike. That one day I might have through my Fidelity or my Vanguard or my BlackRock, whatever the offering is, I could start funding an annuity type self-pension.
Sure.
When are we going to get that?
So up until now, really what's happened is you have a 401k, which is great. But basically when you retire, you have this lump sum and we sort of say, hey, go figure it out. Figure out how you can give yourself, in effect, a paycheck for life. You don't know how long you're going to live. You don't know what your expenses are going to be. And, William Sharpe, the Nobel laureate, has said that that is the nastiest, toughest problem in finance. And yet we have annuities. And in fact, though, they're not really used that much in 401ks. So what we'd like to do at BlackRock is take a three-pronged approach to it. We'd like to give you an investment that can help you save. We'd like to embed an annuity, give you some guaranteed income. And we want to wrap it with some technology to really help get you to start thinking about how do you take that nest egg and convert it into income.
Are we talking about the kind of thing, though, where if I'm doing a paycheck by paycheck contribution to my 401k investment options, that I could also split some of that into the guaranteed annuity? I'm going to call it the annuity option.
We're going to do it all for you. So you've heard of target dates, they're age-based asset allocated funds. We're going to put the annuity into that in part. And so, in fact, you make one investment and you'll get some liquid assets and the annuity, doing it all for you. You started off with, we need to make this simple, easy, and cheap for people. It's already complicated enough.
Are there any kind of rules of thumb that you typically, advise for clients and people trying to save? I'm sure, everyone has a different situation, different income levels, different spending habits, but are there certain percentages that you usually advise allocating?
Well, as you say, everybody's got a different circumstance, and if I put a number out there, probably most people are not at that number. In today's environment, a young person probably should be saving about 15% of their paycheck combined with their employer contributions. If returns start to go down, that number is going to go up. But my advice is don't let that big number put you off. Save, 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 start small, and get the impact of compounding.
Right, Ann, thanks for coming in. We hope to see you back here soon when we have more to talk about with retirement, which we always do. Ann Ackerley
Thank you
of
very much.
BlackRock. Appreciate it.
Coming up, Warner Media unveils its answer to Netflix and Disney+. But will the price point prove to be too high for consumers? Plus, take a look at some of today's winners on Wall Street. It's 12:33 on Tim's birthday. Tim's our floor director, by the way. 3 hours into the trading day, and stocks are a little mixed. We're waiting for the Fed decision. Look, Dow's up, but the other two, they are barely in negative territory. Take a look at what's happening with gold right now. Gold is trading higher, $1,496 an ounce, still not above $1,500. Taking on Amazon, the COO of Shopify joins us to discuss the company's latest quarter and the significance of surpassing 1 million merchants. College kids cash in. The NCAA shocks the sporting world by voting to allow athletes to profit from their name and likeness. And generational divide. Generation Z takes on older Americans with a new rally cry. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for staying with us. Well, a major milestone. The Canadian e-commerce company Shopify surpassed 1 million merchants worldwide, but it's costing them to get there. In the third quarter, earnings actually posted a loss. Chief Operating Officer Harley Finkelstein joins us now. Harley, thank you for being here. So, obviously, 1 million merchants is a big deal. Basically, you guys provide kind of the back office for many, many different, now 1 million different merchants worldwide. But indeed, you did post a loss. Where is that spending going? Where are you deploying it?
So Shopify really started as an e-commerce platform over a decade ago. We wanted to provide small business with the same tools that traditionally only the biggest companies were getting to build beautiful online stores. And over the course of the last decade or so, the business has evolved. We now help merchants sell offline as well. We have a capital product where we help provide cash advances to small businesses, payments product. We have a fulfillment network that we're setting up right now. And so more and more, we're trying to create the world's first retail operating system. And it's now being used by about 1 million merchants. And they've sold about $130 billion on Shopify. What we're trying to do, though, from a business perspective, and just to be clear, we just announced Q3 earnings yesterday. Revenue was up 45% to about $390 million. GMV, which is the sales by those merchants, was about $15 billion, which is up at 48%. We really feel like right now is the time for us to double down. And anyone in the world that wants to sell a product online or offline, we want them to do that with Shopify.
But for our understanding, I might go to an Amazon to buy, but it might be the product or the merchant I'm dealing with is actually the ecosystem and the environment is all Shopify when I'm buying that product. Why the loss? Yeah. Because I don't know if I understood this appropriately, but there was a one-time tax charge from a capital gain?
So actually, the tax charge obviously played a role there, but generally we believe right now there's an opportunity for us to become the entrepreneurship company around the world. You mentioned Amazon. What Amazon does when you sell your product, when you are a brand or a merchant or an entrepreneur, Amazon rents you customers. And at any point, they can decide they don't want to rent you those customers anymore, or they're going to tax you for the use of those customers. What we're seeing generally across retail is that retailers and consumers want to buy direct from the actual maker, from the brand. So if you look at stores on Shopify that grew up from day one, companies like Kylie Jenner, or Allbirds, or Bombas, these are companies that started their mom's kitchen table that grew entirely on Shopify. And they don't want to share their profit margin. They don't want to rent customers. They want to go direct to the actual end consumer. On the profitability side, we were profitable initially. We were a bootstrap company. Well before our IPO. We will eventually get back there. But right now, we feel the time is to invest in growth, which is why we're spending $1 billion to democratize fulfillment so anyone can fulfill the way Amazon does. We're spending a lot of money to help acquire new businesses to increase our capacity. But we're also spending money so we can entice more people to think about entrepreneurship around the world.
And when you look at those million merchants, how many of those are new versus existing users? And how do you prevent people from, these small and mid-sized businesses, once they scale to a certain size, moving to something like an Amazon and graduating to that platform?
It's a great question. Actually, we're not seeing that at all. What tends to happen is whether it's some of the more celebrity-type businesses like Kylie or Kanye West who start on Shopify and then end up doing hundreds of millions of dollars a year, they don't actually graduate off of Shopify. Shopify's product unveils itself over time. So as you grow, let's say you need cross-border tax compliance. You won't need that on day one. You may need that only when you hit a certain growth level. So the product of Shopify scales really well. But your other point, which is that some of these businesses are existing. On the earnings call yesterday, I mentioned Fry Boots of London and Gatorade and the BBC all now using Shopify as well. Procter & Gamble is doing way more of their brands on a direct-to-consumer model using Shopify too. But the vast majority of those 1 million merchants are brand new entrepreneurs. So what that means is we're not just growing our piece of the pie when it comes to small business, we're growing the pie itself. And that's why I think we're the leader globally in entrepreneurship.
You mentioned that your revenue growth was 45%, which it sounds impressive, although it was a bit of a slowdown in terms of the pace of growth for Shopify. What's the long-term right-sized revenue growth for you guys? It sounds like you have more flexibility on the profitability side as you invest and, kind of put your foot on the brake and take it off. What about on the revenue side?
So just to be clear, we actually are the fastest growing company to ever hit the $1 billion revenue mark in the history of SaaS. So in terms of growth perspective, we are growing faster than any other company that is operating at that revenue levels. I don't know where we're going to end up ultimately. What I do believe is that we have historically been an e-commerce company focused on core markets in North America. We are now a global retail company. Just an example, we've given out more than $700 million in cash advances. Our payments company, Shopify Payments, is one of the fastest growing payments companies. We have this shipping business as well. We have all these other areas of commerce we think we can actually help these entrepreneurs with, and we're now expanding internationally. For the first time ever a year ago, we translated Shopify into more than 19 languages. So now, whether you're in a place like Germany or France or Japan or Singapore or India, you can also use Shopify as well. So in terms of where the growth will come from, it'll be more services and helping more of these entrepreneurs in more places.
All right, Harley, thank you for being here. Harley Finkelstein of Shopify, the Chief Operating Officer. Appreciate it.
Coming up, lacing up for a payday, the NCAA shocks the college sports world by voting to allow athletes to profit from their names and likeness. Plus, take a look at some of today's most actively traded stocks by volume. And before we go to break, want you to take a look at the video just moments ago. Firefighters are now attempting to rescue a group of goats in Simi Valley, California. There are wildfires which are burning through the area. A mandatory evacuation has been ordered for the region. And of course, they're trying to prevent that fire from spreading to the Reagan Library. Take a look at the top trending stories on Yahoo Finance right now. A Michigan produce supplier is recalling half a dozen apple varieties distributed by retailers in 8 states. That includes Florida, Illinois, and Kentucky, over the concern that they may be contaminated with listeria. This is according to a statement from the U.S. Food and Drug Administration. The apples were shipped between October 16th and October 21st. Southern California Edison had started shutting off power to tens of thousands of customers and warned up to 304,000 customers could be without electricity. This, as the most powerful Santa Ana wind event of the season has descended on the area. Forecasters predict potential gusts of up to 80 miles per hour. And just in time for Halloween, Chipotle is celebrating the spooky holiday by giving customers in costume gear a $4 burrito bowl, taco, or salad. The deal starts tomorrow at 3 p.m. until close nationwide. How about some free guacamole?
It used to be you dressed as a burrito, you got a free burrito. A couple of years ago. Oh yeah, I remember. I recall people in tinfoil, wrapped, walking into Chipotle for their free burrito. So this is actually.
I'm glad that doesn't have to happen anymore. Let's talk about the massive change that's on the way in the world of college sports. The NCAA has cleared the path for athletes to profit from their names, images, and likenesses. This is an about-face for the organization, which has historically been steadfast in prohibiting college athletes from being paid in order to preserve its amateurism rules. With us now is Greg McElroy. He's ESPN college football analyst as well as Yahoo Finance's Dan Roberts. And of course, he's also, Greg, a former football player at both the college and professional level. So just first of all, tell us your reaction to this decision.
Well, it was a matter of time. Thanks for having me. There's been such a public outcry, just knowing how the game has changed and shifted from being a very amateur-based model to a very professional-based model. And with all the salaries of the coaches and the amount of money the NCAA was bringing in annually in regards to their basketball tournament and other things, you felt like it was only a matter of time. So I think this was a necessary step. Now, cleaning up the details in which how it's going to be enforced is something that we're going to have to figure out. And I think the NCAA, frankly, even though they voted unanimously to accept some modernization to their current format, you still think that there's a lot they need to figure out before this really goes fully into place in January of 2021.
Greg, Dan Roberts here. Thanks for coming on. We had your colleague Jay Williams at our live summit a couple weeks ago, and he was talking about the California change. At that time, that was all that had happened, SB 206. And he said, gosh, my jersey from Duke sells a lot, or the jersey that has my number. And I've often wondered, well, am I owed a cut of that? If you look back at your playing time when you were a quarterback in college, what would this have meant for you? Can you imagine that you would have been signing deals with sponsors? Or are we going to see some players, even when it's allowed, maybe steer away from that because of the different ethical issues with that?
Well, I think that it just depends on the situation. Frankly, I came from an affluent home. I came from an affluent family, and I would gladly have sacrificed what additional revenues I could have in order to give it to my teammates that might be a little less fortunate. So I would have opted out if given the opportunity, knowing that some of my teammates were in a much more difficult financial situation than me. That being said, I never felt taken advantage of. I never felt as though they were using my jersey to create significant revenues that wouldn't eventually be going back to the student athlete, maybe in a different sport. So this is a unique circumstance because it doesn't really involve the schools. This is more about name, image, and likeness. And I think, frankly, guys, it's not going to be a great deal of money that's going to be exchanging hands. Maybe for the select few, the Zion Williamsons, who was an incredible basketball player at Duke last year, now has signed an 8-figure shoe deal with the Jordan brand. The Trevor Lawrences of the world, who is an awesome sophomore quarterback for Clemson, and maybe Alabama's quarterback Tua Tagovailoa. There'd be a handful of guys nationally that could create up to 6 figures of additional wealth for themselves. But I think those opportunities would be few and far between. It'd be more mom and pop type of opportunities, small town, maybe representation, autographs, things of that nature that could accumulate a couple $100. But I wouldn't expect, generational wealth to be exchanging hands amongst companies and student athletes.
Well, we wait to see, because even though nickels add up to dollars. But I wanted to ask you about this.
Sure.
I think Senator Burr is threatening, because even the $100 would be taxed as income. But he's threatening, if you benefit in any way from one of these deals, whether it's 100 or $1 million, taxing the scholarship if you happen to get a scholarship as if it were income. What do you think of this? What would you say to the senator?
Well, I'm very concerned about that aspect of it, knowing that each university, or several universities, especially at the Power 5 level, the most profitable universities that you'll find playing collegiate sports, they're spending upwards of $100,000 a year per student athlete to make sure that that person can perform at their peak, regardless of sport. So I think it would become very interesting in regards to the tax side of things. And I understand where Richard Burr is coming from, but I think that would be something that would be fought tooth and nail in the court of law, especially when it comes to all the aspects that come along that you can't really put a price tag with. I mean, the amount of clothes that you get, the marketing opportunities that you get just by playing for said university. I mean, those are worth a fortune. The tutors that are free, the meals that are free. Yeah, you can put a certain amount of money on it, but it'd be difficult to kind of figure out exactly how much would be owed in regards to tax liability. So I think that is a very deep rabbit hole that everyone would still try to figure out. But if you start talking about taxing scholarship, that's not something I would ever be on board with. But I do think there would be opportunities for tax liability in regards to the marketing dollars that you might be able to create based on your name, image, and likeness.
Greg, just quickly, we know that NCAA President Mark Emmert has resisted change like this for a long time because the NCAA sees it as questioning its own role of amateurism. If you just look at the last decade and how, look at the basketball scandal and the FBI investigation with Louisville and other schools and sponsors, what do you even make today of that idea of amateurism? Where do we stand in regards to whether that's still an apt tenet for the NCAA to cling to?
Amateurism is a farce at this point. I mean, as much as I like to say that we protect the integrity of the game and all these things, the NCAA is essentially a medium put in place to make sure that everyone's trying to compete under the same rules and spectrums and trying to level the playing field for just about everybody. But college sports is no longer amateur. We're talking about billions of dollars exchanging hands. And like I said, as a former college athlete that played in the last 10 years, I never felt taken advantage of. I never felt as though I was kind of getting the short end, so to speak, while people on the back end were getting all this unbelievable cash because I saw what was going on around me and how they were making me a better player. So really the money that was being created by the school was actually going back into the student athletes. So I never felt taken advantage of, but I do think anyone that suggests that we are an amateur sport and that it's only for amateurs, no, there's a lot of profiting that's going on. And I think it's time that people have started to recognize that players, there is a place for us to find some revenue opportunities. But like I've said earlier, I don't anticipate those revenue opportunities being life-changing by any stretch of the imagination. But if it can make someone a little more comfortable, then I'm fully in support.
Greg McElroy, ESPN college football analyst and alum of Alabama. Thank you for joining us. I appreciate it.
Thank you, guys.
As we go to break, Yahoo Finance's editor-in-chief, Andy Serwer, got a chance to speak with professional baseball player and Hall of Famer Mike Piazza. Take a look.
So let's talk a little bit about baseball and business, because you know a lot about both. Yeah. And obviously people talk about the relationship between baseball and business. In your mind, how are they similar? How are they different?
Well, I mean, I think the expression or the cliche was like baseball is a metaphor for life. And obviously, as you said, that can translate also into business. I think the importance of teamwork, the importance of different parts and different people getting together to have a common goal, a common agenda, and that is obviously in baseball is to win. In business, obviously, is to build a successful business, to build profits, to increase efficiency, to deliver your product to your customers efficiently. And what I found is that to really have a successful team, you have to have everyone knowing their role. You have to everyone have a support and support each other. And you can't have, we talked about Tommy a little earlier. I mean, Tommy Lasorda always has this expression saying that if a team is working against itself, he said it's like tug of war. He said if you have one half of the team on one side of the rope and one half on the other side of the rope, you're going to pull against each other all day and achieve nothing.
Did you
but
ever
if you
see
get
that
everyone
in
on the
that
same,
thing?
well, if you get everyone on the same side of the rope, he goes, we'll pull all the other teams with us.
Right.
So these cliches and these expressions make a lot of sense in the business world as well.
BuzzFeed around, 3 stories, 1 minute each. We start with Warner Media's new streaming service, HBO Max, which will be the home for shows like Game of Thrones and Friends. It's going to cost you $15 a month. $15! What do you think, Graham? What do you think?
There are a lot of brands, obviously, underlying, but I'm still more intrigued by the Disney Plus, right? You've got this brand there that is global. At that price point, it's considerably cheaper, right? It's 2x is what HBO Max is. So I don't know. I'm not that excited about HBO Max. More excited about Disney Plus.
Well, at the same time, if you look at that $15 price point, it almost feels like not enough for what they're going to be spending on it. I mean, they're saying $4 billion by 2025 is going to be the spend on HBO Max. So huge investment. Look at Netflix, still cash flow negative. So these streaming services, I mean, it's huge business right now, but costing all these companies huge amounts of money.
I mean, what do I have now? I have Netflix, I still have cable, which includes HBO, and I have Amazon Prime, and I don't have time to watch all this stuff. So I don't know when the whole fatigue of watching is going to hit everybody. After hearing of coaches, scientists, and former football players, New York lawmakers have decided to propose a bill that would ban children under the age of 13 from playing football, tackle football specifically. They say it's because, of course, the research on trauma, concussions, blows to the head. But does this need to be legislated?
I mean, it's a good question. I don't think parents like being told necessarily, what their children can and can't do, and I think that's more of the crux of the issue. But the science is pretty clear at this point that early tackle football, that can really cause degenerative brain damage down the line. So it's something to consider.
Tough to do anything else, right? You'd love to say, okay, when they turn 13, go teach them how to tackle and teach them how to tackle properly. But that's not going to happen in the entire country or an entire state. So you can understand why something like this becomes relevant all of a sudden.
I think you're saying let the parents decide. It's kind of where I would fall on this one.
I mean, if you have a public health issue, I think there is a responsibility on the part of government to do something about it, just like we regulate cigarettes or anything else, right, for kids who are younger. I don't know. I think if I'm with Emily, actually. If the science is that clear, there's not much choice.
Buzz. All right, Boomer. Okay, Boomer is the new phrase used by millennials and Gen Zers who have had enough. This new saying is used as an answer for older generations who just simply don't get it when it comes to the issues young people face and what matters to them. Driving this saying to display on T-shirts and hoodies around the country. Fortunately, Gen X were left out of this one.
No, apparently, OK Boomer is sort of an all-encompassing everyone who is over 30 , basically.
Yeah, snowflakes grow up.
Exactly. No.
Yeah, and that's what they say in the TikTok videos.
Exactly. So it's just kind of the retort between generations.
Let's just take it and own it. I'll take the OK Boomer. Everybody get that hoodie. Clearly OK Boomer on several things that we need to make decisions on, from Brexit to U.S.-China trade. So I understand the frustration sometimes.
I do, but of course now we'll all start saying OK Boomer, and then it won't be cool for the people to say.
Well, that would ruin it, wouldn't it?
There you go.
Yes,
or
it would.
You want your inheritance when we kick off? Play nice. That's another way to do it, right? Money talks.
I don't know. Emily is as the sole person under 30 on this panel.
Okay,
we'll have to continue the discussion, even though we got Buzz. Let's take a last look at the markets here. Ahead of the Fed decision and widely anticipated cut this afternoon, stocks are a little change.
And we're going to bring all of it to you at 2 o'clock, the decision, the Powell press conference. But right now, you should know that Wi-Fi PM is going to take you through the next hour of trading.
It is 1 p.m. in New York City, and the major indices are quiet as investors brace for decision time at the Federal Reserve, with the key interest rate decision due out in just an hour's time. On tap for today, the Fed largely expected to cut rates for a third consecutive time, but will it signal more from there? We'll chat with a key economist to dig through what to expect when Fed Chair Powell steps to the podium. Plus, the rising costs of the progressive Democratic agenda, from Medicare for All to a potentially stiffer stance on trade than even President Trump's. We'll have why both could spell problems for an already shaky economy. And the NCAA opening the door to college athletes getting paid for their likeness and endorsements, prompting some to hope for the return of NCAA video games. The co-founder of the Major League of Gaming will join us for more on how it could change the thinking behind that decision. All that and more. This is Wi-Fi PM. Good afternoon. Happy Wednesday. I'm Zach Guzman, and joining me on Wi-Fi PM today is Yahoo Finance's Sabeel Marcellus, along with Bullpen Capital founder and general partner Duncan Davidson, back with us in studio. Duncan, good to see you again.
Good to see you, Zach.
It's been a bit of time. Sabeel, good to see you as well. Like I said, it's a little quiet, the market action we're seeing right now, guys. The Dow up just 16 points, the S&P off by about 3, and you can see there in the NASDAQ, the biggest mover on the day, off just 0.17%. We'll see where things go. But first, of course, all eyes today are on the Fed. We're awaiting the central bank's interest rate decision at 2 p.m. Eastern Time. Fed Chair Jay Powell will also hold a press conference as usual at 2:30 following that interest rate decision. This comes as GDP grew at a 1.9% annual rate for the third quarter. Economists had originally estimated growth of 1.6%. Joining us now for more on this is First Franklin Chief Market Strategist Brett Ewing. And Brett, I mean, when we look at these numbers, it's interesting because it's very much the same storyline we've been talking about for a while, right? The U.S. consumer holding up. But interesting to see business investments also dipping yet again. So what do you make of the latest read?
Yeah, the business investment was certainly soft. This is the second quarter in a row, and it's only the second time that this has occurred in this entire expansion. The last time this occurred was back in 2015, the third and fourth quarter. So I think the uncertainty regarding revolving around the trade war is certainly has frozen that part of the economy up.
I just want to read the numbers here. I mean, we saw weakness. Business investment led by structures and equipment both dropped the most in 3 years. Structures contracting 15.3% after an 11% drop in Q2. So, I mean, when we're looking at that, I mean, how much of that is directly tied to just trade uncertainties and what we're seeing here as we continue to await a phase one deal between the U.S. and China?
Well, I think quite a bit of it is. In fact, I think business leaders around the country, you know, there's a lot of CapEx projects that have been put on the sidelines because they just don't understand how this is going to play out. And before any CEO is going to release the OKs for any $50 million project to go online or new facility or infrastructure, I think they're going to probably take a pause until they get a better feel for what's happening out there.
So we know that consumers are the lifeblood of the economy, but they need a little bit of help. So if we continue to see businesses reduce their investments, what can we expect for the fourth quarter? An even slower economy growth?
Well, for the fourth quarter, you know, it depends. I mean, I think if you get some positive movement on the phase one, I think you could see that maybe slightly stabilize, if not, maybe pick up. But I do think right now we are expecting what really matters is the consumer. And the employment numbers are very strong. There are 7.2 million job openings right now and about 6 million people looking for jobs. And it's the 18th consecutive month where job openings have exceeded hires. And so what I'm looking at are the internals of the job market, the quits, the discharges, and the layoffs. And those are still, the total of the quits and layoffs are still underneath the hires, which is a very positive signal for the labor market.
Yeah, we also got a new update today, too. The October ADP report also out. Private sector adding 125,000 jobs last month, beating that the median estimate in a Bloomberg survey of economists of 110,000. So, I mean, when we're looking at that, that would seem to boost the confidence that the the job economy, everything out there when it relates to the unemployment rate, still continuing to be, again, one of the strongest positives out there when you try and assess what's going on here.
Look, we view the labor market and the employment situation as the last leg of the economic stool. And as long as that stays intact, we don't believe that you would see a recession here in the United States. Even though there are slowdowns in other areas of the economy, as long as we have wage growth and people are employed, we're a consumption-based nation and economy, and we feel the economy can continue to muddle through the headwinds of the trade war.
Yeah, I have a question, actually a comment and a question. I'm from Silicon Valley. Nobody in the venture industry is behaving as if a recession is about to happen. They usually surprise and you find out later. I'm just wondering, what should we be watching for before we should worry about a coming recession?
Well, I think there's a lot of indicators right now that we are watching for, and we've seen they are alluding to some slowdown in the economy. I think that you can have cooling off periods in an economy. If you look on a historic basis, we like to call this phase of the economic expansion, we're in a vulnerability phase for a recession, and it could come if there was some exogenous shock that suddenly made consumers freeze up right here. But we think right now where the consumers are, we don't see a recession in the next 6 months. Again, as long as the consumers are holding up right here.
All right, Brett Ewing breaking it all down. Appreciate you taking the time for right now. We'll continue with that thinking. And a reminder to stay tuned to Yahoo Finance's The Ticker for live coverage of the FOMC decision in just under an hour's time. Now about 55 minutes away from that specifically. All right, well, as the 2020 race heats up, a new note from Barclays breaking down how Senator Elizabeth Warren's trade proposals could significantly shift U.S. policy. And Sabeel, I know you've been looking into that because it would seem to be a break, even from what we've seen from the pressure applied by President Trump.
Yeah, so it actually would be worse in terms of the U.S.'s trade policy under Elizabeth Warren's administration because of her plans. They would actually be more strict. So we've seen in the last debates, Democrats have been asked, what would you do to address the unfair trade practices with China? Would you remove tariffs on day one if you were to become president? And none of the Democrats were really willing to say that. They're pretty much like, we're going to keep tariffs in place as we try to figure out the strategy. And Elizabeth Warren, she's been pretty mum too about basically not talking too much about removing tariffs because her trade policy would be even more extreme. She actually has a list of requirements, an eligibility test that foreign nations would have to abide by in order to be able to trade with the U.S. And that includes human rights and labor rights, also anti-trafficking, anti-bribery, anti-corruption, and also she wants these nations to also fight tax evasion. So she would put all these eligibility requirements on these foreign nations in order to be able to trade with the U.S. And if they're already trading with the U.S., she actually wants to revise that to make sure that they're abiding by that. So Barclays took a look at that and said, you know what, if she were to actually keep this standard, if she becomes president, then it would alienate foreign nations because that hasn't been U.S. policy to have all these requirements in order to be able to do trade. And also when it comes to climate change, she wants foreign countries that are trading with the U.S. to also be a part of the Paris Climate Agreement and also refuse to subsidize all domestic fossil fuels.
It's a long list.
Exactly. So when it comes to China, if you think it's hard now to get a trade deal with President Trump, it would be, forget about it with Elizabeth Warren. It would be even tougher.
You nailed her, I must say. I was going to say, in Silicon Valley, there's money going into Mayor Pete. Mayor Pete is now running to the center. You might have seen stories on that. Yeah. He's beginning to surge a bit in Iowa, maybe New Hampshire. So I would say, don't watch Warren, watch Mayor Pete.
Well, that's the interesting thing, too. We've highlighted some, where the money in tech, at least at the FANG names, employees of the FANG name, where they've been putting money into. It's been not Biden, it's been Sanders, as we've highlighted. Right. And some of these other names out there, not really necessarily Biden. He hasn't gotten much traction with them, but it is interesting to see where people fall in the tech world.
Well, I was going to say, the FANGs are going to spread their bets and hedge, and they'll give a little bit to everybody. But a lot of the private money or venture money is going to Mayor Pete.
Interesting.
Some is going to Andy Yang.
Yeah, and that's kind of like the badge of honor for Elizabeth Warren. She said, "I'm not taking that money. I don't want Wall Street's money."
Well, she's not going to get it.
Right? She's not going to get it, but she's spinning it as like, I'm my own person. Nobody can buy me.
Yeah.
So I think it's working for her brand. I mean, just look at the polls. She's definitely one of the front runners.
Yeah, and just more reason perhaps for people on Wall Street or people watching trade policy to be a little bit more worried about what might happen under a President Elizabeth Warren.
They want change, but watch out what you wish for.
Yeah, absolutely. All right, well, while we're talking about change and the election approaching in 2020, another hot button topic is Medicare for All, and Yahoo Finance's Adriana Belmonte joins us now for more on this. Adriana, I know you've been looking into exactly how we'd be paying for something as costly as Medicare for All, so how will we?
Well, first of all, we have to get an idea of how much it's going to actually cost, not just how to pay for it. And the Committee for a Responsible Federal Budget estimates that it'll cost about $30 trillion over the next decade, which is pretty similar to an Urban Institute estimate as well. So we're kind of starting to nail it down closer and closer. They laid out a list of options as a way to pay for this. So one of them is a 32% payroll tax. Another is a 25% surtax on adjusted gross income above the standard deduction, and then there's also there's a value-added tax. There's a combination of approaches. So there's a number of ways that this can be done. It doesn't necessarily mean it's going to work efficiently, but these are the ones they see as possibilities.
Yeah, and it could be a combination of all those things as well. Maybe try and get some people to concede on some of these points, but others. But I mean, clearly, that's a lot of money. I mean, and just to pay for it. But then also, when you add on how much distortion effects might come from all these taxes as well, that's another big concern here.
Yeah, so I talked to one of the researchers behind this analysis, and he said that the 32% payroll tax, even though it's the most straightforward, it would also shrink economic growth by 3.5%, which, just saw our GDP number.
Yeah, we don't need that.
Yeah, so that's one of the possibilities. He suggested that, a way to cut the cost of Medicare in half would be to take out non-core medical spending, so not covering dental and vision. He estimates that it would cut the overall cost in half. I don't know if that's actually true or not, but he seemed pretty sure. And then another researcher I talked to, he said that instead of just Medicare for All, why don't we just build on the Affordable Care Act? Fix the premiums, the subsidies, rather than starting from scratch.
Well, I want to talk about the Democratic candidates because a lot of them piled on Elizabeth Warren last time because she just said, I'm with Bernie, but she hasn't really laid out how she's going to pay for Medicare for all.
Mayor Pete being one of those too.
Yeah, that's right, exactly.
So do you think there was some credibility to what Biden and Amy Klobuchar were saying in terms of her being disingenuous, where she would have to raise taxes on the middle class to pay for Medicare for all?
I don't know yet because she still has not released how she's going to finance it. So I've been waiting to read that plan as well. But I'm very curious as well because I've been paying attention to what they've been saying. And I think it's interesting. And, somebody else said that these candidates, what's going wrong with Medicare for All or the big problem is that these candidates are making too big of promises. Like there's a way to get the Medicare for All without these exorbitant costs that come with it.
Just a comment. I don't understand why they're going into this mess. The squawking in the blue states over the SALT tax deduction going away, and that's trivial compared to what you just mentioned as tax increases. Their constituency doesn't want them to be taxed. Who are you going to tax to pay for this?
And and you talk about Mayor Pete and also Joe Biden and kind of trying to break away from the progressive idea of Medicare for all, also trying to say that some people out there, left or right, are actually pleased with the Medicare, or not Medicare, the medical insurance that they're getting through their employers as well. So not necessarily everybody on board with this idea, especially if it's going to cost that much.
Even Biden, he's like, you know what, we're keeping Obamacare and just adding a public option.
Yeah. And one other thing to point out too is that one person I spoke to pointed out that there was going to be job losses. There's people who work in hospitals. He said especially in small towns where hospitals make up a big portion of employment. That's going to put a lot of people out of a job. And same thing with people who work at insurance companies too. So just more considerations.
I agree. I want to say, if you think of where Trump sort of surprised everybody, Wisconsin, Michigan, Pennsylvania, the UAW is not going to want to get rid of their Cadillac medical plan.
Good point.
They're not. The unions are not going to support Elizabeth Warren.
Provided, of course, that they have that job still, and that's also key to what we just saw play out as well. As long as they're employed, they're probably fine with their health care that they're getting there. But Adriana Belmonte, thank you so much for breaking all that down. Before we go to break, though, I want to highlight that earnings season continues to roll on. We'll be chatting some other names throughout the show, but want to focus first on Apple and Facebook, because those names will be reporting after the bell today. And according to economists polled by Bloomberg, Apple is expected to post earnings per share of $2.84 on revenue of $63 billion. That'll be mostly flat from what they saw in their comp before. Well, Facebook is estimated to report earnings per share of $1.91 on revenue of $17.35 billion. But Duncan, I mean, these are two big, giant tech names that people often watch for barometer of not just how these companies are doing internally, but how everything's going beyond their own walls. Like I said, Apple's mostly expected to be flat here, but Facebook is still showing a lot of growth, especially when we look at Instagram.
Especially Instagram, exactly. That's the plum. No, I think the FANGs, part of the FANGs are doing fabulous still.
Mm-hmm.
If you want to go around where real cash flow is coming, that's where real cash flow is coming. And so I think people are still very bullish. Now, I must admit, I have a daughter working at Facebook. She loves the place. So.
Full disclosure.
Right.
Full disclosure. Very important to put that out there.
That's definitely good to know. Maybe we'll get her thoughts on, how she
quarter.
knows about some of the controversies. But in terms of Facebook, I'm definitely looking at if they're going to say how much money they're making off the 2020 ads, because we know that's been very controversial, to say the least. They've banned this guy who says he's running for governor just so he can run some misinformation on Facebook and test them. We know Elizabeth Warren, she also ran that ad where she said that Facebook and Mark Zuckerberg were supporting Trump. Oh no, psych, this was just a joke. But I'm testing, Facebook's policy. So it would be very interesting to see how much they actually have earned so far. It's believed that President Trump has given the most in terms of ad spending to Facebook, but also going into 2020, billions of dollars are supposed to be spent. So it'll be interesting to see what Facebook's outlook is.
Yeah. Let me add an issue under the table. Facebook's news feed is what really made them great. And now the news feed is so optimized for ads, fake or real, that a lot of people in the U.S. are just turning off. They don't read, they're not engaged like they used to be. So Facebook's economic model may have eaten the heart out of their real product.
I do wonder, too, if that might happen to Instagram, too, because it's so underpenetrated by ads.
right.
I think that's kind of why people are so excited about the growth there. And what might happen if the same thing happens, that happened to Facebook, happens to Instagram as well. So something to watch for on the earnings call. One thing, too, though, is that the company agreed to pay a £500,000 fine over the Cambridge Analytica data scandal, according to Britain's information rights regulator. A company attorney saying the platform's made major changes since that time. That translates roughly to about a $643,000 fine, which was the highest amount possible under the law over there. Of course, it's not exactly as big as the $5 billion fine that Facebook paid here in the U.S., but nonetheless, that's another thing that is now kind of under the rug, swept under the rug. You move on, you learn, and I guess we've heard enough about all these things this week with Zuck already testifying before Congress. Everything's been done now, I think, and I think they'll be excited to get this all behind them.
Except there are 47 state attorneys general that are actually
Still
investigating Facebook.
Yeah, look,
New York is definitely leading the charge. So you can probably expect more fines. I don't know if they're actually going to be broken up. I don't believe that's going to happen. But definitely, you could be seeing more billion-dollar fines.
Look, it's a really hard problem. We don't want Facebook sort of censoring news and all that.
Yep.
But we would like them to identify fake, real. Not the story, but the source. Because a lot of these are fake sources pretending to be real people.
Yeah.
Twitter is nothing but fakery pretending to be real people. I'd like to see them find a technical way to flag that.
But it's also a question of, is it entertainment or is it actual factual news? We all love to be entertained by fake stuff. It's funny, it's great,
Sure. The Onion.
Oh my gosh, send this to my friend, can you believe this?
Yeah.
But if you're actually trying to pursue facts, that's a different story.
Very good point. And when we're talking about elections, it's a very different story as well, because you could be influencing people, doing their civic duty out there.
And who are unsuspecting, thinking it's true.
Exactly, for sure. Nonetheless, the Cambridge Analytica fine over there across the pond, now water under the bridge at this point. But coming up, earnings season really picking up, with GE beating expectations and raising its full-year forecasts, while Larry Culp's turnaround is looking stronger by the day. Plus, Taco Bell parent company Yum Brands slumping after it reported earnings, while the food giant is getting dragged down by Pizza Hut and even Grubhub. The food delivery carnage continues just ahead. And before we go to break, I want to remind you to watch Breakouts on Yahoo Finance at 5 p.m. Eastern Time today. Emily McCormick will speak with Recess CEO Benjamin Whitty. They won't want to miss it. 5 p.m. back in 2. Welcome back to Wi-Fi PM. We are checking the quiet market action again as we await the Fed decision coming up at 2 p.m. You can see the Dow up by just 14 points and the NASDAQ right now, the biggest mover on the day, off by about 0.14%. Well, General Electric stock is currently a little bit less quiet. As you can see here, that stock up by about 10% today after beating third quarter earnings expectations. GE reporting adjusted earnings per share of 15 cents on revenue of $23.36 billion. It also importantly raised its cash flow forecast for this year. Guys, all business units reported gains except for its turbine unit. You can see their power in the red, but the rest of them holding up there strong. And this is something that we've talked about under Larry Culp. Cash flow has been watched closely as kind of that arbiter of how well this company's turnaround is going. And they upped their forecast up from about $1 billion to now $2 billion in free cash flow this year.
Yeah, so the reason why we're seeing GE stock be up about 10% is because expectations are so low for this company. We've had years and years of negative headlines, and now Larry Culp is actually proving that incrementally, so little by little, he is actually turning this company around. So when it comes to their earnings, they were expecting 11 cents per share in earnings. They got 15 cents per share. So investors are very happy about that. But the problem child of GE continues to be the power business. That they saw losses of over $100 million, but that's better than over $600 million in losses that we saw last year.
I mean, how much of this, too, Duncan, when we look at it, this is a company that hadn't really done, before Larry Culp got in there, done a good job of actually delivering on its own expectations and what Wall Street has been expecting. But now, increasingly under Culp, I mean, he's gotten some wins under his belt here. And especially today, when you look at it, I mean, that's the most the stock surged in quite some time. So, I mean, I think people might start to be buying into the turnaround at GE.
Possibly. I mean, it's such a bellwether company, and it's sad when it fell apart, and it's in effect.
Yeah.
You know, it's sad for the whole country. I'll tell you what I worry about more than anything else. A lot of your news stories and other news stories talking about how overall business spending is down or negative. The companies are not reinvesting in middle-class jobs and middle-class businesses. And GE, a lot of their problems are overseas, not in the U.S. I would actually love to see them begin to reinvest in jobs in the U.S. instead of just trying to finagle earnings.
Yeah, what's interesting is another thing that they highlighted, the pain with Boeing, because you talk about their turbine unit. I mean, the 737 MAX, that kind of trickles through, and it impacts a lot of companies. But today, GE stock up the most that it's been in 8 months' time. So nonetheless, we'll let them enjoy their win for now. Elsewhere in our earnings palooza, Advanced Micro Devices is under pressure after reporting quarterly results. The semiconductor company reported adjusted earnings that were in line at 18 cents per share and a slight miss on revenue. But guys, this was still AMD's highest revenue in more than a decade. So that's good.
Yeah, I was actually really surprised by that. I'm like, a semiconductor business doing really well in the era of the trade war with China. And it's like, how are they doing it? And it turns out that they are actually continuing to get plenty of sales when it comes to enterprise and the cloud business in China with those Chinese clients. And also, the CEO has said that despite the fact that the U.S. has put, for example, companies like Huawei on this blacklist, they are still managing to work with other Chinese tech companies and still able to, sell their product.
Yeah.
But also, when you think about the trade war with China, China hasn't made the fact that Huawei's been blacklisted such a sticking point, which shows that they're able to work around that. The biggest issue for China is definitely the tariffs and wanting to drop that. So when it comes to Chinese tech, they're still advancing and they don't really see this as a burden.
Yeah, I mean, that's one of the things, too, when you talk about AMD's product focus shifting. They've focused on a lot of those high-end chips when we talked about smaller processors and all the shift there. But you're right. I mean, it's been a very volatile industry when we talk about the trade war and which kind of sectors are impacted the most. But promising to see that, they're focusing on high-end things and still having it work out. Although the stock not necessarily being rewarded today for again, that highest revenue in more than a decade.
If I can afford just a snarky comment, I'm from Silicon Valley. Nobody cares about silicon anymore. So
the irony.
The irony of this.
The irony of it all.
I know.
So maybe that's why they're not seeing
we
so
still
big
have
of a pop.
We still have Qualcomm, and AMD's got some very good sort of high-end gaming or supercomputer chips.
Exactly. So focusing on the
I'm
high
glad
end.
to see that.
And there's still plenty of headwinds out there.
Yeah, no, for sure. Perhaps those reasons trickling into all of this as well. But a break from the earnings action for just a bit, because we must inform you that Game of Thrones will soon have a new online home, because Warner Media announced it will launch HBO Max in May of 2020. And the streaming platform will make its debut with about 10,000 hours of content from Warner Brothers, HBO, the Cartoon Network, and Turner Classic Movies. And HBO Max will be the most expensive streaming service, just under $15 a month for subscribers. You can see how that compares to some of the competitors around the streaming space. And guys, I say some competitors, but that's a pretty stacked list now when we look at it.
Yeah, in terms of streaming, I mean, we're finally here. I feel like we've been talking about it month after month. The streaming wars are coming. They're coming. They're coming. Well, Friday, boom, Apple TV Plus launches. And then about, not the week after, but the week after that, Disney Plus launches. So HBO Max gets to sit pretty and pretty much watch Netflix, Disney, and Apple kind of duke it out. But HBO Max is definitely aware of their vulnerabilities. So Warner Media's executives have said, well, we know we don't have that large of a library content compared to them, but they definitely have big brand names, and they're also using human curators. So they're kind of using what Randall Stevenson had said a while back, where he said that HBO was like Tiffany's and Netflix is like Walmart. So what they're saying here is basically that, you know what, we're going to have not too much content, but just the right amount of content that consumers do want to watch.
And they added a big important piece of that content. I don't know if it's Tiffany's shiny, but it is shiny to some people. HBO Max also landed the rights to Comedy Central's South Park in a deal valued at up to $550 million, according to Variety. That will be available on HBO Max starting in June of 2020. But that's a lot of money for South Park.
I'll say one other thing. When you get all these streaming services, Apple, Amazon, everybody else, including Hollywood, the amount of money they got to keep pouring in to keep it going is going to surprise them. It's not like you just do a movie and it's out there. No, they have to keep pumping in servers and streaming and technology.
Yeah, I mean,
so California's in good shape. We do the content and we do the technology.
Yeah, you got them both.
Exactly.
Like a vertical integration here, but I mean, you're right. I mean, it's all of these companies continuing to pump more money. You can look at Netflix and the pressure there as all of these continue to roll out. Netflix being one of those that's caught kind of in that space of, yeah, sure, it's the leader, but how much money is it going to cost you to keep pumping out original content and promoting that original content as well?
And especially with Apple, so we're looking to see, how iPhone sales have worked, for their latest, iPhone 11. But at the same time, can they really afford? I mean, I'm sure they can afford, but long story short, every single show on Apple TV Plus, the streaming service, can't cost as much as the morning show, because that's like $15 million an episode. $300 million for 2 seasons. Yes, they needed the star power, Steve Carell, Reese Witherspoon, Jennifer Aniston, but you really can't do that for every single piece of content on that streaming service.
Yeah, and Apple historically hasn't been a great content creator as well. They've had their hiccups in the past with these things. It's not necessarily the same.
If Steve had still lived, he probably would have merged Apple and Disney or something.
I think Bob Iger even said that if he was still alive, they would do that.
But the great thing is this platform shift opens up opportunities. Yahoo Finance, there's a lot of opportunities. Seriously.
The golden age.
The golden age. CNBC's got its channel on cable, but now cable's less important.
RIP is what I say. All right, well, Beyond Meat is rebounding today after getting grilled by investors earlier in the week. And despite beating quarterly earnings and revenue expectations, the stock dropped over 20% yesterday. You could see the shares bumping back a little bit there, up 10%, 9.5%, call it. Beyond Meat CEO Ethan Brown joined Yahoo Finance earlier today to share his thoughts on how his company is dealing with ongoing competition.
Our ability to focus and move more quickly than the incumbents, I think, is a big competitive advantage. It's one that you see time and time again. And so one of the ways that I felt was an effective answer to this question on our roadshow was to return with a question, was why was Tesla able to do what Tesla has done to General Motors, to Ford, et cetera? There are examples throughout history where companies have been able to move quickly enough to provide a new product from somebody new to the consumer and upend an industry. And we've looked at those and are studying what's worked and what hasn't.
Duncan, this stock's down by about 61% since its peak in July. I mean, it's easy when you have the enthusiasm, and we saw that clearly with Beyond straight out of the gate. But more and more people may be realizing that, sure, you could be an innovator and launch a product that is a meatless burger, but a lot of people nipping at your heels. At some point, maybe you're not the company to actually deliver the product that a lot of people are waiting for.
Yeah, there's two currents they're flowing against, or two counter trends. One is this is more expensive than real meat. And second, it's heavily processed. A lot of people begin to think, well, maybe real meat's healthier for you.
Yeah. I mean, and certainly we've tasted these things, and in my opinion, it tastes better. But that's kind of aside from the environmental factors here and the health factors as well. Just taste alone, I'd go with real meat.
Yeah, well, I mean, when it comes to like me personally, I love real meat. Like I love my ribs and my steak. You know, I haven't caught on to this, fake meat, plant-based craze. But in terms of Beyond Meat's CEO, what he wants, he's basically dating McDonald's right now with that partnership in Canada to have this fake meat burger, PLT, plant lettuce tomato sandwich with the fun name. But he wants to be married to McDonald's. He wants to have years and years of partnerships, a national rollout, also in the U.S. with Beyond Meat. And McDonald's is pretty much looking at the sales, and it looks like right now they haven't been too impressive, but we'll see, because that's definitely going to be the critical factor to see Beyond Meat, whether they're able to really expand is through that partnership with McDonald's.
Yeah, in that same interview, he noted that he was confident in that test trial with McDonald's, and that seems to be going well in his mind and could lead to a marriage. I like that metaphor here.
He's talking the talk.
He's talking the talk. We'll see if he walks the walk. But I mean, at least he has been walking the walk when it comes to Dunkin' and the partnership there as they continue to roll out that sandwich. Their breakfast sandwich did very well in New York, and then they rolled it out to even more locations. So at least they're proving it on that front. But again, kind of the concerns here being that it's a lot of competition coming for Beyond Meat as well. And to your point, Duncan, I mean, it's kind of an expensive product out there.
Yeah, and also Tim Hortons. I mean, they tried the Beyond Meat fake sausages and fake meat sausages. There were real sausages with just plant-based fake meat. And their same-store sales were down 1.4%. So it's iffy when it comes to the fake meat market. For example, Burger King. They did really well with the Impossible Burger with the Impossible Foods, but it's not a guarantee that it's going to be, a huge boon for sales.
Yeah, one size does not fit all, and one meatless patty not the same across the board either. It's a much worse state. I don't think that's going to catch on, that saying. But lastly, in our earnings palooza, we're also watching Yum Brands. Speaking of food, that company is suffering its worst trading day since 2015. You can see their shares off. It's rebounded a bit, now off by about 7 3/4%. The Taco Bell and KFC parent company reported third quarter revenue and earnings that mostly fell in line with expectations, as you can see there. But the bad news was that same-store sales rose just 3% compared to the 3.3% average analysts had been expecting, according to Bloomberg, citing consensus metrics. And that was largely due to a flop on the part of Pizza Hut, whiffing on the 1.6% growth expectations to come in flat as the restaurant brand continues to flounder. Yum also wrote down its stake in food delivery company Grubhub, which Yum put $200 million into for a 3% stake back in February of last year to bolster its delivery efforts. And that write-down, importantly, does not reflect the 40% implosion Grubhub suffered yesterday after reporting its own earnings. So perhaps another write-down coming in the future here, guys. But Taco Bell continues to be the standout brand for Yum Brands, and that doesn't really surprise me. I think that brand has done a lot of things to innovate menu items. You can talk about all the things that they've done, but clearly something is wrong with Pizza Hut right now.
Yeah, definitely something's wrong with Pizza Hut and also with Yum Brands in general, trying to win in the delivery space with that Grubhub investment. So they made a $60 million pre-tax payment that was linked to their investment in Grubhub. So in February of last year, they spent $200 million to get a 3% stake in Grubhub. And now their own valuation of that investment, they're writing it down, and it hasn't been helpful for them. And as we mentioned there, Zach, Grubhub is also feeling the fire there and also warning investors at this point that there's a lot of competition in this space and that growth is going to be much, much slower than they expected.
Yeah, Duncan, I mean, DoorDash being one of those names that's competing with Grubhub, and we've seen them continue to grow, steal share. But that's another company out there that is in the private sector getting funded. That's another SoftBank company getting money. We saw what happened to WeWork. I mean, there's pressure on these companies to start making money too.
The WeWork, can I mention WeWork once again?
By all means.
The WeWork fiasco is causing the mother of all shifts from growth at any cost to margin. And it's impacting all these companies. You can't really see if they're ever going to get to become a profitable company. So in our own investing, we have a company competing with Lyman Bird in the scooter business. We know it's a better business model. And we now know we can get this company to profitability and growth when they're going to keep struggling. I think we're symptomatic of what's going on all across the venture industry, a shift, not to no growth and profit, but to growth with high margins, which is a traditional tech company.
That's kind of been the interesting thing, though, too, when you look at Grubhub, and I think that's why it was kind of so hit hard yesterday, because a 40% drop, clearly very hard.
Yeah.
But I mean, that kind of being the question, if a publicly traded company is the right way to go for this space where you're not going to be making money in the food delivery space, and DoorDash, you have the luxury of being a private company and not having to worry about updating everyone every quarter.
Well, I think the issue is multiples. Like WeWork are trying to claim tech multiples. It's a real estate company. Peloton, tech multiples, it's exercise bike company. They're terrific companies, but they don't get tech multiples.
Yeah.
So the problem are the multiples being put in these aren't tech companies.
You don't think food delivery is tech?
No.
Okay. All right, good. Then we're agreed on that point then.
But I don't think, Adam Newman, founder of WeWork, is too concerned at this point. I mean, he got $1 billion cash out.
Yeah, I know.
The company is struggling.
Clearly.
But, he's still a success story there.
Yeah, but
try to do that if you can.
Well, no, wait. He's more of a bailout. He's got $1 billion of debt now from J.P. Morgan and from SoftBank, and then he'll sell his stock down to get about $900 million.
Yeah, but
a lot of money.
Can you imagine if this company went public? This company went public, and then you had all these people on board who may have been sold shares, and they might not have enjoyed where things went. That would have been very dangerous.
We sold a company to WeWork at their inflated price. I was trying to stop it. It's now just toilet paper.
That sounds like another story to get into. If we had more time.
Different topic.
That's quite an assessment.
Yeah, we're going to get into that one later. All right, next on Wi-Fi PM, though, the NCAA opening the door to paying college athletes for their likeness, including in video games. So what does that mean for the gaming industry? The co-founder of the Major League of Gaming will join us next for more on that. Plus, speaking of gaming, the World Series wrapping up tonight, and Yahoo Finance caught up with MLB legend Mike Piazza for his take. We'll have that right after the break. Good afternoon and welcome to Wi-Fi PM. I'm Zach Guzman, and joining me today is Yahoo Finance's Sabeel Marcellus, along with Bullpen Capital founder and general partner Duncan Davidson. Guys, strong Act 1. We got a lot to fit into Act 2, so no time to waste. We're checking the market action right here. The Dow up by about 7 points, a little bit quiet Wednesday here. Of course, that'll probably change when we hear from Fed Chair Powell coming up with their interest rate decision at 2 o'clock, and then him stepping to the mic at 2:30. Let's check in with Scott Gamm on the floor of the New York Stock Exchange for more on the market action we're seeing today. Scott?
Hey there, Zach. Well, yeah, it's tough to be on the air 20 minutes ahead of a big Fed decision and try to make sense of the market right now. But with that, I'll reiterate the sleepiness of the action we're seeing today. But remember, it's not necessarily that 2 p.m. decision and statement that the market historically has reacted to. It's really more so the press conference at 2:30, especially with Jerome Powell, who has a history of making statements during the press conference that spooks the market. So all eyes will be on what he has to say in just about an hour's time from now. When it comes to individual stocks, it's not often we say this, but GE is leading the S&P 500 up about 10%. Of course, the company reported better than expected earnings this morning, and perhaps even more importantly, raised its industrial free cash flow guidance for the year. So GE shares getting a pop off of that. Now, when it comes to the downside, you do have financials as the second worst performing sector in the S&P 500. Again, we're expecting a rate cut at 2 p.m. That tends to thin out those net interest margins that the banks rely on. But then again, rate cuts, at least over the past couple of months, have steepened the yield curve, which is good for the banks. So it's a tricky dynamic. But the two bank components in the Dow, JP Morgan Chase and Goldman Sachs, are down right now, Zach.
All right, Scott Gamm on the floor of the New York Stock Exchange. We'll check back in with you later on in the show. But meantime, some video game fans are hoping NCAA football could be making a comeback after optimism has grown following the NCAA Board of Governors' decision to vote yesterday to allow college athletes to get paid for the use of their names, images, and likenesses. And this comes as esports revenue is expected to reach $3 billion by 2022, according to a recent Goldman Sachs Global Esports report. So joining us is co-founder of Major League Gaming, Mike Sepso. Mike, good to see you. I should say Sepso. Sepso.
That's right.
Is the name. Mike, I mean, when we look at this, what do you think of the decision here? Because obviously EA Sports had kind of stopped making their games because of all the questions around athletes getting paid for their likeness in these video games. But this could open the door to maybe revisiting that decision. It would be a big one, considering how big gaming's grown.
Yeah, I think there's lots of fans that love to play EA Sports games that would love to see NCAA football back. I think it's a bigger decision for the NCAA and college athletes. I think, in the past, having things like that where their names and likenesses were being licensed and they weren't being paid for it, I think that's not great.
Yeah.
So I think this could be a win-win for everyone. I think what the NCAA actually said yesterday was they put together a working group to figure out how this could happen. They're not starting it tomorrow. But I think it's a great thing for both the video game industry and the NCAA to be talking about.
What's interesting, too, though, is that we're talking about likeness in video games like NCAA football or NCAA basketball. You can make all the different games there. But also, I mean, the gaming industry has grown itself as a sport, so we should be talking about potentially gaming athletes getting endorsement deals here as well, just like you would see a football player or a basketball player get endorsement deals as well.
Yeah, well, I think if you guys are probably familiar with Ninja, who's one of the biggest people, I guess.
He's the only one I know.
Yeah. He got to start in Major League Gaming many years ago playing Halo in our competitions. And, he's now bigger than most athletes and musicians and movie stars at this point. So I think gaming is just so big and pervasive and so mainstream at this point that superstars are being made all the time and globally.
Mm-hmm.
I was a student athlete in college for track, so that's not a sport that I think all this endorsement money is going to come to, or fans really want to do like a track video game. But how much money do you think this is actually going to bring to student athletes in the popular sports like football and basketball?
Look, the video game industry itself is, if you took the entire movie box office globally and the entire music industry and doubled it, the video game industry is bigger. So it's at a scale that most people don't realize. Over $150 billion in revenue this year just in the video game industry globally. How much of that would be attributable to names and likenesses for college athletes? Probably not a ton.
So like a billionaire student walking on campus.
Yeah, I mean, it's not going to necessarily be that. I mean, if that billionaire student, if that student was in esports and not football, maybe.
Yeah, I mean, done that. I mean, when we look at it, it's interesting too, though, because I mentioned the reluctance on the part of EA to kind of get back into here with all the legal question marks about using likeness. But EA's CEO Andrew Wilson recently told the Wall Street Journal that EA would jump at the opportunity to bring back the college football gaming franchise. I know that your league is backed by Activision Blizzard, right? So that's a different company entirely.
Yeah.
But I mean, when we look at it, I don't know. What are your thoughts on maybe when you're kind of designing these games and making these decisions in a video game level? Clearly there was demand for these games, right? And that's kind of what this is all about. So you want to make games that people want to play. But now if that legal question gets answered, I don't imagine there would be any kind of headwinds to bringing it
I don't
back.
think so. Like I said, I think what the NCAA is doing is putting together a working group to figure out how that would actually happen, how that cash would change hands, how those rights would be managed. And there's a lot of work to be done to make that happen. It's not on the video game industry's side of things to figure out.
Yep.
I think, my experience, so I started Major League Gaming, which was one of the first big esports leagues in the world. Activision Blizzard bought us in 2015. And then we went on to create the Overwatch League, and more recently the company created the Call of Duty League. Today we launched a company called Vindex with $60 million in a Series A funding. And we've acquired a couple of companies to get started, and what we're going to build out is the infrastructure to help power all these things. It's still a very nascent industry, even though it's billions of dollars changing hands. It's still very nascent. But I think what we are seeing is that stars in esports are rivaling in terms of earning power and notoriety traditional athletes.
Yeah, and I think that's the key piece that has been
That is the
overlooked
key
when we
piece.
talk about likeness and everything else. Everyone's focusing on NCAA football, but hey, you could go a different route
But
here.
who's working harder?
Yeah.
The athlete or the gamer?
You never know. I mean,
it takes all kinds, I think. Mike Stepso, thank you so much for joining us, and congrats again on the $60 million fundraising.
Thank you.
Big stuff. Thank you. All right, well, tonight is Game 7 of the World Series with the Houston Astros taking on the Washington Nationals. And ahead of the excitement, Yahoo Finance's editor-in-chief Andy Serwer had a chance to sit down with MLB Hall of Famer Mike Piazza to get his thoughts on the game. Take a listen.
Astros Nationals. Were you surprised that those two teams are in the World Series?
No, I follow the Astros. They've always, for the last, since they, Bob Crane bought the team and they embarked on a very ambitious plan to draft young guys and change the sort of philosophy, the culture of the team. And they have a great farm system now. They're well coached. They're well managed. Obviously, they have some great players. So no, I mean, I'm not. Success is not an accident. I mean, success it's a culture, and you have to put the right people in the right place and have, as I said, everyone on the same page for a common goal. And the Nationals were actually one of the best teams after the first few months of the season. So they have some amazing pitching. Scherzer getting hurt didn't help them. Anytime one of your big guns like that goes down in the World Series, it's the worst time for it to happen. So, but tonight's Game 6, and if Strasburg can throw a gem, you're even again. It could be a Game 7. I love Game 7, so I'm not really I don't have a dog in the fight. So but it was always fun to have a winner take all game.
Oh, everybody loves Game 7s. It's going to be good times tonight. But coming up, we're just minutes away from the Fed's interest rate decision. We'll chat with Wells Fargo's senior economist for what to listen for when Fed Chair Jay Powell steps to the mic right after this. Breaking news, we're just moments away from the Federal Reserve's decision on interest rates, and the central bank is widely expected to cut rates for a third time since July. And joining us now to discuss is Wells Fargo senior economist Sarah House. Sarah, the street expectation here, the large expectation is another 25 basis point cut, but what are you going to be listening for when Fed Chair Jay Powell steps to the microphone?
Right. So the cut today is largely priced in and I think pretty widely expected, as you indicate. But what's really going to be key is that guidance going forward. So we've seen the Fed really take a risk management approach to the environment right now. The data, it's slowed a little bit, but generally show that the economy continues to hold up. And so I think the question really becomes, do they feel that they've taken enough of this risk management? Do they think they've taken out enough insurance at this point? And what will they be watching going forward to determine if further easing is necessary?
So GDP grew at 1.9%, and an economist said that that's better, I guess, than being poked in the eye with a sharp stick, but it's not that great. So what do you think is the future guidance when it comes to business investment? Because you know that the fact that businesses pulled back on that had a big impact on GDP.
Right, so we've still seen the economy slow overall. So if you look at GDP on a year-over-year basis, we're only growing about 2%, which is the slowest pace since 2016. And really the downdraft is coming from that investment side as you continue to see uncertainty about the trade situation, the global growth environment linger in the background. And so that's had an impact. We've certainly seen it on capital spending plans, and that showed up in today's GDP report. And we think that will be a headwind that's here with us for a while until we get some sort of meaningful resolution in the trade situation. Now, luckily, things haven't escalated further over recent weeks or even the past month or so. But when we look at where we are with the overall situation, it still seems that we're pretty far away from a full-fledged deal. And so we continue to expect investment spending to probably show up negative over the next couple quarters.
And let's talk about the consumer. So what do you think about the health of the consumer, given that the consumer shopping spree has definitely slowed down? So it was a little bit over 4% in the last quarter, and now it's slowed down to close to 3% in the third quarter.
Right, so that second quarter consumer spending was in large part payback for a weak Q1. So I think we're really starting to see consumer spending begin to level out, and we'll probably see a further downshift over the next couple quarters. So real disposable income growth is only growing about 2.5%, and so that does suggest that unless consumers are notching down the rate of saving, that we'll probably get a slowdown in overall consumer spending. But the fundamentals of the consumer remain pretty strong right now. So you have a saving rate still right around 8%. That's twice as high as what we saw in the 2000s. Debt service remains historically low as well. And so we still think that consumers can continue to really carry this expansion, but it's not going to be at the breakneck pace that we saw in Q2.
All right, Sarah House, breaking it all down again, just moments away from that key Fed interest rate decision. Thank you so much for joining us. Appreciate you taking the time.
Thanks.
And thank you as well to Duncan Davidson, sticking around for the full hour. Always good to see you in person, my friend.
It's great to be here.
Yeah, thank you again. Sabeel Marcellus, thanks as always. Let's check in with Scott Gamm on the floor of the New York Stock Exchange for more market action. Scott?
All right, Zach, thank you. Let's continue the conversation on the Fed with Alan Valdez of Silver Bear Capital. So, Alan, what are you expecting at 2 p.m.? A rate cut plus something else?
Well, yeah, I think you're going to see that rate cut quarter point. That's like baked into the cake right now. Now, what isn't, of course, will be the press conference later with Powell. We'll see what happens. But the guessing down here is maybe you'll see him say a pause because today's numbers were strong. GDP, jobs number a little stronger. ADP, we'll see what it looks like on Friday. But basically, you could see, I mean, we've had 3 cuts this year. That's pretty strong. It really is. So we'll see what happens. Right now, December would be the date when they'd be cut again. But I think, if anything, it'll be a pause.
Yeah, so if they cut today, this would be the 3rd cut of the year.
Correct.
You mentioned the strong economic data that we saw today, that along with stocks back at record highs. So what does that mean for the calculus of the Fed?
I think they're going to say, hey, we should pause because we've already cut 3 times. Let's watch this market. Because, you know, it's in December. It's 2 months away right now, basically. We'll have to see what happens. A lot could happen with the China talks. A lot could happen with Trump and everything. So there's a lot of things that come into play between now and December, end of the year. We'll have to wait and see. But I think you'll see a pause.
So what does that mean for stocks then? I mean, now that we're back at record highs, I guess what's the next catalyst that could break us out to even more highs?
Well, you know, earnings season's basically over, so we got the earnings behind us. So right now it's going to be all on tweets probably till the next quarter. But the numbers are strong. And then the consumer number's strong. That GDP number was strong, and it mainly was on the backs of the consumer spending. I think we're going to see a good Christmas season. Consumers be out there spending. we'll have a good year.
Well, you mentioned earnings. We have Apple and Facebook after the
That's
close
right. We have
today.
those two giants today, yeah.
I mean, those are typically market moving.
Without a doubt. We'll have to wait and see where they are. Apple, though, I think is going to be pretty good. I think they'll be strong. Facebook, I'm not so positive.
Are you surprised by the surge in Apple over the past couple of weeks, now nearing $250 a share? I mean, the stock was at $140 at the beginning of the year.
It's amazing. But, you know, I mean, I still see lines for the Apple, what is the Pro 11, the new iPhone out there. I pass an Apple store on the way home a lot, and I still see lines for that phone. So, I mean, sales must be robust out there with the Apple.
All right, we'll have to watch and see how it plays out. But Alan Valdez, thank you so much. Zach, we'll send it back to you with 5 minutes to go until the Fed decision.
That's right, 5 minutes to go. Stay tuned to Yahoo Finance for complete live coverage of the Fed decision. The ticker starts in 2.
Good afternoon and welcome to the ticker on Yahoo Finance. I'm Akiko Fujita. We are tracking breaking news out of Washington, D.C. The Federal Reserve decision set to come down any moment now. And of course, following that, we will be waiting for Fed Chair Jay Powell's press conference that is scheduled to start in roughly 30 minutes. Ahead of that, we are seeing red arrows across the market, although pretty flat trade right now. The Dow is down just 11 points, the S&P 500 down 4, and the NASDAQ down 17. Now, as we await that decision to come down, let's bring in our panel here at the table. I've got Yahoo Finance's Adam Shapiro, along with Tony Rodriguez. He is Naveen, head of fixed income strategy. So, Tony, let me start with you. Another rate cut pretty much all but baked in here. Right. The question's really going to be in that press conference and how the Fed chair messages what's going to be ahead. Is this going to be the last one of the year?
Exactly. And our view is that there will be the last one of this year, but there'll possibly be one more by maybe the middle of next year. But the key will be, does he thread the needle in being able to convince the market that they are going to pause without it being too hawkish of a pause, which could spook the markets?
And Adam, this comes on the back of some mixed data that we got today. What are you going to be listening for?
Insurance, the word insurance. Do you see that in this statement? Look, we are on trajectory for 2.3% GDP growth. That there, as just one metric, is enough for the Fed to say, okay, at full employment, we can pause.
Let's try to break down what we got today in terms of the numbers. I mean, GDP 1.9%. Okay, we're getting this decision right now. We are looking at a quarter or 25 basis point cut here as expected. We are also seeing some headlines coming out here.
Uncertainties remain.
Uncertainties remain. The Fed saying they will assess appropriate rate path. That word appropriate, also one that we've heard throughout the year as well. So we're looking at a 25 basis point cut here, and the Fed looking at uncertainties to remain. Tony, when you look at what has played out over the last several meetings, trade has been the big uncertainty. There's certainly a lot of geopolitical headwinds. You could make the argument here that things have maybe been pushed a little to the back. The U.S. and the Chinese are speaking. Brexit has been delayed. How much of that has actually reduced the uncertainty, at least in your opinion?
I think at the margin, it has reduced the uncertainty. It's what allows the Fed to take this pause in order to assess incoming information. The economic data has certainly held up reasonably well. The consumer's been solid. It accounted for all of the growth, of course, in the third quarter. Business spending is anemic. Until the trade situation gets resolved, we expect business spending to remain anemic. So that's why the Fed has to pause but remain data dependent and flexible, because we're really not sure how this trade story is going to play out.
You talk about business spending remaining anemic. Adam, the number we got today for business investment, Q3 dropped 3% on that front. So we've certainly seen businesses pull back, at least in the face of the uncertainty. Your thoughts?
Well, my thought is that the statement actually removed language from previous statements and promising to, quote, act as appropriate to sustain the expansion. That is the phrase that was doesn't have the word insurance, but that had kept the markets very happy that the Fed would step in. That almost, well, do you think that that's a signal that, okay, nothing in December and maybe not even next year?
Well, I think that there's enough members on the Fed who are, I won't call it hawkish, but are certainly questioning whether they do need to do any more. So I think it's kind of playing to those members on the committee. I still think that the chair, though, is going to be, responsive to data for what we see in the fourth quarter coming out early next year, because there is still quite a bit of uncertainty of how much weakness might we see out of the consumer. Right now, it's been great. They've held up, but that'll be the linchpin.
Okay, Tony, stay right there. I want to bring in Brian Cheung, who is, of course, in Washington, D.C., our Fed watcher on the ground there. Brian.
Hi, Kiko. Yeah, so as you've probably seen already, the big headline being that the Federal Reserve did cut interest rates by 25 basis points. This is the third consecutive cuts following the 25 basis point cuts in July and September. So the current Fed funds rate target is between the range of 1.5 and 1.75%. And as Adam was just mentioning, the big change in the statement was really the removal of the language "act as appropriate." That was language they had used in the past few meetings to really describe the need to possibly cut rates. That language is revised to now say the committee will continue to monitor the implications of incoming information for the economic outlook as it assesses the appropriate path of the target range for the federal funds rate. You will take that as you will, maybe perhaps a bias that they're pausing for the time being, but not much else in the statement has really changed. One kind of notable thing is that they did describe business fixed investment and exports as remaining weak, but otherwise mostly unchanged. We did see two dissenters, one from Boston Fed President Eric Rosengren and another from Kansas City Fed President Esther George. No real surprise there. Both these individuals had dissented from the Fed's previous two decisions to cut interest rates, but James Bullard, who had previously in the September meeting advocated for a 50 basis point cut, no longer dissenting. He did agree with the 25 basis point cut in the meeting today. Otherwise, not much else changed in the statement. Something that's also worth watching, though, is that October 11th was when the Federal Reserve did have that surprise announcement that they would be continuing what they call organic balance sheet growth. That would be about $60 billion of purchases of T-bills. Something that they very clarified and said that is not quantitative easing because it's not for the purposes of easing monetary policy. It's simply just to make sure that interest rates stay within the target range that it had after that crazy repo incident in mid-September. So something worth watching there, although nothing in the statement directly talking about that. But obviously Chairman Powell probably expected to answer some of those questions in the press conference that will begin in about 25 minutes. And for those that aren't aware, this is not a meeting that had any sort of dot plot projections, so no summary that we can kind of point to right now for where rates go from here.
Hey, Brian, I am curious about something in the Fed statement and help us understand the dual message that they're saying. When you quoted from the paragraph where they said business fixed investment and exports remain weak, just before that they say household spending has been rising at a strong pace, then business fixed investment and exports remain weak. Then they get into inflation and they point out that market-based measures of inflation compensation remain low, the tips. We don't have the 2% inflation they want. So how should an investor read that? You got the consumer seems to be strong, but everybody else seems to be flat and we're underperforming under inflation?
Well, I think the important thing to note here is that we really need to compare it to the Fed's last description of both consumption and also business fixed investment. So you do mention that household spending in this statement was described as rising at a strong pace. That is the exact same language that the Fed used in its September meeting. So nothing really changed there, which would seem to hint that the Federal Reserve doesn't really see us as really tipping into a recession yet, because the consumer being about 70% of the economy has been commonly cited by Fed Chairman Jerome Powell as really the driver of this current economy. So that hasn't really changed. The language that did change was around business fixed investment. Again, they described it as remaining weak as opposed to the last statement in September, which said have weakened. So it's showing that there hasn't been any sort of material recovery in that particular space. And the BEA numbers for GDP for the third quarter seem to back that up for the last quarter. The numbers that we got this morning showed that structures investment, which is a piece of business fixed investment, actually declined by 15.3%. That is a pretty precipitous change right there. So I think if you're reading this, you're probably saying that it's really those manufacturers, those types of businesses that are really holding back on capital spending that are really going to be feeling the burn for right now. But the Federal Reserve does hope that by cutting interest rates today, maybe it can ease some of the business conditions for those companies. But regardless, it will be interesting to see how Chairman Powell describes that in the press conference, which again begins in about 25 minutes or so.
Hey, Brian, this is Tony Rodriguez. I think the market was concerned whether we would get a pause, but then it would be read as being too hawkish and that we'd see a negative response from the equity markets, for example. Right now, it has not been a very strong market response. Do you think that the statement so far and that the Fed will be able to kind of thread that needle in terms of a pause, but not a hawkish end to the potential easing cycle?
Well, it's an interesting point that you make. I mean, normally it seems like a big dramatic change in the language of the statement would hint at maybe some more market sensitivity. But I think we have to remember that this is, part of Jerome Powell's strategy as coming in, when he came in February of last year to have press conferences at every single meeting. So I think markets might be watching more closely for what he's actually going to say at the podium as opposed to what the statement says right now. But if the statement is any sort of indicator for what he might say, the act as appropriate language, which policymakers have leaned on so heavily in the past few months, is probably not going to be the name of the game anymore, and it'll be interesting to see what markets do after that point in time. I mean, this is not the first change in language from the Fed. We have to remember from beginning of this year, which feels so long ago, but at the beginning of this year, the statements used the word patient. That was when the Fed had not yet started cutting rates, but at the time you did see some interesting reaction as the Federal Reserve did seem to indicate what the market really wanted, which was easing policy. So we went from patient at the beginning of this year to act as appropriate around August or so. Actually before that, earlier in the summer, really, and then now, finally in October, finally changing to continue to monitor. Now, it's up to the markets to decide to what degree that indicates a pause or not. But again, I think it's the Powell press conference that'll really be the tell-all from here.
Okay, Brian, we'll let you get to that press conference. Brian Cheung there on the ground for us in Washington, D.C. And a reminder to our viewers that press conference is set to begin in about 20 minutes or so. Tony, I want to get your thoughts on that question you asked Brian. I mean, why do you think that we're not seeing as strong of a reaction given the significant change we saw, even if it's that one line in the language? Is this just the market really looking to see what the Fed chair has to say in terms of the outlook and trajectory moving forward?
Yeah, I think they're going to certainly wait on the press conference. And I think that the data we've seen over the last month or so and some of this kind of reduction in the temperature on the trade discussions has made the market comfortable that, December ease doesn't need to happen. I mean, that was clearly priced in a few months back where the market felt the Fed was way behind the curve. I think the market might feel like now the data has held up reasonably well, certainly the GDP number. And so therefore, a pause is okay. It doesn't put at risk growth in 2020.
We didn't get a dot plot, as
Right.
Brian pointed out, but when we do, they had been saying or setting us up for at least, wasn't it 2 more next year?
Yeah.
And now it seems as if we're backing off of that or not, because this seems to signal the pause could be longer than December.
Yeah, I think what we'll see if we get when the next meeting when we do get dot plots is that we actually see is a narrowing of the dots, right? Where there was still some divergence at the last meeting. So, I think what we're going to start to see is everyone narrowing in on either staying where we are throughout the year or at most one more. I don't think you'll see any more tightenings despite the dissents on these. I think you'll see them come in at that this is maybe the equilibrium rate over the next 1 to 2 years.
Okay, Tony Rodriguez, appreciate you stopping by the studio today. Let's get out to Scott Gamm, who is on the floor of the New York Stock Exchange. And he's joined by Kevin O'Leary from O'Shares ETF Investments. Scott, what's the reaction on the floor there?
Hey there, Akiko. That's right. I want to bring in Kevin O'Leary right now for reaction on the Fed. Okay, so we got that quarter-point rate cut. What was your reaction?
It was so highly anticipated, I didn't expect much other than we were going to get 25 basis points. But here's the issue. If you look at the whole data set today, the two big surprises. One, how strong the consumer remains, up at that 3% growth, and also the 3% decline in CapEx spending with business. So these are offsetting, but yesterday we were at 90% we'll get another Fed cut. I'm not sure now. I think the Fed may pause for a while. Things are not as bad as everybody had anticipated and not slowing as much as everybody thought. We look great on GDP that we're going to kind of hang in at that 2.8, 2.93%. And so the Fed has to be looking at this saying, I think we'll take a rest. So and the market is at peace with that at this point.
Back near record highs.
Yep. I've looked. It's been, what's been so resilient are two aspects. Number one, the consumer remains the strong pivot of job creation in America, unemployment under 4%, and continuing to spend on a healthy basis. And yet we're being thrown that bone on trade. We're being thrown that vision of maybe getting a deal over the next few years because we've got this stage one maybe coming on the 17th. I know it's a tertiary deal, it's mostly financials, it's not really IP and it's not really access to their markets, but it's better than nothing and the market is willing to wait for the rest of that.
And when you look at stocks compared to interest rates, I mean, we've got the 10-year yield now at 1.8. The last time the market was at a record high in late July, it was at 2%. So just that difference could be a bullish sign for stocks.
So I called around a few desks after all the data poured out in the morning and said, has anybody changed their mind about commitment to equities? Is there anything better to invest in right now for the next 12 months? Is there any strategy that would have you go to cash? What has changed on this data set that would make you not want to stay long going into the back end of the year? There is nothing changed. You'd still rather be in equities. You'd still rather get those dividends. They're far better than going long duration on corporates or on govies. So I think we're in the pause that refreshes, but near the highs. What's wrong with that?
So how would you be positioning your investments? Because I remember the end of last year, we were talking about how high-quality dividend stocks were in vogue. Maybe tech had fallen out of favor, but maybe that's reversed now almost a year later.
It's interesting. Both have worked, because if you were willing to take the volatility provided by the high PE techs, you're back where you started. You've just had a bit of a ride. But I have stayed, my core asset holdings remain my own index, OUSA, because I own, about 138 of the S&P 500 that have the highest quality balance sheets. That's a safe place for me to live. I don't tell people how to invest. That's what I do, because I want that 2.8, 2.9% div yield I get. But I also use OGIG, which is, a huge basket of global internet players that include all the FANG stocks, and they're back up near their highs again. People want growth, but they don't want just domestic FANGs, they want international growth. And I'll tell you, the most interesting stocks that I think are in the market today are those Chinese internet giants with a hint of a trade deal, because they got slaughtered into the whole trade war stuff. They got pushed down to the lowest values they've been in a long time, and now they're coming back up with the idea that maybe we're going to get a trade deal. So we have a lot of cross currents coming from the political agenda, including our own domestic companies, but the market is waiting to see what happens next on trade.
Regulation risk when it comes to big tech. In the final 60 seconds, how do you calculate that when you're valuing some of these tech companies?
I'm getting unhappy with the idea that a politician knows how to break up a Google, an Amazon, or a Facebook. And I want to remind everybody that one narrative that has not come into the fore is Facebook and these other digital platforms are job creators in America. They create millions of jobs. My small companies would not exist without Facebook, without Instagram, without, WhatsApp, without Messenger. We need these tools to acquire customers. The last thing I want is some politician telling me how to design the product. Let the market design the product. Let the market decide what they want to spend on a Google or on a Facebook. Let us do it in a way that keeps the government out of these businesses. We don't need to break them up. That's a huge mistake. We're going to look like Europe soon. No tech companies. Do you want to look like France? There's no France book. If you want to do business in France, you use Facebook. Where'd that come from? America, because we have an environment to create great companies like that. Well, the last thing we need is some politician trying to use these platforms to get votes in an election cycle. I'm fighting back.
Although just quickly, I mean, take Amazon, for example. Do you really need Amazon Retail and Amazon Web Services under the same umbrella? I mean, would it unlock value for shareholders if you broke up some of these companies?
But the point is, IBM in the mid-'80s, I use this example all the time, was a giant, was the #1 market cap company in the world. It blew itself up. It didn't need a politician to do that. It's a shadow of itself because it missed the market. The market's changing all the time in tech. 40% of the sales of my companies come from Amazon. I do not want that platform broken up. It's working just fine. I don't need a politician to tell me how to design an American story when it's a business. Let them do their political thing and stay the hell out of this. It's working. We're creating American jobs. Stop messing with it, is my message as an investor and an entrepreneur and an operator and a supporter of tens of thousands of young people creating companies and jobs. We don't need those words. Hi, I'm from the government and I'm here to help you.
All right, Kevin O'Leary, we will leave it there. Thank you so much, as always. All right, we'll send it back to you, Akiko, in the studio.
Okay, thanks so much for that, Scott, and our thanks to Kevin O'Leary as well. As we await the Fed press conference, Jay Powell's press conference to start in about 15 minutes or so, we want to take a quick check on some of the big tickers making waves today. Now, I do want to point out when you look at the three indices so far, we have seen them climb back into the green on the back of this Fed decision, so we're tracking that as well. General Electric, one of the tickers in focus today, it is surging after reporting its third quarter results. It beat expectations on both the top and bottom line, giving investors confidence that GE's turnaround efforts may be making progress. GE seeing notable strength in demand for its aircraft parts, along with its healthcare business. Meanwhile, shares of Yum brand sliding there, down more than 6%. While meeting revenue estimates in its latest quarter, the company came up short on the bottom line. Its Pizza Hut brand underperformed specifically, and Yum also took a charge on its investment in Grubhub, which weighed down on earnings. And Johnson & Johnson is on the rise, up 2.5% there. The company disclosing that tests of its Johnson's baby powder found no asbestos in them. Late last month, AFDA test of a single bottle was found to contain trace amounts of the dangerous mineral, which triggered a recall of 33,000 bottles. Now we want to get back to breaking down that Fed decision that came down a short time ago. Calvin Schnurr is joining us now from Washington, D.C. He is Nareit's Senior Vice President for Research and Economic Analysis. He's also a former Federal Reserve economist. Calvin, it's good to have you on today. So the headline coming out of this statement here is the fact that the Fed has dropped that the line of act is appropriate, and yet the Fed still maintains that uncertainties remain on the outlook. This comes on a day where we got some softer economic data, if you will. The data that we got today, does that support the more dovish statement that just came down from the Fed a short time ago?
Well, the data this morning were actually quite important, but when you're looking at the FOMC decision today, you need to realize how unusual an environment it is to be discussing rate cuts right now. The economy is growing fairly well. The interest rates are already quite low. Unemployment rates are very low. This is not an environment when the Fed would normally be discussing rate cuts at all. The entire reason the rate cut debate came about was after the trade wars escalated in May, and that led to concerns that this wild card really could derail the U.S. and the global economy. So we've seen a couple of rate cuts, but this morning's news was really important because GDP growth ticked down just a tenth, but there was really no big drag from net exports. We saw pretty solid consumer spending, particularly on durable goods, up 7.6% annual rate. And we saw some increase in home building, residential investment. Those are the sectors that would be alarming if they were to drop suddenly, because they often fall quite a bit in a recession. So the economic news this morning really suggests that actually more than anything in the FOMC statement, the stronger economic data say that the economy can weather this trade storm without needing further rate cuts.
So, Calvin, what do you want to hear from Jay Powell during the presser, especially with the fact that they don't say it's quantitative easing, but they're once again purchasing $60 billion worth of treasuries every month. And I may be mixing apples and oranges here, but as an investor, I've got to wonder if the economy truly is as strong as we keep saying it is, given that the fact that they are doing QE.
I think you're right that you're mixing apples and oranges here. The initial QE, the large-scale purchases of assets, was intended to make financing conditions easier on the long end. That was really a monetary policy decision. What we're seeing right now really is much more of a technical matter for the clearing and settlement in the overnight markets, and you need a certain amount of Treasury collateral to carry out those deals. And what they're really doing is trying to support the market, for the clearance end of it, which is different. It's very separate from the monetary policy aspect, and we should keep that in mind.
Calvin, let me pick up on Adam's point, though. Even if that's the case, when you talk about the technicals of why this is being carried out, do you think the Fed, or at least Jay Powell, has done enough to communicate that to the market? And, to add to that, what more are we likely to hear today in that press conference in terms of the Fed's expansion of the balance sheet?
Well, the technical components are quite technical, so it's going to be difficult to convey that in a way that really satisfies everyone. What I'm looking for in a message from Chairman Powell is how much reassurance does he have that the underlying trajectory of the economy remains sound despite the impact of the trade wars. In the second quarter, we saw a big hit to growth from declining net exports. We did not see that in the third quarter, but we are seeing weak equipment investment. There's weak business sentiment due to the trade wars. I'm looking for more insights into how he weighs the strength in some pockets of the economy versus the risks of trade wars and possible escalation of those trade wars.
Hey, Calvin, looking forwards, assume we get a pause in December, then we get into 2020. We have new voting members, Kashkari from Minneapolis, Kaplan from Dallas, Mester from Cleveland. What do you think that says based on their history, that they would be, except for one of them, Kashkari, would love to see, I think, more cuts, but the other two, aren't they more, let's hold off?
That's right. And so, there could be some more argument for why you could move rates even lower. Rates are low, but the natural rate, the estimates of the neutral rate that does not affect the economy is also quite low. But again, it's ultimately going to be driven by the economy itself. If we see payroll numbers likely to be weak on Friday because of the GM strike. But after that, if we see payrolls continuing to grow at a trend pace and GDP growth somewhere in the neighborhood of 2%, then the arguments for further rate cuts is going to be quite weak in the next year.
Okay, Calvin Schnurr, appreciate you joining us from Washington, D.C. And for those who are just joining us, we are awaiting that press conference to begin at the Fed. Fed Chair Jay Powell expected to take that podium you saw a short time ago in roughly 10 minutes or so. So we will go to that live as soon as it begins. Let's bring in Yahoo Finance's Jared Blickery, who is at the Wi-Fi Interactive board. Jared, you are watching gold along with bonds.
Yeah, first stocks. Stocks have turned positive here. Dow Jones Industrial Average up 35 points or thereabouts. We had taken a dip on the announcement, and we can see that right here, but it bounced back up. Interestingly, we didn't even go as low as we did when we took that news into consideration that Chile had unilaterally canceled the APEC meeting. That was around here after the open. All in all, somewhat positive action here. If we look at bonds, 10-year T-note yield had been down about 4 basis points, went up about 1 beep, and now down again. Not too much action in the bond market, which is a little bit unusual. Usually we see bonds react more, although we still do have the Powell presser in a few minutes here. U.S. dollar index not really moved, up 1 basis point. Let's take a look at gold futures because they did sell off on the news. This is the intraday price action. We can see there's a little bit of a trend here. They sold off about $5 on the news. And then if we look at the sectors in play here in the S&P 500, we can see utilities is up the most, about 0.5%. It has led the entire day. That's as the 10-year T-note yield is down net. And then we have healthcare up about 0.2%, consumer staples, and then technology. To the downside, energy is off about 2%, and that's after the crude oil report came in a little bit bearish or more bearish than markets expected. So let's take a look at social media and see how our friends around Yahoo Finance have reacted to this. And if we take a look at that, we can see that most of the comments are basically as is. Now, here's Stephen Guilfoyle on our shows quite a bit. Talk about copy and paste. The statement virtually a carbon copy of its previous statement. Here we have Charlie Bielo analyzing the previous 84 FOMC meetings. Not one surprise. And then Vamp Capital here, wake me up when the Fed funds rate is at 0. And finally, Sam Rowe here at Yahoo Finance. When's the Trump Fed tweet coming?
Yeah, the big question on the back of the decision. All right, thanks for that, Jared. I want to bring in Tiffany Wilding and Brian Relling into the conversation. Tiffany is PIMCO's Executive Vice President and U.S. economist. Brian Relling is with Wells Fargo's co-head of Global Fixed Income Strategy. Tiffany, let me start with you. Your reaction to the statement we got a short time ago.
Yeah, so I mean, I thought this statement was actually pretty neutral. One thing that I think the markets were expecting was that the uncertainty to the outlook language that could be removed, helping to kind of signal that the Fed was going to pause in cutting rates after today's rate cut. We didn't get that. Federal Reserve members continue to believe that uncertainties to the outlook remain. But on the margin, we got maybe a little bit more hawkish language in that the Fed is now maybe not going to act as appropriate, but it's going to continue to assess the data to think about the path of policy going forward. So I think there are very marginal changes to this statement.
Well, given the fact that you just said that you could interpret this to be somewhat hawkish, Mr. Relling, James Bullard, who going into this meeting had said last week that I think we also have to consider additional insurance in the messages of the meetings ahead. If he's in approval, which he was, of this statement, is he signaling an about face for him?
I don't know. James Bullard's always been a little bit of an outlier. He, if you recall, was suggesting a couple of or a 50 basis point rate cut, rates being held instead of being increased. He's always been a little bit of an outlier. I think he's comfortable with where we're at, but by and large, I think watching what the governors do is more important than the regional presidents.
Tiffany, when you look at the market reaction, not a significant reaction, at least so far. What do you think investors are waiting to hear from the Fed chair in terms of the direction moving forward for the central bank?
Yeah, I mean, so like I said before, I think the statement was pretty neutral, and so the markets aren't reacting. I think what they're going to be focused on for the press conference is whether Chair Powell sends any signals as to, or stronger signals as to, their pausing their current rate cutting path. So, I guess our view would be that he's not going to send very many signals. He's been instead relying on the data dependence mantra throughout this cutting cycle. We think that continues, and the reason is because the uncertainties to the outlook remain. We don't think that they've declined notably, at least notably enough for him to more strongly signal a pause.
Brian, let me bring you into the conversation on that front. If we say the Fed is still data dependent, you look at the data we got today, GDP 1.9%. Core inflation, though, was up to 2.2%. Consumer spending decelerating just a bit, but it is still strong, offsetting the decline in business investment. Is that supportive of additional cuts come 2020?
Well, the whole data dependent thing is very interesting to me. I recall about a year ago they were data dependent and a long way from neutral. They essentially, threw that playbook in the trash can, decided to do some mid-cycle adjustments, even though, to your point, inflation continues to be near their targets, unemployment continues to be near their targets, and now seemingly they're comfortable pulling that playbook back out of the trash can and going back to data dependency. So it's all a bit curious to me, but it does appear that the Fed will pause here until the data would suggest otherwise. But they've misled us in the past.
Tiffany, with the pause that we are now discussing, and I think it's only a 21% chance that we get another rate cut, as the markets are telling us in December, we had priced in this rate cut already on market. So what should investors expect as we head towards the December meeting? Is it time to sell on the news?
So I think in general, we think the market is underpricing the risk of another cut in December. Now there's been a lot of optimism around the most recent trade truce between the U.S. and China. And I think that there's still a lot of uncertainty there. So certainly that reduces the risk of further escalation, but we would just highlight that the tariffs that have been implemented continue to remain in place. The tariffs that were hiked in September continue to remain in place, and we're just seeing the economic effects of that now. Furthermore, I think the trade war has been only one aspect of why U.S. growth has been slowing in certain sectors. Global growth was slowing before we had an escalation of the trade tension. So it's certainly exacerbating that, but global growth hasn't clearly bottomed yet. So we're still going to get some spillover into that. And then just finally, I think investors are over-reliant on the 90s analog for thinking about what a mid-cycle adjustment means. Now, in the 90s, that was 3 hikes and done. But the big difference between today and the 90s is that real neutral interest rates are at 2%. So the Fed had a lot more room to cut, if there were downside risks that were materializing. Today they don't have that much room, and I think that just argues maybe for a little bit more accommodation.
Tiffany, I apologize. I'm going to have to cut you off. Tiffany and Brian, thanks to you. And let's head out to D.C. now, where Fed Chair Jay Powell has taken the podium.
My colleagues at the Federal are dedicated to serving the American people. We do this by steadfastly pursuing the goals that Congress has given us: maximum employment and stable prices. We're committed to making the best decisions we can based on facts and objective analysis. Today, we decided to lower the interest rates for the 3rd time this year. We took this step to help keep the U.S. economy strong in the face of global developments and to provide some insurance against ongoing risks. As I will explain shortly, the policy adjustments we've made since last year are providing, and will continue to provide, meaningful support to the economy. We believe that monetary policy is in a good place. The U.S. economy is in its 11th year of expansion, and the baseline outlook remains favorable. The overall economy is growing at a moderate rate. Household spending continues to be strong, supported by a healthy job market, rising incomes, and solid consumer confidence. In contrast, business investment and exports remain weak, and manufacturing output has declined over the past year. Sluggish growth abroad and trade developments have been weighing on those sectors. Looking ahead, we continue to expect the economy to expand at a moderate rate, reflecting solid household spending and supportive financial conditions. The job market remains strong. The unemployment rate has been near half-century lows for a year and a half. The pace of job gains has eased this year, but has remained solid. We had expected some slowing after last year's strong pace. Participation in the labor force by people in their prime working years has been increasing, and wages have been rising, particularly for lower-paying jobs. People who live and work in low and middle-income communities tell us that many who have struggled to find work are now getting opportunities to add new and better chapters to their lives. This underscores for us the importance of sustaining the expansion so that the strong job market reaches more of those left behind. Inflation continues to run below our symmetric 2% objective. Over the 12 months through August, total PCE inflation was 1.4%, and core inflation was 1.8%. Inflation pressures remain muted, and indicators of longer-term inflation expectations are at the lower end of their historic ranges. We're mindful that continued below-target inflation could lead to an unwelcome downward slide in long-term inflation expectations. However, against the backdrop of a strong economy and supportive monetary policy, we expect inflation will rise to 2%. Overall, we continue to see sustained expansion of economic activity, a strong labor market, and inflation near our symmetric 2% objective as most likely. While this has been our outlook for quite some time, our views about the path of interest rates that will best achieve these outcomes have changed significantly over the past year. As I mentioned, weakness in global growth and trade developments have weighed on the economy and pose ongoing risks. These factors, in conjunction with muted inflation pressures, have led us to lower our assessment of the appropriate level of the federal funds rate over the past year. In both July and September, we reduced the target rate for the federal funds rate by 1/4 percentage point and we did so again today, bringing the range to 1.5 to 1.75%. The policy adjustments we've made to date will continue to provide significant support for the economy. Since monetary policy operates with a lag, the full effects of these adjustments on economic growth, the job market, and inflation will be realized over time. We see the current stance of monetary policy as likely to remain appropriate, as long as incoming information about the economy remains broadly consistent with our outlook of moderate economic growth, a strong labor market, and inflation near our symmetric 2% objective. We believe monetary policy is in a good place to achieve these outcomes. Looking ahead, we'll be monitoring the effects of our policy actions along with other information bearing on the outlook as we assess the appropriate path of the target range for the Fed funds rate. Of course, if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Policy is not on a preset course. Let me end with a few words about our technical monetary policy operations. In January, we made the key decision to continue to implement monetary policy in an ample reserves regime. In that operating framework, we control the federal funds rate primarily by setting our administered rates, not through frequent interventions to actively manage the supply of reserves. In the transition to the efficient and effective level of reserves in this regime, we slowed the gradual decline in our balance sheet in March, and we stopped it in July. In response to the funding pressures in money markets that emerged in mid-September, we concluded that it would be appropriate to maintain over time a level of reserve balances at or above the level that prevailed in early September of this year. To achieve this ample level, we announced on October 11 that we would purchase Treasury bills at least into the second quarter of next year, as well as continue temporary open market operations at least through January. These actions are purely technical measures to support the effective implementation of monetary policy as we continue to learn about the appropriate level of reserves. They do not represent a change in the stance of monetary policy. In particular, our Treasury bill purchases should not be confused with the large-scale asset purchase programs that we deployed after the financial crisis. In those programs, we purchased longer-term securities to put downward pressure on longer-term interest rates and ease broader financial conditions. In contrast, increasing the supply of reserves by purchasing Treasury bills only alters the mix of short-term assets held by the public and should not materially affect demand and supply for longer-term securities or financial conditions more broadly. Thank you. I will be happy to take your questions.
Michael McKee with Bloomberg Radio and Television. So I guess the question is this it? Do you consider rates to be accommodative enough now to achieve your goal of sustaining the expansion? And as far as Global Wall Street's primary question, what kind of change in the economy would cause you to reassess? Some sort of significant deterioration in what?
So what we've said, to repeat, is that we see the current stance of policy as likely to remain appropriate as long as incoming information about the economy remains broadly consistent with our outlook. And we say that really because both of the performance of the economy and the stance of policy. The performance of the economy has been, particularly the household sector, has been strong, has been resilient, with low unemployment, attractive levels of job creation, wages moving up, labor force participation moving up, household confidence, and solid gains in many measures of consumer spending. The manufacturing sector, particularly manufacturing and also investment in exports, have been weaker, but overall we've seen moderate growth, a strong labor market, inflation moving up. We see the outlook as for more of the same. We also see the risks to the outlook as perhaps having moved in a positive direction over the course of this intervening period, although some things remain to be seen. So that's the economy. Turning to policy, we've moved the stance of policy over the course of the year to a more accommodative stance. And after cuts at the last three meetings, the federal funds rate is now in a range between 1.5% and 1.75%. We feel that policy is well positioned to support the outlook that I described. So you ask what it would take, to move, and as I mentioned, we're going to be watching all factors, And if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. But that's what it would take, a material reassessment of our outlook.
If I could follow up, if the markets decide that you need to cut rates again, will you be forced to follow?
We'll be looking at a full range of data about the economy and about the risks to the risks to the outlook. And I've given you a sense of what our outlook is. It's for moderate growth, a strong labor market, and inflation near our 2% objective. If something happens to cause us to materially reassess that outlook, that's what would cause us to change our views on the appropriate stance of policy.
Heather? Hi, Heather Long from the Washington Post. You just said that the risks to the outlook are moving in a positive direction. I'm wondering if you could specify, is that on trade or there are other matters? This morning, we obviously learned that we've now had 2 quarters of contracting business investment, which would seem to be moving the outlook in the other direction.
So in terms of risks, what I was referring to there, the principal risks that we've been monitoring have been really slowing global growth and trade policy developments, as well as muted inflation pressure. So I was really referring there to trade developments. We have that phase 1 potential agreement with China, which, if signed and put into effect, could have the effect of reducing trade tensions and reducing uncertainty, and that would bode well, we think, for business confidence and perhaps activity over time. So that has the potential for being an improvement in the risk picture. Brexit, I would say as well, it appears that the risk of a no-deal Brexit seems to have materially declined. I think on both situations, there's plenty of risk left, but I'd have to say that the risks seem to have subsided. You ask about business investment. And that's right. Business investment has been weak, and today's reading was weak as well. And it was broad across equipment and other parts of all parts of business fixed investment were weak. That's consistent with what we've seen. But that's the economy we've had this year. What we've had is an economy where the consumer is really driving growth, and personal consumption expenditures were almost 3% in this quarter, in this first reading for the quarter. So overall, we see the economy as having been resilient to the winds that have been blowing this year.
Can I just follow up quickly? I mean, there's this concern that I sometimes hear that with businesses have cut investment, and are they going to turn around and cut employment? Sort of if they continue to be concerned. Can you give a sense of how the committee is thinking through that possibility?
Yes, so that is a risk. That's a risk that we've been monitoring, but we don't see it yet. We don't see rising initial claims or layoffs or anything like that. But the risk you mentioned of the weakness in the manufacturing and export and business investment parts of the economy getting into the consumer side of the economy, we really don't see that. What we continue to see is good job creation. Unemployment has declined again, and the household survey is now at a 50-year low, has been at very close to 50-year lows for 18 months now. So it's a very positive. The consumer-facing companies that we talk to in our vast network of contacts report, that consumers are doing well and are focused on the good job market and rising incomes, and that's their principal focus. So that is the thing that's pushing the economy forward, and it doesn't seem to have been affected so far by weakness in the other areas.
Gina Smilik, New York Times. Thanks for taking our questions. So you've previously sort of compared this rate cutting cycle to the insurance cuts in the 90s. And in both of those instances, the Greenspan Fed took those cuts back after a while. They raised rates again fairly quickly. And I guess I'm just curious what the onus is for doing that in this cycle. What would make you guys decide it's appropriate to raise interest rates again?
So the reason why we raise interest rates is because, generally, is because we see inflation as moving up or in danger of moving up significantly. And we really don't see that now. Inflation moved down in the first quarter of this year. We thought that was due to some extent to idiosyncratic or transient factors. That turns out to have been the case, so it's moved back up. but it seems to be settling in below 2%. So we really don't see that risk. Inflation expectations have also kind of moved down and sideways, both surveys and market-based over the course of this of really the recent months. And we think that inflation expectations are very important in driving actual inflation, and we're strongly committed to achieving our 2% inflation objective on a symmetric basis. We think it's essential that we do that. So we're not thinking about raising rates right now. There obviously will be times in the future where that will be appropriate. What we're really thinking now is that our current stance of policy is appropriate and will remain so as long as the outlook is broadly in keeping with our expectations.
Mr. Steve Leisman, CNBC. Mr. Chairman, I'm not to make light of it, but I'm a little bit, I don't know if you can help me out with the appropriate understanding of the word appropriate here. So the statement says that the committee is going to monitor the implications of incoming information for the outlook as it assesses the appropriate path of the target range. That tells me you could go either way. You came in and you used the word appropriate, that the current rate is likely to remain appropriate, which means you're on hold. So how do I walk away from this, or what should we walk away from this believing of what appropriate means? Are you on hold and need to be proved wrong that you should remain on hold, or is it really you could go either way here? Thank you.
So we think that the current stance of policy is likely to remain appropriate, as long as incoming information about the economy is broadly consistent with our outlook, which is a positive one of moderate economic growth, strong labor market, and inflation moving close to 2%. That's what we're saying about that. We also say, of course, if developments emerge that cause a material reassessment of that outlook, we would respond accordingly. So that's really how we're thinking about it. I can't point to one data point or one thing that would change our minds. It would be a reassessment of a material reassessment of our overall outlook, which is what I described.
Sorry, just to follow up. Why isn't the phrase likely to remain appropriate in the statement if that's the sense of the committee?
Well, there's a lot of practice and science and history in terms of how much you put in the actual post-meeting statement as opposed to what we say in the press conference statement. It's a judgment call. I'm saying it now. So.
Thank you, Nick Timmeros with the Wall Street Journal. You described the recent slide, Chair Powell, and inflation expectations as unwelcome. You said that inflation expectations are very important. What, if anything, would the committee be prepared to do to address this slide in inflation expectations if it continued?
So, as I mentioned, we do think that inflation expectations they're quite essential, quite central in our framework of how we think about inflation. We need them to be anchored at a level that's consistent with our symmetric 2% inflation goal. We think that we need to conduct policy in a way that supports that outcome. That's what we're doing now. We're also, as part of our review, looking at potential innovations, changes to the way we think about things, changes to the framework that would lead us, that would be more supportive of achieving inflation on a symmetric 2% basis over time. That's at the very heart of what we're doing in the review. It's too early to be announcing decisions. We haven't made them yet, but we're in the middle of thinking about ways that we can make that symmetric 2% inflation objective more credible by achieving symmetric 2% inflation. And it comes down to using your policy tools to achieve 2% inflation. And that is the thing that must happen for credibility in this area. So we're committed to doing that.
Do you think that review might be announced to the public?
So we're in the middle. We're really quite in the middle of it now. And my thinking is still that it will run into the middle of next year. These changes to monetary policy frameworks they don't happen really quickly, let's say. Inflation targeting took many years to evolve. I don't think we'll take many years here. I think we'll wrap it up around the middle of next year would be my guess. I have some confidence in that.
Edward Lawrence with Fox Business. Thank you, Mr. Chairman, for taking this. So how big of a change then to monetary policy would there be if you get some of that uncertainty cleared up, specifically the Phase 1 China trade deal finished and USMCA ratified? How big of a change could that be to the monetary policy as it stands here? And could we see rate cuts next year? Or rate hikes next year, I'm sorry.
Rate hikes for next year.
Yeah, because I've heard the argument that trade's causing the uncertainty is keeping the prices low. I've heard that argument from a Fed president from one of the districts. So you remove that uncertainty, prices then would naturally rise. So then could there be a point, or I guess my question is, how big of a impact on monetary policy would removing that uncertainty?
So I would just say that if we were to have a sustained reduction in trade tensions, broad reduction in trade tensions, and a resolution of these uncertainties, that would bode well for business sentiment, which is trade uncertainty has been weighing on business sentiment in our judgment and the judgment of many analysts. And ultimately, it could affect activity. I wouldn't expect that the effects on activity or confidence would be immediate, or would there be immediate effects in economic activity. I think it would take some time after the recent things, but I do think it would be quite positive over time. You come back to the question of raising rates, so that's really about inflation. And we haven't yet, we just touched 2% core inflation, to pick one measure, just touched it for a few months, and then we've fallen back. So I think we would need to see a really significant move up in inflation that's persistent before we even consider raising rates to address inflation concerns.
Brendan Greeley, the Financial Times. The other thing you've talked about in this review is the gains that a super high pressure labor market have, particularly for the communities that you're talking about. You mentioned it just now when you were talking. If that's something that you're identifying and that's something that the Fed is learning more about this year, why not continue to push those gains, particularly for people who are reentering the labor force?
Well, I think we're doing that. I mean, I think we're keeping. I think we've made very substantial adjustments to policy over the course of this year. If you think about it, we entered the year expecting some further rate increases. We went to patient. Now we've done 3 rate cuts. It's a very substantial shift, and the effects of it will be felt over time. So we feel like that those shifts are appropriate to support exactly the outcomes you're talking about, which are a continuing strong labor market, continuing strong job creation.
So if you were to describe the shifts that you've made so far, it wasn't just about trade uncertainty. It was about specifically these kinds of high-pressure labor gains that you've talked about.
Well, no, it was. So we've said it was about 3 things. It's been about the slowing global economy. You have a synchronized slowdown in economic activity around the globe. It's been building for just about 18 months now, and that's having an effect on U.S. activity. That's part of the weakness in manufacturing, export, and business investment. We've had trade policy uncertainty, which we think also has been weighing on activity and investment and sentiment. And we've had inflation, which we've called out the risk of inflation running persistently below 2% as a risk that we needed to address. So we've been doing it to address all of those things. I would say the gains in the labor market have been great to see. It's particularly the fact that people at the lower end of wages have been getting most of the benefit of most of the wage gains in the last couple of years. That's a great thing. You know from our Fed Listens events that we've been hearing from people who live and work in low and moderate income communities that this is the best labor market they've seen in their lifetime, things like that. And by the way, that there's still so many people who are still not in the labor market yet, and that there's just a lot more good that can be done there. At the same time, we have to think about the whole economy. And but yes, those gains are very positive. We do call them out. They are a reason for us to want to extend the expansion, and that's something we're committed to doing.
Victoria. The Fed's balance sheet, you all recently resumed purchases of Treasury bills. And I was just wondering, how long do you expect that to continue? And given the fact that, the repo operations, it seems like the Fed is having to increase the amount of liquidity, temporary liquidity that it's injecting into the system. Do you still feel like it's just that there is not enough reserves in the system? Do you feel like you have a good sense of what's going on there?
Okay, so on how long, what we said is that we expect bill purchases to continue at least into the second quarter of next year. And we said that temporary open market operations we expect to continue, I think, at least until the end of January, I believe. Yeah, the end through January. In terms of the causes, so there's a lot of forensic work going on by us and by market participants and all kinds of analysts. And one thing is that we think we need reserves to be back up to the level, the minimum level of reserves that we can have during the various fluctuations that you see with reserves is something like 1.45 trillion or a little higher, and that's the level in early September. So we're going to be adding reserves to get back to that place. That's one thing. There are also it may be one thing that was surprising about the episode was that liquidity didn't seem to flow as one might have expected. We had surveyed the banks carefully about what was their lowest comfortable level of reserves, and many banks that were well above that level did not take that excess cash and invest it in the repo market at much higher rates. They didn't do that. And so the question is why, and are there things that we can do that adjustments that we could make that would allow liquidity to flow more easily in the system without in any way sacrificing safety and soundness or financial stability. So we're looking at those. Those are not things that can happen, that can really address the situation in the short term, but those are a range of things that we're looking at as well.
Howard Schneider with Reuters, and thanks for the questions. I wonder if you could give us a little more texture on sort of what the strongest or most important case is for feeling that you've now taken out adequate insurance. Is it the response you're seeing in housing and other parts of the economy, arguably, to the cuts made so far? Is it the fact that the risk environment out there globally has shifted a bit and abated a bit? Or is it something different, in the financial markets, the fact that the yield curve has righted itself, et cetera?
Honestly, it's really there isn't any one factor. It's really the whole range of economic data, and also what we see as about our stance of policy, which we believe is the appropriate stance. It's really both of those things. Again, if you look at the performance of the economy through this, the consumer sector has been quite resilient. Witness today's GDP report. And it's just, again, all the things I went through earlier suggest that sector continues to be strong. We know that the manufacturing, investment, trade, export sector has been weak. That continues, but nonetheless, overall, we've got an economy that is showing moderate growth. And we think that today's setting, we're now at 1.5 to 1.75%. That is, we believe, an accommodative level and a level that will support that outlook that we have.
Really, this is kind of a one-legged recovery, that unless you get some impetus from other things, exports, investment, that it's going to weaken further at some point?
We don't see any evidence of that. What we see is that the consumer sector continues strong. Again, low initial claims. It's all the data we monitor. Obviously, a very broad range of data. We also see now, I think, more clearly the effects of more accommodative monetary policy on various kinds of consumer activity. You're seeing strong durable goods sales. You're seeing housing now contributing to growth for the first time in a while, 0.2, I think, this quarter. And you're seeing retail sales. The retail sales number, the PCE number, as I mentioned in today's release, was 2.9%. So that's good. And I think more broadly, monetary policy is also supporting household spending and home buying by keeping the labor market strong, keeping workers' incomes rising, and keeping consumer confidence at high levels, where it currently is.
Okay, Scott Horsley, here.
Thank you, Mr. Chairman. You're just talking about how the lower rates have affected consumer behavior. Is there a concern that there's just less potency on the business investment side, that you're, in effect, pushing on a string?
Well, I think monetary policy works through the channels that we understand. I think the effects are clear in what we think of as the interest rate sensitive sectors, which are some of the ones that I mentioned. I think interest rates are a factor in business investment, but I don't believe they're the main factor, a main driver. And I think, what one would like to see to support greater manufacturing activity, business investment, and exports would be a global recovery. And, there's a lot of monetary policy accommodation and some fiscal accommodation, maybe, in the global economy now. Not here, but perhaps elsewhere. And that should support growth in the global economy. And again, resolution of our trade issues would contribute to that over time as well.
Chris.
Thank you. Chris Rugaber at Associated Press. You mentioned Fed Listens a couple of times and what you've heard from people there about how it's benefited disadvantaged or lower income workers, the hot job market we have. Has the Fed thought about institutionalizing something like Fed Listens and maybe taking in some of this input from people that you don't always hear from? Things like the Beige Book focus on businesses. Has there been thought of bringing in folks, say, from community groups more regularly? Thank you.
We think that Fed Listens has been a great success for us, and I'm sure we will repeat it. In fact, I would imagine that this entire monetary policy review will become institutionalized and be done every few years. I would say this. In the Beige Book, we talk to educational institutions, healthcare institutions, community groups, labor groups. It's not just businesses. And by the way, all of those groups are also represented on the boards of our regional banks. We also meet quite regularly at the board with representatives of low and moderate income communities. And so we're very conscious of, that we represent all Americans and we need to hear all of their perspectives. That's why we talk about how low the unemployment rate is, the aggregate unemployment rate, but we also talk about groups that haven't experienced that yet. And so we try to remind ourselves that we serve everybody.
Steve Matthews.
Steve Matthews with Bloomberg. You mentioned housing and today's GDP data. When you look at that, do you believe that you have achieved a soft landing or are achieving a soft landing in the sense that we're moving to trend growth for the rest of the year and next year?
So that is our outlook overall is for moderate growth of around 2%, which is pretty close to trend. That's our outlook. Could be better, could be worse. You never say you've achieved it, but that's our outlook. And we feel like our current stance of policy is appropriate as long as that remains broadly our outlook.
Donna, and then Greg.
Donna Borak with CNN. Chair Powell, setting aside market expectations for today's rate cut, obviously 97% sort of expected that this would happen today. Can you tell us a little bit more about the rationale behind moving at this particular meeting as opposed to waiting 6 weeks and cutting in December? And if there was any discussion about that around the table? Thanks.
Yeah, I think this seems to be the right movement. You can see that we had our usual range of perspectives, range of views, but in the end we had a strong vote in favor of this action. I strongly believe it's the right action. I strongly believe that the actions we've taken over the course of this year have been the right things to do for this economy and are supporting economic growth and will do so in the future.
Okay, Greg.
Thank you. Greg Robb from MarketWatch. Chairman Powell, it seems that the differences all across the country, that there different regions are reacting differently to the China trade, and some regions are much weaker than others. There's this urban versus rural divide, the coasts versus the middle of the country. How does that factor into your policy decisions?
Monetary policy is famously a blunt instrument, so we can't raise interest rates someplace and lower them other places. But we're very conscious. The first thing to know is to understand that and we've called that out, as you I'm sure know, in one of our recent monetary policy reports to Congress, the sort of rural-urban disparities in employment, in growth, in all kinds of things, in health outcomes. It's a big and growing set of differences. We don't really have the tools to address that, but we call things out that are important to our economy that we may not have the right tools to best address them. But we call them out because, we're spending all of our time with the economy, and those are issues that maybe have to be addressed by legislatures and, at the national level and at the state level.
Don,
Oh, could I
and then
follow?
Virginie.
Sorry, could I follow? Quick, sorry. Just so are you asking Congress to do something now, or will you ask them to do something down the road? Thank you.
I'm not asking Congress to do anything right now. I sometimes have noted that it would be appropriate. I put it this way. We do what we do, which is we're assigned a job, which is maximum employment and stable prices. We do financial stability. We do bank regulation. The U.S. economy faces significant longer-term challenges around potential growth, around labor force participation, around disparities of income and wealth, around all kinds of things. And those are issues for Congress. They're not issues for us. But if you really want the U.S. economy to be all it can be and raise the potential growth rate of the United States, you need proper monetary policy. But really, it isn't monetary policy. Really, it's fiscal policy that supports, inclusive growth.
Don Lee with the LA Times. I think you said, Chair Powell, that the primary positive development in risk to the outlook was on trade, and specifically the prospects for a phase one agreement with China. But given the ups and downs of the trade dispute and that several truces and tentative deals have fallen through, are you concerned about developing monetary policy guidance, if you will, that's dependent on good part on the wins of the trade negotiations?
Yeah, I don't. That's not how I would characterize it. I noted that it may be that there's been progress there toward away from bad outcomes and confrontational outcomes, and it seems like there's the makings of a possible settlement there. I didn't say we're baking that in or anything, but I'm just noting that that's the case. As with Brexit, it's still quite uncertain what will be the result of the election and what the ultimate result will be. But I would say that the tail risk of a non-negotiated, no-deal Brexit seems to have decreased. Just as I would say that the situation in our trade negotiations with China seems to have taken a step closer to resolution. That's all I'm saying.
If the phase one agreement then doesn't work out, then would we be back at making monetary policy that would?
That's one factor among many factors that factor into our assessment of the outlook. And if things happen that cause us to materially reassess the outlook, change our assessment of the outlook in a material way, then we would act accordingly.
Virginie and then Paul.
Virginie Montet with Agency France Press. Thank you. The Fed has pointed out many times in the past the rising inequality over those past decades and how that could be a factor behind a sluggish growth. In light of the recent outcome of the strike at General Motors, do you see the union having a role to play, helping to raise lower and middle incomes and promoting more shared growth on the long run?
So not for us to say what the appropriate labor arrangements will be. I will just say on the General Motors strike, it's likely to have taken away a couple of tenths of growth this quarter. That's likely to come back maybe over the first half of next year. And I think it's good to see it settle. But I'm not going to comment on what the appropriate labor arrangements are. That's a little bit far afield from our task here. Thank you.
Thank you, Chairman. Paul Kiernan from Dow Jones Newswires. Oh, I was wondering what that was. Paul Kiernan from Dow Jones Newswires. Thank you. Thank you, Chairman. Wondering if you would categorize the current stance of monetary policy as accommodative, or if it's just, that neutral was lower than we thought at this time last year. Secondly, we're now 2 years removed from the Tax Cuts and Jobs Act, and the economy is growing at about the same pace it was before, 2%. So given your mention of fiscal policy and the role it plays in supporting long-term growth, is it fair to say that the Tax Cuts and Jobs Act worked the way it was supposed to? Thanks.
Sorry, say again what your first question was. I wrote it down, I can't remember.
Sorry, if policies data right now.
Yes, okay.
Thanks.
So if you look at where the federal funds rate is trading, it should be in the middle or maybe the lower half of the range of 150 to 175. So that means the real rate is probably modestly below zero. I think my own sense would be that that's somewhat accommodative policy. I would say, though, that there's a range of plausible estimates of what the neutral rate of interest is, and I think many of those who make such estimates have moved their estimate down over the course of many years, and that process continues. But nonetheless, that seems to me to be very likely to be an accommodative stance of policy, and an appropriate stance given the situation we're in with continuing downside risks and that I mentioned. So.
Okay, Jean?
Hi, Jean Young from Market News. I wanted to ask about financial stability risks. Recently, the IMF and some other global policymakers have been expressing concerns over the high level of risky corporate debt. So as rates get lower in the U.S. and around the world, are you more worried about financial stability risks and reach for yield?
So we monitor financial stability risks very carefully all of the time. It's what we do since the financial crisis, as I've mentioned before. Currently, we don't see large imbalances. This long expansion is notable for the lack of large financial imbalances like the ones we've seen certainly before the crisis happened. So we have a four-part framework I'll quickly mention. The first is leverage in the financial system, which is low by historical standards. The second is funding risk, which is the risk of runnable funding, and that risk is also quite low for banks, but also for the non-banking financial sector. If you look at asset prices, we see some high asset prices, but not broadly across a range. We don't see bubbles and that kind of thing. Then that leaves the fourth, which is leverage in the non-financial sector, and that's households and businesses. So with households, again, we don't see leverage. We see them actually getting in very good shape financially in the aggregate. Obviously, plenty of households are not in great shape financially, but in the aggregate, the household sector is in a very good place. That leaves businesses, which is where the issue has been. Leverage among corporations and other forms of business, private businesses, is historically high. We've been monitoring it carefully and taking appropriate steps. So that's what I would say. But corporate debt is one part of a larger part of our framework, and it is something that we're paying quite a bit of attention to. And it's been part of the last couple of shared national credit exams, and we've been monitoring it carefully and taking appropriate action.
Nancy, and then now Sue.
Hi, Nancy Marshall-Genzer with Marketplace. Have the problems in the repo market led you look into whether the liquidity and capital requirements for banks are too high? Is that something that the Fed might review?
So I think the most important basic thing is to get the level of reserves back up so that reserves move up and down with some volatility. We don't want them to move below the level they were at in the beginning of September, which is, again, between 1.45 and 1.5 trillion. That's the main thing. That's the first thing. And we're on a path to do that between our temporary open market operations and also our bill purchases. In addition to that, we're looking at it's a big, complicated marketplace, and there was one of the surprises, as I mentioned, was that banks that had told us that their lowest comfortable level of reserves was here, they were well above that, and yet they didn't deploy that liquidity when there seemed to be great opportunities to do that. That didn't happen. So why is that? And so we're doing careful analysis of that. You ask, would we lower capital or liquidity requirements because of this? I don't think so. I don't think that's where this goes. I think where it may go, though, is to look at, for example, intraday liquidity, which used to be a common thing. It used to be a common thing for banks to have intraday liquidity from the Fed, what are called daylight overdrafts. That's something we can look at. Also, there are just a few technical things that we can look at that would perhaps make the liquidity that we have, which we think is ample in the financial system, move more freely and be more liquid, if you will. And those are things we would do, but only if we can do it without compromising safety or soundness or financial stability.
Now to.
Thank you very much, Chairman Powell. Now it's Aoyama from the Asahi Shimbun, a Japanese newspaper. Given this sustained level of low inflation, even in this country, do you think there seems to be a higher possibility that lower inflation expectation will remain going forward? So do you think a Japan-like situation or Japanification of chronically low inflation and interest rates, the U.S. is getting trapped by the Japanification of this situation? Do you think so?
So we of course, have watched the situation in Japan and now the situation in Europe, and we note that there are significant disinflationary pressures around the world, and we don't think we're exempt from those. But of course, if you look at our current inflation performance, it hasn't been anything like what we've seen in those other places. But we don't think we're exempt from those pressures, and we are therefore strongly committed to having inflation expectations anchored at a level that is consistent with a symmetric 2% inflation objective. That's what we're committed to, and we'll use our tools to achieve. So we take the risk very seriously. The risk isn't that inflation might run a couple tenths below 2%. The risk is that what we've seen is other economies getting on a disinflationary path that it's been very hard for them to get off. Once inflation expectations start sliding down, inflation moves down, you have the interest rates move down as well because there's an inflation component in interest rates. And we think the right thing to do is to do what we can now to hold and really move inflation expectations up so that they're squarely and firmly anchored at a level that's consistent with 2% inflation.
Okay, Brian?
Hi, Brian Chung with Yahoo Finance. Another type of balance sheet question, but not necessarily focused on the repo crunch. There was a discussion before that maybe we should move, or rather the Fed should move to a more neutral balance sheet, trying to remove some of the agency mortgage-backed securities that are on the balance sheet and maybe replace them with shorter-term treasuries. I haven't really heard an update on the composure or the composition of the balance sheet for right now. I'm just wondering if the Fed is actively thinking about that right now, and if so, when we might expect to hear something on that.
It's an issue, but it's not an issue that we're currently working on or reaching a decision or anything like that. The question of the longer run maturity composition of the balance sheet is a big one, and it's one we'll return to over time, but not imminently.
Okay, Vivian with the BBC for the last question.
Chairman Powell, this morning the President tweeted that we're seeing the greatest economy in American history. I just wondered, as the chair of America's central bank, what you made of that characterization.
I am going to maintain my longtime practice of not commenting on anything any elected official would say. But thank you.
Thank you.
Thanks very much.
And that was Federal Reserve Chair Jerome Powell wrapping up a press conference in Washington, D.C. The Fed cutting interest rates as expected by another quarter point. This marks the third rate cut this year. Chair Powell characterizing the cut as insurance against ongoing risks. The big question now, what is next? More cuts or a pause? With me to break it all down, of course, my co-host, Miles Udland, Yahoo Finance editor-in-chief Andy Sturwer, and UBS economist Rob Martin. And it was the very first question that the chair faced. Is this it? A lot of focus right now on what they've changed in the statement. Yeah. Act as appropriate is gone. Now we're assessing the appropriate path. Yeah. Is that accommodative? Is that a pause? What do you take from everything he said?
I think the Fed probably would like to be done at this point. I mean, I think, what Brian Chung and myself have written about the last couple of days is sort of this notion of the Fed looking to history as its guide, and specifically 1990s history, because there were two episodes during the 90s, 95, 96, and then in 1998, where the Fed cut rates and then waited, and then things happened, and guess what? We had a great economy throughout the 90s, and, I don't know if the Fed believes we can recreate that, but certainly, and Powell said it a couple different ways, they believe their current actions have aided this economy in continuing to grow. And the Fed right now believes that they are able to pull a few different levers, especially as it relates to the consumer, to get this economy growing, for a more extended period of time. And so I do think that they're probably going to wait after this, because there are, again, two episodes where Fed cut 3 times and then waited. And it feels like they want to do the same.
I mean, I would say I agree with that exactly, right? And I think the key words to me were in his press conference himself. He said that they're providing significant support, that support is likely to remain appropriate for some time, and that it would take a material change in their, oh, he liked that word, didn't he? Yeah. A material change in their outlook before they would do anything else. I think they're back to forward guidance, only this time forward guidance was flat going forward.
And even more specifically saying that it would have a really significant rise in inflation, basically, here to hike. Andy, we've been talking about deflation. Nothing seems to be going on with inflation. So even if there's questions around the appropriate path and what's happening with another cut, they are not looking at hiking anytime soon based on what he just said. Would you agree with that?
I would agree with that. And, obviously, where I stand on inflation. There is none. Keep looking, you're not going to find it. But, it's interesting to me, and I think that, okay, I'm starting to come around a little bit, you guys, with the notion that the global economy is slowing, certainly. I mean, I think the most important, there are so many things happening today, GDP and jobs, but I think the most important thing was the IMF lowering the forecast for 2019 for global growth down to 1.9%, the lowest since the Great Recession. Yep. And to me, that, they might not want to admit it, but that's the number they were really pretty keenly focused on. Maybe not focused, but that was there. And then, of course, the print today for Q3 GDP at 1.9%, also higher than 1.6 expected. But still, the trend is slowing. So, okay, preemptive, I'm not a fan, but at least I get it. Yep. Makes sense.
Well, certainly the stock market has been pleased with what Jay Powell said. I think, Jen, really kind of jumping on those comments about what it would take for the Fed to raise interest rates. For more on today's market action, let's go to the floor of the New York Stock Exchange, where we will find Yahoo Finance's Scott Gamm. Scott.
Hey there, Miles. Well, yeah, I would echo some of the items you were just talking about, the appropriate language in the statement. There was a lot of uncertainty there just from what we saw written in the statement and then the comments that Powell made afterwards. It seems like some of the reporters in the room were frustrated that the statements from Powell and the items written in the statement were not exactly in sync. And you might think that there would have been a market reaction to that, but no. In fact, we've got stocks getting a little bit of a late session bid right now, with the S&P 500 crossing 3045, the Dow nicely above not just 27,000, but 27,100. Now, if you back up a bit, just prior to that 2 p.m. release, the 2 p.m. statement, you saw declines in the financial sector. It was actually the second worst performing S&P 500 sector. But then, as the conference went on later in the session, you saw the banking sector pair almost all of those losses. We've now got the XLF, that's a financial sector ETF, largely flat. Now, it's a little bit tricky to kind of understand this, but rate cuts tend to thin the net interest margin of the banks. But on the other hand, those rate cuts that we've seen over the past couple of months have uninverted the yield curve, and that's good for banks. You need some sort of steepness in the yield curve for the banks to make money, even if the absolute levels of the yield curve are at a lower basis. Now, we're also keeping an eye on the tech sector, which is getting a bid right now, although Apple shares are still slightly in the red. By the way, Apple is one of those names that tends to be a Fed-sensitive name. That is, when you get a dovish Fed, Apple shares tend to get a boost, as with some of the other FANG names as well. But then again, you do have Apple's earnings in just about an hour from now, so that's kind of the big catalyst or the big hangover for Apple shares, at least for today. guys.
All right, Scott Gamm live on the floor of the New York Stock Exchange. And, Rob, something that Chair Powell brought up a lot, which is a theme we've discussed here, and I think because the stock market has suggested it's true, which is that this is all about the consumer right now. We're sort of betting, we're leveraging everything, all economic growth, all future prosperity on consumers continuing to do what they do. Powell mentioned that a few different ways. Do you think that that's the right way to think about the economy in a sense where you downplay the risks that I think we all know exist in the corporate sector, but then play up the strength that the U.S. consumer and the U.S. labor market continues to show?
I think it's exactly the opposite wrong way to look at the U.S. economy. So it's true. It's true. Consumers are 70% of the U.S. economy. And so if consumption is growing robustly, then so is GDP growth, period, full stop. But where are those consumers getting money to spend? It's from employment. It's from their jobs. And so when he's talking about business investment here, remember, he's not just talking about manufacturing investment. He's talking about a broad pullback in the desire to invest if that translates into a desire to pull back from employment, consumption will not hold up. That's what we see in every downturn.
So then I guess in your view here, and it's a point that I have tried to make, but I'm not an economist, so I don't know if it kind of carries as much weight, but it really comes down to, are people getting jobs? And as long as they get jobs, things will be fine. But the chief risk is that a pullback in investment leads to a decline in overall employment.
That's exactly right. Firms pull back where it's easiest first. And so the first thing that it's easy to do is not buy a new computer, is not to put a new piece of equipment in. It's hard to fire people. It's hard to lay off. It's even hard to pull back from employment. And so there's a general order to these things. And so I agree. So from now on, you can say that that's an economist certified statement.
But it's interesting, you guys, because it sort of speaks to this whole thing we've been dancing around, which is what is the Fed looking at specifically? How are they measuring? Because right now, and it's important, it's always important, but maybe a little bit more right now because we're at a set it and forget it moment, right? Because now, okay, we've done our work, so we're going to see what happens. Well, what are you looking at? What exactly are you measuring? And remember, it's this preemptive, so things aren't going to get worse. Yeah. And are you looking at the consumer? You're looking at the job market. What exactly is the way you're going to decide?
I think his answer to the second question was very interesting in terms of what they were looking at geopolitically, because he dove right in. He said the words phase one, which I have not heard at a Fed meeting. Yeah. He is obviously watching what is happening with trade. He also said Brexit. He was said in the answer to the first question, we are looking, it would a material reassessment to the outlook is what we would have to see to change here. And then they pushed him on it. So what is that? And he wasn't diving into data on confidence. He wasn't even diving into the CapEx stuff. Really, things look brighter in the stuff that we've been talking about here, Brexit and trade. But those things can turn the other way so quickly.
Yeah. Oh, good luck, depending on China.
So that's the thing. Like, if you're on a phase one, if that's what you're looking at, we just had the event canceled where this is supposed to be signed.
Right.
How does that factor in?
And not only that, but remember the phase one, and what he said in the press conference just now was phase one takes off really bad things happening with trade. So basically it takes off some of the risk of escalation. It's not the be-all, end-all itself. So he's back to his confidence kick.
And this gets back to the point I've made before, which is the whole thing is self-inflicted. If not for the trade war, where would the economy be? So I've got to keep rates low so the president can do this, to my mind, crazy stuff, right? And so now I got to keep doing it. It's kind of becomes a cyclical kind of thing.
Do you think there's another rate cut coming?
So we do. So we do.
25% of the people out there, you want them, right?
Yeah, that's right here. It's all good.
There's always one.
Yeah, because there's four of us, and not right away, right? They've got their material. They've got to get to their material reassessment, right? That he's very clear that has to happen. We think that happens in Q1 and Q2. Okay. We think what the Fed's missing is two things here, right? Labor markets are solid, even though they've slowed from 200,000 to 119,000. That's a horrible number. And the retail tariffs that came on September 1st are having a big effect. We're seeing it in the trade data. We think that that's going to result in a material slowdown in Q1.
That word again. So 25% is for the December cut. So you're saying you're not actually specifically one of those people. You're saying for the next.
I'm some year. Other set of 25. Yep.
So I guess then, just quickly, in your view, is this a mid-cycle adjustment or is this a full-on rate cutting cycle cycle and the next stop. I mean, eventually this cycle would end up at zero before we get another rate hike.
That's easy. What I've been telling clients and what I've been saying is that what we have here is a series of mid-cycle adjustments.
And you adjust your way all the way back to zero, but it was never a full cut cycle.
We never entered a cycle.
That's right.
What we have here is a failure to communicate. If you remember the movie.
I think we're
right?
threading the needle.
I like that.
Rob Martin, UBS U.S. economist, thank you so much for joining us.
All right, coming up here, we'll have more in the final round. Plus, we will preview those big after-hours earnings reports. Apple, Facebook, Starbucks, Lyft, coming up right after the break. Hello everyone, Miles Ludland here at Yahoo Finance. This is the final round. Stocks higher here after the Fed indicates there will not be rate hikes anytime soon. A pause in this cutting cycle might be coming. We'll have more discussion of the Fed, of course, coming up in just a bit. Plus, huge after-hours earnings reports are coming your way. Apple, Facebook, Starbucks, Lyft, all set to report their quarterly results. We'll have the preview, and we'll break down today's Fed decision with SunTrust's Keith Lerner. Also, we will talk about the travel business and earnings with Royal Caribbean CEO Richard Fain. We'll hear what the consumer is telling him. Joining me now, as always, my co-host Jen Rogers, also joined today by Yahoo Finance editor-in-chief Andy Cerverus. We've got 29 minutes to go in the session. Let's take a look at where we stand right now. All three majors are higher. The S&P back at a record. The NASDAQ about 40 points away from a record high. The Dow 200 points or so away from its record. 27,359 is the record there. We see 27,175 today. So, Jen, we hit those record highs earlier this week. The Fed kind of making people excited. And I think it goes back to a discussion we had, which was the Fed sets the bias for the market, and it has kind of some fluctuations along the way. But clearly, as we just heard from Rob Martin at UBS, this is not the end of the Fed getting easier with policy, however long that takes.
Right. Are they accommodative? Are they not accommodative right now? I think the way to get at that maybe is through, are they going to hike rates anytime
soon? Which a few
And
people asked, and the answer was
no. They are not hiking rates. The thing that they are going to look at to hike rates is inflation, and it would need to be a significant rise, and that is nowhere can you find inflation. So basically, fine, you have a pause, maybe you get another cut, but rates aren't going higher. I think we're here for a long time. Welcome to the new normal.
Andy Silver, how much inflation are we going to get?
Zero. None. We're not going to get 2%. I mean, that's a joke. Anyway, no, I think the answer to your question, which is rhetorical, I gather, is yes, we have an accommodative Fed, which is why the market's at an all-time high. I mean, it's a given. It's baked in. Plus, you have all these other really positive signs, which is to say the job market, and of course, the fact that we do seem to be making some progress, as noted, on the geopolitical international front as well. Yeah. Chile APEC cancellation notwithstanding, which is a curious thing that still needs to be figured out. But, all signs are positive right now, and even earnings, which we are concerned about, are fine. It's just like, so why wouldn't you buy stocks? Would you sell stocks here? Well, that's another question.
Maybe if you're going to retire soon. For more on today's market action, let's go to Scott Gamm live on the floor of the New York Stock Exchange. Scott, about 27 minutes to go before we get those big earnings reports. What's the buzz down on the floor?
Well, folks are still trying to get over what we saw from GE this morning, and it's not often that we say this, but GE is the best performing stock in the S&P 500, up about 10%. The company reported better than expected earnings this morning, and perhaps more importantly, raised their industrial free cash flow guidance for 2019, now expected to be in a range of flat to $2 billion compared to the prior range of negative $1 billion to positive $1 billion. So GE shares getting a nice bid today, and the stock is now back to where it was trading just about a year ago at that $10 mark. Of course, it's been exactly 1 year since CEO Larry Culp took the reins of GE. It is interesting to see GE's impact and how it's being affected by the grounding of the Boeing 737 MAX jet. We know that GE plays a role in the manufacturing of the engines for the MAX, but aviation revenue was a bright spot in GE's quarter, rising 8% year over year. Now, staying with earnings, traders down here are also keeping an eye on shares of Facebook. We're going to get their earnings report after the closing bell. The stock right now is still below that key mark of $200 a share. Remember, it was about a year and a half ago in July of 2018 when Facebook was trading at a record high, and then it reported that dismal quarter and the stock plummeted. It took about a year for the stock to rebound back above $200 a share. That was where it was this summer, but of course over the past couple months it has fallen below $200 a share. Now we are expecting earnings per share of $1.88. That would be a rise of about 7% year over year. We're also expecting revenue of about $17.4 billion. That would be 26% revenue growth year over year. So those are the kinds of numbers that we're used to with some of these high-flying FANG names. So we'll see if Facebook can live up to those expectations at the close. Miles.
All right, Scott Gamm, we'll talk to you after the closing bell.
As you heard, it is a big day for earnings, and it's time for our Tech Hell Talk to dive into the topic of tech earnings. Apple and Facebook. Here to walk us all through it is Yahoo Finance's Dan Howley. Wow, we're going to have an onslaught after the bell.
Just nonstop.
Really, Apple.
Apple.
You can't overstate Apple's importance to this market. It's NASDAQ, Dow, S&P.
It's like Mr. Wonderful.
It's everywhere.
Right.
What do we need to be looking for here? Is it, again, all about iPhone?
It's going to be about iPhone and services. The big thing being that analysts are expecting, and this is generally just what happens, is the new iPhones announced in September. The quarter that we're looking at, the fourth quarter, doesn't have much time for iPhones to sell through to get any meaningful reaction from the company. So really, we're going to be looking at mostly just a hold of people waiting to get the new iPhones. So we'll see a slowdown in iPhone sales. And this is just the cyclical nature of the company. That as well as potentially a slowdown in sales of the Apple Watch. So we might see that accessories sector kind of slow down for the company just for this quarter because they were waiting for the Apple Watch Series 5. So that might be an issue. The next quarter, though, a lot of people, and this is something that I said from the beginning, just based on anecdotally and just interest that I've seen, is that the iPhone 11 is expected to sell better than analysts were initially saying, and that was kind of my thought as soon as it came out. Was this is going to be a device that people are going to want to buy, and that seems to be the way analysts are looking now as well. Ditto the Apple Watch. They actually lowered the price on the Apple Watch Series 3 to $199. Obviously, that means the margins aren't going to be as high, but they're still going to sell more, get more people into the ecosystem. And oh, by the way, they introduced the Series 5 that was worth the same amount as the Series 4. So they're going to get more penetration into the smartwatch market, really continue to dominate there. So I think what a lot of people are going to be looking at is how badly the iPhone sales were. That'll give them an indication of how much people are really interested in the iPhone 11, 11 Pro, and 11 Pro Max.
So you mentioned the watch price going down. The iPhone price also went down on that lower level. That's been something that analysts have been writing about. And I'm curious, just look, we do this every 3 months. And stories in the past have been, oh, it's going to be the services quarter, right? That's what you have to be looking at. Before that, it was the ASP. It was the average selling price. That's just what is so key for Apple here.
And then they decided we won't provide that anymore.
Right, and now, like, okay, so that goes. We've had the prices cut. You brought up what it's going to do to margins. We've had quarters where it's going to be all about the margins. So they keep kind of changing the narrative, and we keep going along with it here. Of the metrics that are on the table tonight, I guess what is the most crucial for investors to be paying attention to? Because we've given them all of these shiny things to look at.
Right?
It is, but Christmas is coming up. Holiday season is coming up. I just don't know where to kind of focus the attention.
I'm going to give a sleazy answer.
I'm ready.
And just say that all of them.
Yeah.
It's really.
But it's because they've only sold the 11 for 10 days. Jen.
Right. And I mean.
Right? You can't.
I've had my
in the
phone
quarter.
for- oh,
in
yes.
the quarter.
Yeah.
It's
Yeah.
40 days of sales, but
Yes.
only 10 days in the quarter because they started on September 20th. You know, it's interesting. I think that, I'd look a little bit at the investment, right?
Okay.
Because they're going to do this spend for content. And so how much money did they spend there? And actually, that's a bigger theme with a lot of companies right now.
Yes.
These companies have so much cash. The tech giants have so much cash right now because, the taxes that are low, they built up all this money. Money is cheap. They can borrow as much as they want. And so that's a theme. Amazon, Google,
Saw that too.
Apple, and I think Facebook, because hiring moderators and people to look at content. So I think the numbers are all going to be a little weak because they're investing in the business right now.
I like
'cause they have
that.
a lot of cash.
I think that can also give you a lot of hints on what else is happening out there.
Yep.
That does bring us to Facebook.
Yeah.
Facebook. What do we? I
FB.
mean, come on. We've
Nothing
seen
can
Mark
stop.
Zuckerberg so much recently.
Yeah, I mean, he has to. When Congress, kind of tells you to get where you have to get, you're going to get there. And he's that was all kind of a lead up to his hearing, the appearance at Georgetown, the talk about Libra from David Marcus. That was all just kind of, let's get out there ahead of this hearing so we can get our talking points out before you guys start grilling us. Facebook is basically untouchable as far as the stock goes and the company in general, just because as long as people are using the service, advertisers will continue to purchase ads and people will continue to buy the stock. And it's not going to change unless there's some serious I don't even know what controversy could break this company now. They gave away our data to some fly-by-night business and we still use it. So what are they going to do?
Its own employees are complaining about its business practices recently. I mean, and by the way, you left out we're going to do a whole news thing. They did that.
Yes.
But, I think watching Instagram, which is the key to all the growth at this point, and it's growing like 40% still, and it's I mean, it would be a huge company on its own. Which some people think would be a good idea.
Maybe it should go out there. on its own.
And just looking at that number, I think it was like 46%, 40+% top line growth. They have all different kinds of ways to monetize stories still. I mean, that is the gold standard right now in social media is Instagram stories. So we'll be watching that, I would imagine. Right?
I think it's that and the sales part of it, the actual sell-through on Instagram. I think usually what happens is you have Mark Zuckerberg come out and name a couple of competitors that are the reason why Facebook is not the dominant force in social media, and it's incredibly disingenuous for him to say that Instagram isn't, as far as the photography, video sharing, and say that something like a TikTok is as big as Instagram. Instagram just dominates this category, and they're going to continue to dominate, and they will be a huge chunk of the ad revenue that Facebook brings in. And once they really get the sales off, I think that's just going to just build on it, and people will start using it as really a storefront more so than they might now.
Right. Young and old people
use
Instagram. Right.
That's why all the really young people are going to TikTok.
Hey, boomers.
Okay, boomers.
They don't care.
All right, boomers.
Okay, boomers.
All right, okay.
Dan Howley.
Okay.
It's going to be fun after 4 p.m.
I can't wait.
All right, coming up here on the final round, we'll break down today's big Fed decision with SunTrust strategist Keith Lerner. But first, let's take a look at where banks are trading out with 18 minutes to go in today's session. Welcome back to the final round. Stocks higher after Fed Chair Jay Powell announced the Fed has cut interest rates for the third straight meeting. Joining us now to discuss is Keith Lerner, SunTrust's chief market strategist. Keith, we are allowing you on the program today on a day when the market is higher. What'd you make of Powell's comments? And I guess that moment at which sentiment really turned during the meeting when he pretty much said, forget about a rate hike. We're not even thinking about that at all. It feels like that has gotten the market excited today.
That's right, and thanks, Miles. This is twice in a row I've been on the show when the market's up, which is breaking the historical trend that we've had historically. But no, I think today you just call it the Powell pause. I mean, I think the biggest surprise to me is just how definitive and how clear he was talking about that the Fed is on hold here, and that there will have to be a material change for them to cut rates again. But as you mentioned, I think the market's okay with that because they also said we're not raising rates for a long time. And at the end of the day, if the economy is kind of chugging along, grinding along here on a relative basis, stocks look like the place to be on a relative basis.
So, Keith, not only are you here on an up day, but the S&P 500, back at record highs. I'm curious, if you're looking out at this market right now, the story has changed a lot in just the last 2 months, where it used to be a recession is coming, and now what seems to be in vogue is the market melt-up coming. Do you buy this idea that we could be seeing a market melt-up soon?
Well, the first thing, we've been relatively positive, especially during the decline. And what we're seeing right now is we've talked a lot about on this show the carousel of concerns. That's flipped to be the carousel of catalysts as a lot of these concerns as far as China, Brexit, recession fears have receded. That's provided fuel for the market. So answering your question more directly, we still think the weight of the evidence is still higher over the next 12 months, but I also don't want to be complacent and say it's going to just be a straight up move. We have been looking for a fourth quarter rally, likely have further to go, but just as far as a melt up, that might be a little bit premature.
Yeah, Keith, so I was going to ask you about the catalysts, and can you be a little bit more specific? I mean, it sounds like you have to be referring to things like Brexit, China trade, et cetera. I mean, I don't see much on the domestic front that would say spur an earnings boom, for instance.
Correct. Well, so again, our main theme in this year was the carousel of concerns, and we always talk about how things in the market isn't about good or bad. It's all relative to expectations, and people were priced for a worse outcome with China. That's eased. They were braced for a worse earnings season. We have the beat rates among the highest we've seen in several years now in the earnings season. And also, I think one thing that's a little bit underreported, I think the global economy, or the market is sniffing out that the global economy is stabilizing after all this stimulus. And I think what's going to be important as we move away from this meeting today with the Fed, this week we have really two important numbers to keep an eye on. We've got China's manufacturing data overnight. And then on Friday, yes, we have the employment report, but we also have the ISM number, which was really weak last month and caused a lot of angst. But our base case is that overall, as we go through the end of the year, we'll start to see that stabilization in global growth.
All right, Keith Lerner is the Chief Market Strategist at SunTrust. Thanks so much for joining us.
Thank you.
Coming up, we've got the closing bell on Wall Street just about 11 minutes away. First, though, we're going to talk the travel biz and earnings with Royal Caribbean CEO Richard Fain, what the consumer is telling him. Royal Caribbean sailing the high seas with their Q3 earnings report that is out. This is the highest third quarter ever reported for the cruise operator. And joining us now is Royal Caribbean CEO Richard Fain, as well as Yahoo Finance's Brian Sozzi to jump in here as well. So Richard, last time that we were talking about your company was around the time of Hurricane Dorian. How were you able to deliver these results with that catastrophic event that had so many people sort of watching and worried about your business?
Well, actually watching Dorian and the impact on some of the people involved was heart-wrenching. But our business has just been so strong across the board. That was obviously an unfortunate distraction from what was an amazing time of good bookings. Our rates are up, our volume is up. Except for that one thing, it was an amazingly good quarter.
Richard, good to see you as always. You noted on the conference call that your 2020 booking trends have already started off pretty well. Explain that to us, because I think a lot of people, or at least our viewers, have seen today, GDP grew under 2% in the most recent quarter. So how come your bookings are already off to a good start for next year?
Well, as you say, our bookings are off to an outstanding start, actually. We had a record last year in terms of how much we had booked ahead of time and at what prices. And today we are better booked for 2020 than we were a year ago at this time, both in terms of the number of bookings and the price that those bookings are at. And I think that's a function of two things. I think, number one, cruising has really come of age. People understand cruising now in a way they never have before. Cruising is offering a product that people like in a way they never have before. And so it's a great time to be in cruising. And then we've been fortunate because some of the things that we've done with our destinations, with our refurbishing of the vessels, with our new technology, all of those things have made us a more attractive product, and people are coming to us. So I hear what people are saying about the economy, but so far, we certainly haven't seen any sign of anything other than a very positive demand looking forward.
Well, so, and Richard, just to follow up on Brian's question there about sort of the mix that you guys are seeing with your bookings, do you think it's a function of consumers want to spend a little bit more on their vacations, or is it that you feel that Royal Caribbean and the cruise industry in general, as you noted, are able to extract a little bit more of a premium price than perhaps they did in prior cycles?
I think it's a little of both. I think people more and more seem to value their vacations. Multi-generational travel, experiential travel has really ramped up, and so people view the vacations as it's not discretionary. People keep putting us in the discretionary category, and we're not a discretionary expenditures. Most people think of their vacations as a requirement. And so that's better. And then we've done things in the cruise industry and especially Royal Caribbean that make us more attractive to the consumer. And so they're willing to pay more for it and commit further in advance.
Richard, you're putting, I believe, 80% of your capacity in the fourth quarter in China. Isn't that a pretty bold bet with the economy slowing down?
It's not 80% of our capacity. China is still a small part of our total, where for the year we're under 10%. But yes, we've made an aggressive move in China, and that move is paying off for us. We started out very strong in China, and we've got only stronger. China is, and again, I know there's a lot of talk about the economy and everything else, but China is just going gangbusters for us. And again, that's both a question of what the economy is doing, but it's also a question of how we're responding. We've done a lot with the distribution system. Our future depends on our relationship with the travel advisors, with travel agents. And in China, we've done a lot to strengthen that bond as well. So again, it's people who want a better vacation, but it's also the steps we've taken to enhance our value to the consumer.
Richard Fain, Chairman and CEO of Royal Caribbean, thank you so much for joining us. And,
thank you for having me.
And Andy Serwer and Brian Sazzi, you guys both get to go have a good evening.
Thank you. We will. Maybe a cruise, Brian?
Gangbusters in China, Andy.
Yeah, I know.
Go figure.
Okay, yeah, go figure. Exactly.
Yeah, go figures, right? We'll see what happens going forward. Guys, thanks for joining us. Coming up here, we'll have the main event on the final round today. Earnings reports from Facebook, Starbucks, Lyft, and of course, Apple. We are back with all of that right after this.
Welcome back to the final round on Yahoo Finance. I'm Jen Rogers with Miles Udlin, and joining us is the host of Wi-Fi AM, Dan Roberts. We have 1 minute until the closing bell. Right now, stocks reacting pretty positively to the Powell presser and the Fed expected rate cut, third one here.
Thanks, Jay.
And now, if you thought that was exciting, after the bell,
We're only getting started, Jen.
We've barely even touched.
Don't you dare change that channel.
What we're going to be doing.
Apple, Facebook, Lyft. Let's go.
Starbucks.
Who?
I think it's over 100,
Coffee.
over 100 companies after 4 p.m. So you have no idea. I mean, those are the big ones that we're watching.
But someone might grub it.
You can always grub it. You could be on it. We don't even know. Live pictures of the New York Stock Exchange and the NASDAQ market site. Stocks right now near session highs. Also record territory. Got to look at some.
That's going to be a record for the S&P.
S&P. Have to look at our final numbers here. But the idea that, look, the Fed, whatever they know, they're not hiking rates. So at least you have this accommodative stance, and you can take that to the bank, and some people did.
Two of these.
You can take it to the stock market bank.
You can take it to the stock
market. It's a bank of sorts.
Put that in your pipe and smoke it.
It's a bank of expectations.
Your jewel. Two of the four names we're about to get, really good names within our ongoing, never-ending story on China. Because Apple and Starbucks. Two names very susceptible to what is going on in China. Really will be interesting to look at iPhone sales. The Apple story has successfully changed in the last little while, hasn't it? I mean, for almost a year, it was iPhone sales in China and trying to convince people, services, look over here at services instead. And now, I think that has been largely successful. I don't know about financially, but in terms of the narrative, the rhetoric, we are talking mostly about services. And by the way, because Apple TV Plus is going to launch in 2 days, November 1st, a lot of the discussion around earnings time is going to be about that, even though it's likely to be such a tiny portion financially and isn't going to be profitable for them for a long time because they're giving it away. Well, and a lot of people are going to be talking about Apple TV Plus.
And I was thinking about that because there's been a lot of data about how earnings how stocks have performed after their earnings so far this earnings season. And basically, your stock goes down less than you would expect if you miss, and it goes up a lot more than it traditionally does if you beat results. And it's amazing because it was only 10 months ago that, almost exactly 10 months ago, Apple comes out January 2nd, 2019, the first trading day of the year.
Apple Doomsday.
And basically gives the worst possible guidance you could have imagined. One of the worst guides I've seen from a major, maybe the worst I've seen from a major company. By the way, it wasn't part of normal earnings. It was a special announcement to say how bad everything was.
After a crazy close to the year.
Right.
It was insane.
The market had just gone down 20% in the fourth quarter. At its lows, it was off more than that. It was the worst year for the market since the crisis. Apple comes out and says the worst thing you could even imagine, and yet here we are, it's fine. It's kind of wild. It's like all it took was Powell basically saying, I don't plan on raising rates anymore, because the China story actually didn't get better.
Right.
That's kind of the thing you're talking about.
People decided they don't care about it as much anymore.
Well, now it's getting better. Fed Chair
Are we sure?
I will look.
That's the thing.
Chair Powell told me that it was getting better. He did mention phase one. He said it's looking, the outlook is better based on what's happening there. So I don't know. I'm going to take the man at his word. He's in Washington, D.C.
Still seeing slowing global growth.
Yeah.
An issue for the U.S. and all.
For more on today's market action, as we wait for these results, let's go to Scott Gam. He's on the floor of the New York Stock Exchange. Scott, walk us through the close here.
Yeah, a record close and a record day for stocks. Jen, it seems like the market is getting more used to Jerome Powell's press conferences. He has a history of saying things that spooks the market, but he did well today and he did well back in September. Now, it's not Jerome Powell's job to appease the markets, but still, stocks reacting positively today, not just to the rate cut, but to the idea that rate hikes are not on the table, at least not anytime soon. Now, your best performing Dow stocks today were names like J&J, McDonald's, and Merck. Remember, J&J was halted in the final moments of yesterday's trading session on news pending, which ended up being that J&J's own tests found no evidence of asbestos in baby powder, so the stock reacting positively today to that news. Your laggards in the Dow today were names like Chevron, Exxon, and Goldman Sachs. JP Morgan, the other bank in the Dow was also in the red today, although it was not one of the worst performing Dow stocks. The broader financial sector ended the session largely flat. It seems like the bank stocks didn't really know how to react to the Fed developments from today, because on one hand, you got a Fed cut, which is not good for the banks, but then Fed cuts tend to steepen the yield curve, so that's good for the banks. And then if this was 2 years ago, we would be talking about GE as a component of the Dow, but no, GE was booted from the Dow a little over a year ago, but still GE was the best performing stock in the S&P 500 today, up over 11% on the heels of those better than expected earnings the company posted this morning, and perhaps most importantly, that raise to the industrial free cash flow guidance. And we should also point out that aviation revenue at GE rose 8% year over year. So the turnaround story in GE showing a little bit more sign of life, at least for today, guys.
Scott Gam, we will talk with you tomorrow.
It's too busy of a day
to keep talking to you.
Didn't even realize that GE had, well, I mean, we did talk about it yesterday, but you sort of think of all the things that you knew were coming up today.
GE.
That is, secondary. It's amazing.
And an example, actually, and our colleague Brian Stassi wrote about this first thing this morning, but you were just saying, these companies that they beat on earnings and the stock goes up inordinately. I mean, by a, magnitude that really doesn't quite befit sometimes the actual beat. And we know that GE had some accounting wrinkles.
Yeah.
Just we're so happy that it's not worse.
It was up like 20%.
Investors just think, all right, well.
It was up 11, yeah.
This is better than
11
it
was
could
the most
be.
it went up.
Scott just said that.
It'll be interesting to see. Really, I thought it was up a high double digits. It'll be interesting to see what is more powerful if one of these big names we're waiting on to get any minute has a big miss. So what is more powerful tomorrow? The positive hangover of Jay Powell's move, or we know that some of these names, Apple, Facebook, can have huge negative impacts on their industries and other
big
stocks if they have a big miss.
I mean, that's been the theme all of this year, is that the negatives will just be excused away. We just won't worry about the negatives.
Well,
if someone comes out and says something terrible today, it doesn't matter, because guess what happened? Last week, Amazon had a bad quarter. Earlier this week, Alphabet came out with a bad quarter, and it's fine.
It's a market that wants to go up, as you like to say.
You don't have to like it.
Because Jay said the market wants to go up.
You don't have to like it. It just has
I
to.
do
I do like
make the rules.
Oh, I like it.
You like that?
Sure. You like that?
Yeah.
Also, did Alphabet have a bad quarter? Did Amazon have a bad quarter?
Well,
they had bad
spending more.
parts in
They're
their
spending more.
quarter that were worse than we thought, right? There were okay. None of these companies are falling apart. So they have little wrinkles, and people are latching on to the positive stories.
Well, arguably quite the opposite. One of these, Amazon and then also Alphabet, investing more is quite the opposite of falling apart, right? I mean, you're saying that we want to ramp up X, Y, or Z, and it's going to take some cost in the short term. Sorry, and then shareholders don't like it in the short term, but later on, then you say, guess what? Now we have nationwide one-day shipping in Amazon's case. Same with Alphabet. Well, investing more, and yes, that's why profit went down. Huge profit loss.
In the short term, it's a voting machine. In the long term, it's a weighing machine.
Oh, another good, another good quote. Should we just rattle off truisms about the market today?
Facebook out with its results for the third quarter. Let's go right to Jared Blickery. He's in our newsroom to break down those numbers. Jared.
We have beats on both the top and bottom lines. So let's take the revenue first. It came in at 17.35 billion expectations, or excuse me, 17.65 billion, and the expectation was for 17.35 billion. And then the the net income estimate per share is $2.12, and it came in at $2.12, and the estimate was for $1.91. Sorry, I'm mixing up my numbers a little bit here, but it is a solid beat on both the top and bottom lines. You have my word. Daily active users for the third quarter, 1.62 billion, and expectations were for just under that at 1.6 billion. And the monthly active users came in at 2.45 billion, exactly as expected. So again, EPS coming in at 2.12. Expectation was for $1.91. Revenue coming in at 17.65 billion, and the estimate was for 17.35 billion. And if we look at the stock here, it was up as much as 4%. It's up just over 3% right now. Now, the options U.S. market was pricing in about 6.5% move, so we may have some to go here. And a lot of focus is on what's going to happen in the fourth quarter. So I don't have those estimates just yet. I'm going to be digging through the report, but especially focusing on the expenses. They've been on a 2-year program now where they've kind of been revamping and investing in themselves, and a lot of that has to do with data privacy, safety, preventing election interference. We know that's going to go forward into next year's U.S. presidential election, as well as product development. So, but as we see here, we see beats on both the top and bottom lines, as well as a slight beat on the daily active users and monthly active users coming in line here.
Jared Blickery live in the newsroom. We've got more earnings coming out right now. Just real quick on Facebook. Again, Jared pointing out some of the capital expenditure issues here. The company saying that CapEx $3.68 billion for the third quarter. Headcount now crossing over 43,000 people.
What scandal?
Facebook.
What controversy?
Remember
sales.
Remember when they couldn't figure out mobile ad sales?
Sure.
Well, mobile advertising revenues represented approximately 94% of advertising revenue, up from 92, still above 90. They figured it out. They figured out mobile. Starbucks out with its fourth quarter and fiscal year 2019 results, and let's go to Julia LaRoche in our newsroom to break down those numbers.
Yeah, Jen, and it looks like Starbucks is reporting those fourth quarter fiscal results that are right in line with Wall Street's expectations. Adjusted earnings per share came in at 70 cents per share. That's in line with what analysts were expecting. Revenue also came in at $6.7 billion, which is just slightly ahead of what analysts were expecting at $6.69 billion. Of course, the closely followed number to watch is those comparable same-store sales, which grew 5% globally, which also topped expectations. And much of that growth was actually driven by the same-store sales growth here in the U.S., which rose 6%. Now we're going through the rest of the release to give you an update on what's going on in China, so stay tuned.
Julia LaRoche with Starbucks Q4 and fiscal year 2019 results. Looking through here, you said this is going to be a big one for China in terms of some color there. That's been part of the narrative.
Well, and we remember, I think, too much how everyone was focused on Luckin as a competitor. And Starbucks is opening. Julia LaRoche loves to cite the stat, I don't know off the top of my head, the number of new stores per minute, or every 3 hours Starbucks is opening a new store in China, whatever that insane rate of new store openings is. And people have focused too much on Luckin as a competitor, which is small potatoes. And Starbucks, I think, still, talk about trade war all you want, doing well in China.
Yeah, and that stock did nothing for a long time, and this year has broken out to new highs. Julia LaRoche has more on Starbucks. Julia.
Yeah, and just to dig into those comparable store sales in China, CEO Kevin Johnson says that the China growth was 5%, and total transactions in China grew 13%. So it looks like some pretty positive news coming out of China. And guys, I'll also point out that the stock is reacting positively to this earnings report. Last I checked, it was up just over 1.5%. Back to you.
Julia LaRoche with some of the details and breaking down Starbucks. Just looking through the release here, the company calling out opening its Starbucks Now store in Beijing. The #1 slot on company updates gets called out in China there. Anything that you're finding of note in here?
Well, U.S. comp sales up 6%, and a nice clean mix there. 3% increase in traffic, 3% increase in tickets. So you've got more people going and people spending a little bit more. I remember back in the fourth quarter of last year, there was flat traffic growth, but there was an increase in the amount that people were paying at Starbucks. So now a return to traffic growth there at stores. Starbucks has also announced a number of initiatives in the delivery space. Don't know how exciting that's going to be for them. They're small. Like, the thing is, with delivery, if your average order is $7 or $8, I fail to see
margins on that.
I fail to see how it's exciting for Starbucks. But then again, if Uber is going to come in and say, well, the Eats business will subsidize 100% of your delivery and actually maybe pay you even more money than the delivery is worth on just a revenue basis, then sure, they'll do it.
Well, it's not great for Starbucks. It's great for its customers, if you want to talk about convenience.
Exactly.
And the argument is always that it's accretive to the overall business, that when you foment happy feelings and good vibes from customers who say, oh, it's become so much easier to order from Starbucks on mobile, then they say, okay, I'll go to Starbucks more.
Or when someone in the business comes to you and says, "We'll do this for you for free. Would you like this?"
Love that.
Yes.
The point you made, I remember that last quarter about foot traffic flat, but the amount they're spending. It's a little bit like the average sale price story with Apple iPhones. For a long time we'd say, "Oh, look at the sales, fine," but look at ASP. Look at ASP. Same kind of thing. I guess you'd rather have people buying more coffee when they come than more people coming and buying just one little thing each.
Yeah.
Ideally, you'd have more people coming and they're spending more.
The iPhone of coffee.
One of our 2019 IPO names is out, Lyft, with its third quarter results. Let's head back to Julia LaRoche in our newsroom to break down those numbers.
Yeah, and Jen, I think the reaction here is that it was a lot better than expected. Lyft did post a loss of $1.57 during the quarter, which is actually probably worse than what analysts were expecting. But the bright spot here seems to be the revenue. Revenue came in at just above $955.5 million for the quarter, which was much better than the expectations for $916 million during the same period. And revenue per active rider was actually higher than expected. It grew 27% in the quarter. And, another ride-hailing service will be reporting, and that is Uber. And Uber shares seem to also be reacting positively to this Lyft report. So more to come. Jen, back to you.
Julia LaRoche with Lyft's Q3 earnings coming here.
That's an interesting point about Uber. Are these two stocks going to just behave similarly for a while, even though one business has a lot more going on than the other, which isn't necessarily
And one business
a good
is better, Lyft.
Right.
Well, it all has to do with competition, right? If they're going to have a race to the bottom on prices, then they're both going to get hit. But here they are. If you're stopping the promotions, that's good for both of them.
Yeah.
There can be a duopoly in
Tell
this.
Under Armour.
Most of the analyst notes that we get here believe that you can have a Coke and a Pepsi situation.
This is America. We support duopolies and monopolies of all sizes, preferably larger. But yes, Lyft, coming out and saying what they had already said to the Journal not too long ago, fourth quarter of 2021, expecting to be profitable on an adjusted EBITDA basis. So again, kind of torturing the definition of profits there. But we essentially have now an 8-quarter visibility as analysts would see it. They'd say we have visibility out to 8 quarters on what Lyft is going to look like. And these are two companies, Lyft and Uber, that came public with a lot of excitement around what their business would be. Everyone was also excited to see what the financials would look like, how would they behave as public companies.
And then rapid disappointment.
Well, and the stock price has come down quite a bit, yes. But now you can get a 50% discount on Lyft relative to where it top ticked on its first day of trading.
Now, what happens if and when Lyft isn't profitable by the time it has said, although if it's smart, it'll be profitable before then? The smart thing to do would come out and be a little conservative. But yeah, it's funny just to see the positive reaction to, we now think we'll be profitable at this time that is a good, year and a half away? More.
Yeah, but we can't say that doesn't mean anything when there were all these stories about how the risk factors, which again, I don't really like this story because it's very boilerplate, but the risk factors said we might never achieve profitability. Everyone latched onto that, and now they've kind of twisted that into 4 months and said, actually, we have 8 quarters to get there.
I think it's fine to look at the risk factors in the S1. I love doing that, and I don't like, to your point, when people retort, well, that's just boilerplate language they have to include. No, they don't necessarily have to say, along the lines that Peloton said, Peloton basically had a line like, we have no way of, not only do we have no way of knowing we'll be profitable, but we really have no plan to achieve profitability.
You have to say that if you
sometimes it is worse than.
You have to say that we haven't been profitable, though.
Right. Well, no, there's the line you have to say, but then some go further.
You have to say it, but to the earnings here.
Still ain't good.
The loss is shrinking.
Right.
Annual revenue growth rate is up. The guidance for fiscal year 2019, approximately 66%. That is up from 61 to 62%. And their prior guidance for their loss is also smaller. Some other news coming out. It's just, we got to talk about Twitter right now. The stock is actually responding to this news. Jack Dorsey coming out and tweeting.
Let's read the tweet.
Here.
You read
it. You're good at the tweet reading.
Jack is clearly subtweeting. So fun. Great subtweet. Zuckerberg and Facebook just tweeted, we've made the decision to stop all political advertising on Twitter globally. We believe political message reach should be earned, not bought. Why? A few reasons. And then he does a tweet storm. Now, one other of those tweets in the tweet storm is, I think, the key to this whole thing. It's not that one. But
it's a tweet storm.
Yes,
I'll get to it
There's
eventually.
a long thread. But there's one where he basically says, why should, if we come out and we say, we're doing our best to monitor which ads or which political messaging is true and isn't true, but you want to give us money? Well, then we'll still let you post them. And he's basically saying that's what Facebook is doing. I mean, you can't say we care about this, we're doing our best with this issue, here's what we think is the best policy, while also saying we'll take all your money for your political ads. So.
And right now the stock is off just about 2% on the news.
Twitter
is moving lower here. But look, Facebook might have an existential threat on its hands if it doesn't deal with this problem. Twitter trying to get ahead of it.
Think Dorsey intentionally timed his tweet storm to the second that Facebook had a big earnings beat?
It's also material information, so it would behoove him to wait until after the market closes anyway. I mean, his tweets are part of SEC guidelines, and they are official company communications.
It is an interesting day to do it.
Yeah,
because
of course.
Facebook is going to be asked, Facebook, why do you need to take political ads? We got to go. Coming up, we break down today's big earnings reports and what we're looking at for Apple. It's going to report any minute now. We are back right after this. Facebook just reporting its third quarter earnings. Apple earnings are set to be released any minute. And joining us now to discuss is Dan Flack, Senior Research Analyst at Neuberger Berman. So Dan, let's start with Facebook. Stock up, better than expected revenue and earnings. What is the number here that you think we need to be looking at?
Jen, it looks like a good result overall. What's key is really the revenue growth. The user metrics appear healthy. We'll obviously get a little bit more commentary on the call. But the company, despite a lot of the issues that are out there, is executing pretty well. And I think that is important to create value for its users and advertisers. And ultimately, we think that contributes to driving shareholder value.
So you wonder, guys, all of the discussion and hue and cry in DC over Facebook, it hasn't done much to hurt the company. I mean, you know, I am eager to hear about user numbers and user growth, maybe on the call. I'm sure people will ask about that. But it does lead you to wonder, is there sort of a two worlds on Facebook? I mean, for all the talk about truth and advertising and fake news and does it care enough about this and that and false information, clearly a ton of people in America don't care about those issues. They are continuing to use Facebook and advertisers are continuing to spend money there.
In America, and I think globally as well, Dan, there's obviously a lot of things that people find valuable on the platform. But to step back for a moment, in terms of the issues around transparency and improving governance and really trying to do a better job helping people, helping users understand how the platform can be weaponized at times, I think it's important that the company do more in terms of educating people. They are doing a better job relative to a year and certainly 2 or 3 years ago working with governments and regulators, but more has to be done. But if we think about the numbers and the business itself, it looks pretty healthy overall.
How do you model how many employees Facebook is going to need to deal with the problems that they have? When you look, they have over 40,000 employees right now. And the growth that they're having and the amount that they're spending, how do you as an analyst model that in the years ahead? Should we expect to continue to see it ramp this way?
Jen, I look at a number of different dimensions. First of all, on the R&D side, in terms of the innovation engines underneath, we look at how that is progressing. And remember, of course, you have to consider Facebook, you have to consider Instagram, WhatsApp, and Messenger. The latter two, I think, can become more important drivers over time. So I model the R&D. I look at from a safety and security standpoint. And of course, remember, Facebook and Google, Alphabet, and others are investing in more people and, of course, technology tools. So it's a combination of different elements underneath. But to be clear, this company, we would expect headcount growth to remain very high for the foreseeable future.
And then just quickly, we have about 5 minutes to go until Apple reports its earnings. When you look at that company's quarter, what are you expecting to see in there? What do you want to see that business look like as they continue to emphasize their services and also deal with whatever is happening in China with their business, which at this point seems a little bit unclear. We knew it was quite negative at the beginning of the year, but that may have turned around for them a little bit.
I think, Miles, looking at the quarter that gets reported, clearly there's an element of the iPhone units that are going to get sold into the channel, and that those will be what they're going to be. If we look out into the next quarter and really over the next year, I think what matters to the story here is that customer satisfaction with the iPhone 11, and we had talked about over the summer that expectations were pretty low, so not a heck of a lot was expected from this. But the devices are really resonating with customers, and I think part of it is the capabilities, of course, better camera, longer battery life, really this integration, the hardware, the software, the services, and then you add in a $50 price cut. So I think that's going to help drive demand over the next year. The install base, the growth there suggests that even though the smartphone environment remains difficult, Apple users are having a good experience. I think the point on China is obviously a very important one. Besides the trade issues, which of course can have an impact on demand as well as Apple's supply chain in China, I think what's going to matter here is whether the global economy remains decent enough so that consumer demand holds in. Now, there are going to be quarters where some quarters are going to look better than others. But if I then step back and look at the broader Apple story, and this is what I think is somewhat underappreciated at times, there's services, there's wearables. We've talked before about the wearables opportunity in terms of the healthcare market. So there's a lot going on here, which I think is notable.
There's a lot going on in this market. We've got earnings. We also had the Fed out cutting rates today. Let's go to Brian Chung. He was at the press conference, asked Jay Powell a question. Brian, what do you think
Got shot
happens
down.
now?
Got shot down.
Got shot down? Well, I'm not going to say that. But Brian Chung, a big moment for you at the Fed meeting. Not you personally, but for you. What did you think was the big moment?
Yeah, very exciting. I asked him about a very kind of in-the-weeds question about balance sheet composition. He said the Fed's not really thinking about that right now. They have plenty of other things to think about, like whether or not they will cut again sometime in the near future. This is the third consecutive rate cut that they delivered on after cutting by 25 basis points in July and September. Keep in mind that the current range is now between 1.5 to 1.75%. No dot plot projections for this meeting, so not a lot to work with. But what was interesting was that the statement did change. So they used to say that they would be acting as appropriate to sustain the expansion. That language has now changed to will continue to monitor the implications of incoming information for the economic outlook. Although, to be fair, Chairman Powell in the press conference did use the word appropriate again in saying that he thinks that monetary policy for right now is, quote, appropriate. So not necessarily mission accomplished, if you will, but does seem to hint at a pausing bias for whether or not the Fed will cut interest rates more. Keep in mind that 75 basis points was the around the same amount, actually exactly the same amount that the Federal Reserve cut by in 1995 and 1996, when similarly the Greenspan era Fed was trying to avoid a recession amid concerns in Russia and also with the failure of LCTM. So a lot of interesting things there. We did see 2 dissents from Eric Rosengren and Esther George. Not necessarily a surprise. Both of those individuals dissented against the Fed's last 2 decisions to cut interest rates as well. But again, no real hints as to whether or not the Fed will move again in its next meeting. That is on December 11th.
Well, Brian, you mentioned there's no real hint. I mean, I kind of thought the chair was pretty clear, like this is going to be it for now. But I guess the other thing, your takeaway from today's press conference and from the statement, it seems like the mid-cycle adjustment meme is going to temporarily go away, but there was so much discussion about the next rate hike, and Powell was so forceful in that is not imminent in any way, shape, or form, that the next move, right, let's assume a pause in December, January, maybe even into March, the next move is almost certainly down for this Fed. I think that's what the market was reacting to today.
Yeah, well, I think that raises the question of whether or not you can aptly compare the language that the Fed used in the meeting today to the word patient that they used before the Fed actually began cutting interest rates around the summer of this year. When they said the word patient, there was kind of the chance that maybe things would get better and that the Fed could continue to hike interest rates again. But here you have Chairman Powell in this meeting saying in the press conference the chyron that you see right below you, which is that we're not thinking about raising rates right now. So that completely removes any sort of possibility that they would have a bias towards hiking or being hawkish again. So if anything, it's really just staying on pause or cutting interest rates further. So it's kind of one or the other, depending on what happens. Of course, the Federal Reserve and Chairman Powell saying it depends on what the economic conditions are, but not even necessarily data. I mean, these are still insurance cuts by all standards. Chairman Powell acknowledging that all the data seems to be okay for right now. So as you mentioned, Miles, I mean, it really depends on what happens in the next few meetings. But as far as the biases that we've kind of talked about in the past, it seems like for right now, it's a pretty clear bias towards more dovish policy, if anything at all.
You hate to see no Nats prediction from the chair today.
I thought about asking that, but I thought the more fun question was going to be about balance sheet composition, guys.
The thing is, the brevity with which he brushed off your question about balance sheet composition left time, I think, for a follow-up about the Nats.
I think he was quicker on the Trump question. He was quicker to brush off the Trump question.
Nats or Stros?
All right, Brian Chung down in D.C. with a recap of the Fed's decision today. We'll see you tomorrow.
Yep, go Nats.
He went to the Nat game last night.
Oh.
So they watched the Nats game at the Nats Stadium.
That's fun.
That's cool.
And he went.
That's very
on
cool.
his Instagram.
Nothing was more lit than in Toronto when they were watching the game.
Exactly.
It was
That's exactly right.
We are watching for Apple earnings right now. We've got Dan Flax from Neuberger Berman. We are expecting these any moment. We'll go to Jared Blickery here. You've been talking about what we need to look here. Up, they have come. Jared Blickery is live in our newsroom to break down those numbers. Jared.
Apple stock is spiking here. It's a big beat on both the top and bottom lines. The EPS came in at $3.03, quite a bit above the estimate of $2.84. Now, revenue came in $1 billion higher than expected at $64 billion. iPhone revenue came in at $33.36, and that is versus estimates of $32.25 billion. And we got some other numbers coming out here too. Service revenue came in at $12.51 billion versus estimates of $12.16 billion. If you're keeping track, all of these numbers are beats so far. And we also have iPad revenue coming in at $4.66 billion. Lots of numbers here to go through, but the stock has been up as much as 3%, hit a high just above 252, so that would be a record high. The previous high was just above just below 250, and the options market is pricing in a 5% move, so we could see some additional movement here, especially on the call. But so far, nice beat for Apple on both the top and bottom lines. Looks like also beats on all their category breakdowns as well here.
All right, Jared Blickery live in the newsroom with Apple's numbers. Just going through a few things that stand out to me here, Dan. It looks like, I don't know if this is the first quarter that this has happened, but you look at the breakdown in products versus services revenue for Apple, quarter over quarter or year over year, product revenue down a little bit, but services revenue up quite a bit, bringing the overall kind of revenue win for Apple to that year over year increase. So it does feel like that shift towards services, that narrative will continue to gain credence, up almost 20% so far this quarter.
I think that's right, Miles. I think given how product cycles work, so for example, into the holiday season, you have products typically do better then, and then they're seasonally weaker over the balance of the year. One of the compelling elements of the services story is that it helps to balance out Apple's revenue stream. The other thing, and we'll see how their TV offerings and games with the arcade offering do over the coming months and quarters. But really, there's a lot of fertile ground for Apple to innovate and really add to their ecosystem. So we think it's a very interesting story.
And something else that came up this quarter, an increase year over year in iPad revenue. And we've seen iPad been okay recently, and I sort of wonder, as services becomes a bigger part of that business, is there an opportunity for iPad sales to reaccelerate because it's easy to get a cheap, well, not cheap, but relatively cheaper device to consume some of this stuff on?
Well, I think the iPad, and I'll even go back a step and talk about Mac. These businesses are surprisingly resilient for Apple. The company continues to innovate. User satisfaction is high. Now, the devices work well, and so the replacement cycles might be quite lengthy. But you saw the new iPad offering that came out in September. And so the devices are popular. And so the fact that the iPad's growing and we've seen some improvement over the last year, that suggests that there's innovation left even in the iPad, certainly in the Mac.
Maybe they made the keyboard on the last MacBook to accelerate that replacement cycle, because it has not been fun. For me, Jared Blickery has more in our newsroom on Apple's quarter. Jared, what do you got?
Yeah, we have a couple estimates for the first quarter, which is the current quarter in which we're in, and it looks like they're looking for gross margins between 37.5% to 38.5%. The estimate was on the lower end of that for 37.6%, so that is beating the Wall Street estimates. And then they're also seeing first quarter revenue $85.5 billion to $89.5 billion, and again, the estimate for Wall Street was on the lower end of that, $86.5 billion. So in their projections for the current quarter, which is a holiday quarter, exceeding expectations.
All right, Jared Blickery live in our newsroom with Apple's data. Yes, Dan.
We talked about the services gross margins being pretty good as well. And with iPad, also some mention of watches in the report.
Yeah, wearables up almost $2 billion in terms of revenue over the same quarter last year. $6.5 billion wearables revenue this quarter, 4.2 same quarter last year.
I'm going to have to change my tune on wearables because I'm just not a fan of any of that stuff. Now, that said, glad you mentioned iPad because just anecdotally, some anecdata for you.
Anecdotally, yeah, sure, that works too.
It works.
I have not been happier with any Apple product in my lifetime than the iPad mini. Big iPad mini fan. My iPhone frustrates
me. And it shows up in the results.
I don't think every new iPhone model is incrementally better enough anymore. I'm not happy with certain Apple services. I'm not happy with my laptop. Love the iPad mini.
I thought you were going to say the AirPods.
No, hate. But the iPad is a product that just... It has stayed simple and it makes people happy.
Serious question though, Dan Flax, on the AirPod, because Dan Roberts hates the AirPods, but I think that it's probably the biggest kind of status device that Apple's come out with since the iPhone. I mean, does it seem to you like, even though it's only a $200 product, now $250 with the AirPod Pro, that it can be a meaningful driver for that part of their business?
Miles, I think it's a cultural phenomenon. I mean, think back to the iPod. Let's do a little more history here. Remember the white earphones.
Remember the famous commercial where it was just a color screen and the white
thick brick.
And but Apple has taken a product category that people don't think a whole heck of a lot of, earphones, and they've really changed it. They've pulled together the hardware, the software, and the services to deliver an experience that's differentiated, that's cool, that's fun, that's easy, and it ties in with everything else the company's doing in a way that's hard for others to replicate. So I think the AirPods are a terrific product. I think the AirPod Pro, I've ordered mine. I think they're going to do very well. The early reviews are positive, and that speaks to the runway this company has over the next few years.
It's basically as if they just raised the prices on the phone $250 because you have to get the AirPods. So
they give you the corded one, but no one wants that.
No, and also they took away the old hole, so you only have one thing. If you want to charge and do anything at the same time, they've got you in there. So the average selling price, I feel like if you added that in, your ticket price is pretty good. The margins are nice there. Yes, I've ordered mine.
Jen, if you want to if you want to make up a new metric, net effective iPhone price, you're an analyst.
I can do that. I should. You want some anecdata? When I was at the Genius Bar the other day, the guy had his AirPods in, and I said, "Oh, do you ever worry that those like cause cancer or something?" And he said, "Even if they do, I don't care." He likes them so much.
Oh,
I mean,
God.
people are so loyal to this product. They're
Over the
wearing
ear
them all
is safer.
day.
Over
They're
the
wearing
ear
them
is
all
safer.
day.
Well, I mean, if you think about it, though, even the Pro version now, so there's noise cancellation, they're a little bit smaller. To your point, Jen, in terms of raising price by making it an accessory that people want, but one could argue that. At the same time, though, look, they cut the price on the 11 by $50. So the company realizes, I mean, we all appreciate that you don't want to price yourself out of these markets. At the same time, there's a lot of innovation. There's a lot of R&D that's required. And so if we step back and think about what's going on here, this is an area hearing in terms of the AirPods. Maybe there are things they can do with health over time. So there are a lot of potentially interesting use cases beyond all of us, of course, speaking on the phone a lot and listening to music.
Do you think that there is a risk for this company if these shows that are coming out are not good? And we're getting some kind of weird reviews. Like, do you worry that whereas these other companies have come out for their content and they've got sort of a bigger array of content to offer, what is the headline risk for Apple Plus?
I think the headline risk in the very near term, Jen, is that, the shows, some of the reviews initially have been mixed, and that over the next 8 to 12 weeks, there's a little bit of disappointment. However, though, if we think about what's going on, this is a multi-year journey in terms of investing in content, investing in talent. Now, this isn't necessarily in Apple's DNA, so they have to bring in outside talent. Now, clearly getting Oprah, getting Steven Spielberg, they are able to attract people. We're going to have to see over the next several quarters how things do. Now, remember, the TV Plus is going to be included with the new devices, so a lot of people are going to try it out. But we'll see next year and the year after whether people renew or pay for the subscription.
And then, it would not be right to judge it just purely based on how it does at the very begining. Plus, they're giving the thing away, so you got to give it time.
People make their mind up kind of quickly sometimes on these things,
Yeah,
and they write them off.
But so certain people will say, I'm good, I don't need this, and then give it a year, and they get some new hit show that does hit, and then it's off to the races. So,
I think the curated content ultimately is what's going to determine the success.
Coming up, we've got more on those Apple earnings, watching the stock move here. We're going to talk to Constellation Research's Ray Wang right after this.
All right, welcome back to the final round. Apple, Facebook earnings out. Joining us now to discuss, principal analyst and founder at Constellation Research, Ray Wang. So Ray, let's start with Apple, what that quarter says to you and what you see in these results.
Yeah, this is awesome. What we're seeing is really iPhone 11 picking up. That pricing difference of $50 less is actually opening up markets in China. It's unlocking some of the demand. But more importantly was the $12.5 billion that's going on in services revenue, the piece that they're doing in that switch, really tapping into their base of 185 million iPhone units that we're going to see for fiscal year 20. So sales are going to be flat on phones, but services revenue is definitely picking up, and it's the non-iPhone revenue stuff that's getting very interesting. What do you think?
Ray, Dan Roberts here. Let's stick with China, actually. Let's talk a little bit more about that. It looks now in hindsight, and you talk about the price drop, but it looks like maybe people panicked a little bit too much about Apple and China.
Yeah, no, I definitely agree with you there. And what's actually happening is, given that Samsung's almost non-existent now in China, it's mostly a market of, Xiaomi, Huawei, and Apple. Apple's still seen as the status symbol. And so the iPhone 11 sales are picking up there. And I think that is one of the most important things for people to look at. The other thing around China as well is where we are in the trade war. That extension perhaps of pushing out the tariff, or the 15% tariff past December, looks like it's something they're going to be able to navigate through.
And Ray, we were just talking about Apple TV Plus comes out at the end of the week. They're kind of not, they're kind of, they are giving it away to people who buy new phones. As you look at the company's value, does this do anything for you at this point? What do you need to see on the content side to start thinking about that as a real piece of Apple's financial health, not just sort of their Hollywood cachet health?
So just looking at it from a streaming set of services perspective, that $4.99 that's going to happen maybe 7 months from now, maybe 9 months from now, I think we're going to tell by really the attach rates of really folks that buy Roku and Apple TV Plus, the folks that do Netflix and Apple TV Plus. I think it's an and strategy that's actually going to happen. People probably can handle no more than 3 streaming services at the same time. So it's going to be interesting to see how they choose that. But by giving it away for free, people, or trial level, in a trial subscription, people are going to be able to experience it and see what they think about it. But that plus the payments that's going on with Apple Pay, along with the software piece in Arcade, along with the App Store, I think these are all coming together around that platform. It's content, network, technology, and customer all converging into one data-driven network.
Can we switch gears and talk a little bit about Facebook right now? Better than expected revenue and earnings coming out. It's so fascinating because they've been in the news a lot lately and so much criticism around this country, so much headline risk. Their founder and CEO getting grilled on Capitol Hill, not getting rave reviews for a speech, under fire from multiple angles. And yet here comes this company and they seem to be totally immune to it. What do you make of that?
So there are a couple things here. One, most Americans don't know that Instagram is owned by Facebook, so let's start there. 2, they're blending all their numbers, right? So the daily active users now include all the properties, which actually shows them that there is some growth. That 8% growth in daily active users was actually an important number to see. And there's really no other competition, right? So if we're walking into campaign season and holiday season, right, one can expect that there's going to be some growth on the ad revenue, and that's going to pick up. But what was also interesting to watch is the international growth, that they're actually still getting some traction there. But the problem here is we're in a digital economy. Trust is the currency, right? And they lost that trust. You saw what happened with Libra and what happened with the cryptocurrency. And so they got to do a lot to regain that trust.
So you point out that many people don't know that Instagram is owned by Facebook. Do you think that as people learn that becomes a risk for the Instagram product as well, where we've seen so much growth, especially in stories? Will that become an issue for people, do you think?
I think over time, but it's one of those things, it's funny, you walk around, people are like, I'm not going to use Facebook, but I use Insta. I'm like, okay, great, congratulations, right? So it's kind of funny when you think about this. But it's good that they have 2 brands to kind of shield them for that. I think that's kind of an important piece for them. And of course, the WhatsApp and the messaging as well. So,
Ray, just quickly, I also think that there are people who, they know that Instagram is owned by Facebook, and yet they still think that somehow Instagram isn't quite as bad, and Facebook's over here and has problems, but Instagram is clean and nice.
Yeah, Instagram is clean, and I'll text that to you in WhatsApp. We'll all be okay. Don't worry about it. They're not even tracking me. Everything's fine.
Right.
So that's part of the fun. But it's okay to have the multiple brands. And when you look at the combination of those multiple brands, it's been a great portfolio strategy for Facebook.
And then, Ray, let's talk a little bit about breaking news here on Twitter. News we did not expect today. Jack coming out in a thread saying they're going to ban political ads on Twitter. Basically, I wouldn't say subtly, I would say explicitly subtweeting Mark Zuckerberg on his decision here to change the way Twitter wants to operate his platform. I guess two-part question here. One, on the business side, does this really change anything? And then two, in just thinking about Twitter and Facebook, where they sit in the culture, is Twitter here trying to further distance itself from the social media umbrella that I think the two get lumped under, even though we both know they're very different services. But to your point about average Americans, a lot of people don't use Twitter. A lot of people don't really know what it's all about relative to Facebook.
Yeah, so once again, Twitter's been always proactive about getting ahead of regulations, being a lot more ethical about it, trying to manage the way content is perceived. Might not have worked all the time, but they're trying to get ahead of the issue. And I think this is Jack trying to make a point, especially when it's at 4:05 p.m. on release day. So I think that's kind of an important factor to look at. I think it's revenue that Twitter's going to lose. I think Facebook really is not thinking about taking away that part of the revenue. It might not be the biggest part of the revenue, but they also did announce the fact that they have a two-tier system where politicians can go out and say whatever they want, and the average individual is not allowed to. So it's going to be kind of interesting to see how that all works out.
All right, Ray Wong with Constellation Research. Thanks so much for joining us.
Hey, thanks a lot.
We're going to recap all of today's big reports right after this.
All right, welcome back to the final round. Let's do a quick recap of where we stand after hours. A bunch of major earnings reports. Apple shares, they're up a little bit after that company beat revenue and earnings expectations, up about 1% here in after hours trade. Let's take a look at shares of Facebook. That stock also higher, the company coming in with better than expected results on its top and bottom line. Let's move over to Starbucks. That stock is higher as well. The company coming in with same store sales that were better than expected. Also want to talk about shares of Lyft. That stock a little bit volatile in after hours trading, was higher, had been lower, currently up about 2% in after hours trading. The company coming out with a better than expected forecast for the fourth quarter, also saying that it expects to be profitable on an adjusted EBITDA basis by the end of 2021. Finally, got to mention shares of Twitter. That stock down about 2%. CEO Jack Dorsey saying on Twitter that the company will not play in the political ad space. This, of course, a shot across the bow at his friends over at Facebook, who explicitly want to play in the political ad space and have said it's not our problem what you say on Facebook because you're a politician. Twitter not going to be playing that game. The street doesn't like it. Certainly losing a little bit of revenue there.
And guess who has a call coming up this afternoon and could be asked this very
How about
question? Facebook has a call after their earnings, Dan, with Twitter coming out and saying this. It has to put more pressure. I know it's a smaller platform, but it has to put, there's already a lot of pressure, more pressure on Facebook. Obviously, they will be asked about this. Is there any expectation that Facebook, which they say political advertising is just a small part of their business model, might take a similar step?
It remains to be seen, Jen, but what I think will matter for Facebook, certainly in the wake of this tweet, but kind of more broadly over the coming quarters and months into the U.S. Election, and frankly, elections globally, is what is the framework that they want to put in place to help monitor this? They need to try and drive a little bit more consistency. They need to figure out some set of guidelines that can help people understand this. This comes down to leveling with their users in some respects and explaining to them that, yes, a lot of things are not necessarily going to be factually correct and that users can be misled at times. And so as part of all this, technology is changing, the social dynamics in all of these societies is changing. It's different for millennials than for people in other age categories. And so Facebook needs to do more, and it needs to, I think, take a much harder look about changes that might make sense over the next year or two here.
I mean, right, Facebook needs to say, look, this is not true, but we got paid. That's why it's on here.
Or just not get paid.
No.
Which is
no. We got paid. That's the important thing.
In
The
the
important
past.
thing, Facebook has a thing on all political ads. We got paid for this. That's the important thing that you need to remember as a
Senator,
user.
we sell
got
ads.
paid. That's right.
Or you could just take a page from Twitter.
But it is funny. It is funny. This is like classic day of Facebook. Their news cycle lives in two worlds. There's the very negative, journalist side of it, and then there's the street side of it that's like, hey, they make a ton of money. It's great.
Well, right, and given today's report, hard to think that Facebook has to be in any hurry to make a drastic change.
They're kind of structurally,
just be to appease DC.
As a business, they're structurally fading regulation. And why wouldn't they? There's been no regulatory changes for anything meaningful.
A lot of talk, little action.
25 years, yeah. It's fine.
Let's talk about Apple before we go. Is this just a all clear on Apple? Is there anything in this report that has you worried about where Cupertino and iPhone and wearables is heading?
Jen, I still think there are a lot of factors to consider. So, for example, there are risks around China. Competition in the smartphone market remains fierce. But I think what we're seeing in the results here and in the new products is that innovation is alive and well at Apple. And that's really key to the story. It's key because ultimately that is what's going to drive satisfaction for customers, for users of their products and services. This is going to enable them to move into other areas over the next several years. And from a shareholder perspective, that is critical. So if you've got this satisfaction, ultimately we think that can help drive shareholder value.
And Dan, something we haven't talked about at all with respect to Apple, we'll just kind of finish on this quickly, the capital return. I mean, they bought back a ton of stock last year. I think in the release said $18 billion worth of stock, $3 billion for the dividend. As you think about Apple's value, what are your expectations in terms of increasing that shareholder return?
I think they're going to continue to increase the buyback and the dividend. Obviously, this is a very shareholder-friendly management team. CEO Tim Cook and CFO Luca Maestri have been very focused on this as part of the overall story. I do think, though, it comes down to the execution on the product cycles, the new services. If you take that, couple that, Miles, with the capital return, I think this is a very interesting story.
Dan Flax, thanks for going through all these earnings with us. Great to have you here this afternoon. Dan Roberts, good to have you. We're going to see you on Wi-Fi AM.
What do we like tonight?
In the morning.
Nats.
Oh, there's a game.
You like the Nats?
Soto, the most exciting baseball player alive.
So you will watch?
Oh, yeah.
I watched last night.
I'm headed
Yeah.
straight home to watch.
I haven't watched a minute, but
I
I will
did.
watch.
Well,
what haven't we had in this series? You know, the team winning the
at
first
home.
2 games away, then the other team winning 3 in a row. Rule controversy, ejection of a manager. Woo! Baseball is back.
And then it's going to end tonight. This is the last game of the year.
That's all for now from New York, from the Fed to earnings to baseball. We got you covered. I'm Jen Rogers with Miles Upland, and this is the final round on Yahoo Finance.